how much wiggle
Whoa!
room. In other
Look at
words,
those
how far
colossal
does it go
creatures.
against you before you
They're
pull the
impressive,
plug,
but stay
if at
sharp.
all?
What's your
How
plan to
far will it go in
outsmart
your
them
favor
this
before you
time?
take profit, right? So you control the amount that you're going to trade, right? And how long, even you could have a time stop, right? How long will you hold on to this trade? So all of those things are under your control. However, what's not under your control is this particular sequence of wins and losses. That happens to be random for everyone. Even if you have a 99% win rate, that is a random sequence for you, right? Your losers will come. And even if you trade martingale, you trade martingale, even you can't. That martingale is really, when you think about it, the martingale approach is trying to take the randomness out of trading. Like, I will always win. You know what I mean? And of course, that doesn't work.
Yeah.
But see, this is really good. I think this trader is really close because the idea of not looking at your numbers to just enjoy trading, I believe that the easiest way to do this is to focus on your exits and entries and to pay attention to how well you are doing this. So you need to grade yourself on your entries, grade yourself on your exits, possibly even grade yourself on your mid-trade management. So I like, for example, I have a target on every trade and then I have a trailing exit on almost every trade. And so I kind of have that mid-trade management where, when does the trade go to break even sort of thing? Is it when the trailing exit gets beyond my entry price? Or is it when I hit the first target? Do I move to break even? You know what I mean? There's kind of a decision I have to make there. So I believe that you should be scoring yourself on your entries and your exits, and you should really gear all of your focus and all of your attention on that. Now, this assumes that you have a system that you've tested, you have the data for, you know it's going to work, or you don't know it's going to work, but you have a pretty good hunch that it would have worked over the last decade or so, and there's no real reason why you would think it would stop working now, right? So that's what I would say about this idea of, just to enjoy trading and living life. Living life could mean that you're just spending too much time in front of the computer, and you can automate your exits. I've done that. You can do things like that, or you can simply trade the higher time frames. But when it comes to looking at the numbers, and it sounds like this trader's like, I just need to learn to let go. The trader understands you need to learn to let go, but how do I do that? And again, I think for me, what I found, and for the traders that I work with, we just put all of our focus on what we control, which is how well are we entering these trades? How well are we exiting these trades? How well are we mid-trade management, sort of thing, right? Which is, like I said, moving to break even or whatever. So what are your thoughts on how this trader can stop looking at the numbers and enjoy life?
Well, I mean, that's the whole point of this, right? So that's a good way to look at things, I guess. A couple of things I've kind of came up for me. One, I'm not sure what numbers they're referring to. So like you said, it could be the trade itself. Maybe you're spending too much time in front of the screen looking at the charts. So yeah, I mean, like you said, I would say try to automate as much as possible. Try to, you could automate the entry, automate the exit, try to cut down the number of trades that you do, maybe, or number of systems. If a system isn't performing or adding a whole lot of value to your overall portfolio, then maybe cut it out and find something that's a little more time efficient in that sense. If you're talking about you're analyzing your stats too much, like your MFE or your drawdown or your win rate per week or whatever you're doing, then find a way to streamline that. And what's the minimum number of stats that you need to look at? And is there a way that you could automate that? Have some sort of system that sends you an email or something with your just some basic stats, or just look at your statement once a month or something like that, right? Enjoying life, I think, is the whole point of this. So I think it comes back to the automation ultimately. How do you automate as much as possible and only do the parts that you enjoy doing, right? I don't know, maybe it's the analysis, maybe it's the back testing. So figure out, what do you enjoy? What do you like doing in the trading process, and then try to outsource the rest. Maybe you could hire somebody to do some of your other stuff. And that could be one way to enjoy life more and get your time back.
Yeah, those are all really good options. Yeah. It's funny, isn't it? When you first start training, you kind of get sucked into it, as if you are.
You want to do as much as possible, I think, or something, right?
Yeah. I felt like I was trying to crack the code. I think that's why I was attracted to GAN and things like that,
Yeah.
And I think that's why GAN is so attractive to new traders. The idea that he's cracked the code sort of thing. But all the traders I know that are successful today, they have more of this letting go kind of sense. You know what I mean?
like what makes sense to me, I think is important. What important thing for me at least, like if it makes sense to me, I'm more likely to figure out a training strategy around it, as opposed to trying to fit myself into this other mold of Gann or Fibonacci or whatever it is, right?
Yeah. 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 That's why I always cringe when I see traders like on YouTube or whatever say, this is like, if you have this strategy, you've got the golden goose. You know what I mean? Like
Yeah.
that's part of that always gets me. Or actually, you can see it in the free factory forums too, where people like say this. And it's interesting because what ends up happening always, if you look at those threads, is someone will post a strategy and like it's like, I got it, and then everyone's like, first the naysayers come in and like, oh, this is crap, how come you didn't add RSI or whatever, something like that. And then
Yeah.
then there's like some people that get some attention, like get some traction, and more people kind of look and see what's going on here. And then by the end, like years later, it's only the hardcore that are left, And usually the original poster is long gone.
Yeah. Yeah.
Somebody else is kind of like a little team of people have taken over, But it often doesn't look like they trade it differently. So the way that the original poster posted it and the way that the people are posting at the end. And so if you come in as a newbie in the thread, you'll be like, hey, how come, what's going on? Oh, we found that, you got to have the smooth RSI and then, everything's good. It's so funny. Like, yeah, it's funny the process that it goes through. But I think that personally traders go through a similar process where you kind of like, you get the strategy, you get really excited about it. And you might even have some success for a while, but eventually there are things about it that you don't mesh with. And you have to either throw it away completely and find something different, or you modify it. That's where you end up usually.
Yeah. And it's funny, you look at those threads, right? Like how many people have actually tested it? I don't know. I've maybe counted 1 or 2 people per thread, and the rest of them are like, oh, I'm just going to do this right now, right?
Absolutely. Yeah. And you can tell by the questions because they'll say, well, what's the win rate, or what's the, how is it, how profitable, you know what I mean? They're asking questions that they would know if they tested it.
Yeah.
You know what I mean? Like and then they're like, okay, yeah, I'm going to try this. Yeah. It's funny. It's so funny. Yeah. Yeah. Anyway. Yeah. So I think there's a lot that this trader can work with based on what we've talked about here today. So hopefully that helps.
Yeah. But I like to focus on like, trying to live better and live life. That's awesome. All right. Thanks, Walter.
Yeah, definitely. Thanks.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice. Great job identifying that you're stubborn and that you're emotionally triggered. That's key. A lot of people can't.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Hugh, we have a question from a trader here. The question is, we asked the trader, what's your biggest challenge? And it's a he. Yeah, he says, my biggest challenge is that I'm quite stubborn and I am emotionally triggered. So being stubborn and emotionally triggered. One of the things I think about, I first think about when I hear this is I find that women traders have an advantage in that they typically, as a group, and I know I'm generalizing, but as a group, they typically are better at letting go of poor trades.
Yeah, I agree.
Whereas men tend to, their ego gets wrapped up in it.
Yeah.
And so that's a stubborn thing. And in fact, I think there was a quote about George Soros saying it takes courage to be a pig, or you have to know when to be a pig, or something like that. In other words, taking these massive positions that are obviously outside the norm. And to me, that's a very male sort of characteristic of being like, it's definitely going to work, So obviously, one way to look at this is to say, well, trading is just probabilities. In the end, there is a probability that your next trade is a winner, and there's a probability that it's a loser, and there may even be a probability that it's a break-even result. But it's all that's what we're dealing with, probabilities. And now, whether you believe the probabilities have changed based on previous trades, that does depend on your strategy, because there could be some interrelationships between, like, for example, in some trend trading strategies, you may be more likely to have a winner after you've just had a winner, right? And that sort of thing. Whereas if you've kind of had win, loss, win, loss, win, loss, you may, or loss, 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 you may not be likely to have another winner for a while until the market starts trending again, giving you really good signals. So that could be the case. But I think what's interesting about this is that the emotionally triggered part too. So this trader is recognizing that he is being stubborn, which I believe I had when I was starting trading, because I would move my stop loss. So I had a trade, I put my stop loss in, I take the trade, then the trade goes against me, and I move my stop loss further away because I don't want to be stopped out. Why is that? Because I was emotionally tied to that trade and I was being stubborn. I could have just decided to let the market hit my stop loss. That's what I do today. In fact, I can't remember the last time that I moved my stop loss. I just let it ride. But this trader is saying, he's getting emotionally triggered. That could also lead to things like doubling up on your next trade to make your money back, sort of this almost like a mini martingale trade, right? Or possibly straying from your rules because you're getting really emotional, right? Which, like I said, that's what I would do with my, moving the stop further. So I'd have like a buy trade on the USD CAD, and I remember like I was getting on an airplane, and before I got on the airplane, I moved the stop loss and I landed, and I was like, this was before there was internet on the airlines, and then they're like, oh wow, it moved even more. So then at the airport, I would move my stop even further. It's like, and then you end up taking like 4 trades worth of loss, instead of the original 1 trade loss. So by being stubborn. So what are your thoughts on this trader trying to get away from stubbornness and being emotionally triggered?
Yeah, that's a really good question. Well, first of all, great job identifying that you're stubborn and that you're emotionally triggered. That's key. A lot of people can't figure that out, or they're not willing to accept that. So that's great. That's a great start. On the more surface level stuff, like I think you can, through realization, or just like you're saying, looking at your numbers and rationalization, and just like not rationalization, but just like through objectively looking at your trading and your numbers, you can say, okay, I shouldn't be stubborn because these numbers, this is what happens. I have like a 20% drawdown or whatever, right? And that's a good place to start. But then if you look at it that way and you're still being stubborn and emotionally triggered, then you have to figure out, where is that emotion coming from? And this is what I've been doing, researching on my own for maybe a good 15 years, and even more so in the past 5 years. And all of the things that you don't like about yourself, or you have issues with, come from some sort of source. And that's going to be, it could be something in your childhood, something in your adulthood, whatever it is. But the reason you're doing these things is because it's protecting you from something. It's protecting you from an emotion that you didn't want to feel in the past. It's protecting you from some sort of getting hurt, right? It doesn't want you to get hurt. So it wants you to be safe. So it's going to protect you by doing this thing. So a good exercise that I found is that you sit down. You can do this with a therapist. You can do it with yourself by just sitting down and meditating, and just feel into that feeling. Like if it's being stubborn, like feel being stubborn, like feel it with your full body and see what comes through. It might not be an event. It might just be a simple fix, or it could be something like in your childhood or something like that. And just see what comes out. Keep asking yourself, why am I being stubborn? Why am I being stubborn? And don't judge yourself for it. Just let whatever comes come, and just see what comes up, and then face it. Just say, okay, that happened, but I choose to move on. And I think that goes for the emotionally triggered part too. Like if there's an emotion that's triggering you, or first face it. And then I think when you face it, a lot of times things will come up, and you'll be able to figure out either where that came from or how to resolve it. But a lot of times these emotions are triggering us because we are stuffing stuff down, and it's not, you're not able to release it. So I would also look at that. There's plenty of things you could do for that, like hypnosis, go see a therapist, meditation, plant medicine, whatever you want to do. But just kind of look at it in that sense, and don't beat yourself up because you're stubborn or you're getting triggered or whatever it is.
Yeah, that's a really good point. Some people may be interested in the trading tribe because it's basically the idea that it's basically what they do. So this idea of like where you're saying like lean into the emotion and feel the emotion. So at the trading tribe, you can find that you can go to Ed. We can put the link in the show notes. You can go to Ed Sequoia's site. So Ed Sequoia was the Market Wizards guy. He was one of the first interviews in there, right? And most people remember the Ed Sequoia interview because it's so unique. Anyway, he's written a few books, one on the trading tribe. I used to go to the trading tribe in my city. Don't go anymore, but it was really interesting because the whole idea is that we have these emotions, but we're not allowed in normal Western life to experience them. So you set up you kind of like subconsciously set up these things so that you have these really extraordinary events in your life. So you kind of set up the big argument, or you set up the big trading loss, right? So for traders, you're setting these things up. So what Trading Tribe is, it's a safe place to go to kind of experience these emotions. And you do exactly what you said. You kind of lean into it, and everyone's encouraging you. We don't really talk about trading at Trading Tribe. You just kind of feel it, right? So the best way to get information on this, it's not for everyone, because what we noticed at the Trading Tribe was people would come in, they read Ed Sequoia's interview in the Market Wizards, and then they like Googled him or whatever. They found his website and they found these Trading Tribe things. And so they're like, yeah, I want to learn how to trend follow like Ed Sequoia. And then they go to the meeting, and they're like, whoa, I was not expecting that,
This is not about trading.
Yeah, it was like people, yeah, exactly. People bawling their eyes out and stuff, and like, whoa, and they never show up again. That's it. But yeah, so the Trading Tribe book, Ed's book's really good because it explains exactly what you were talking about, kind of in detail. His theory, anyway. It's kind of Freudian, I guess, but the idea is that you need to experience these. If you don't have a place where you can experience these emotions, you will create these emotions in your everyday life. Like they will come up eventually. So yeah, it's kind of exactly what you're saying. It's just a different approach to sort of purging those. And the idea is that if you experience these emotions at the tribe, then there's no longer any reason for you to set yourself up for failure or whatever with your trading, so that you have these terrible emotion out, things, all that kind of stuff. So it's not just related to trading, but it specifically is a group for traders. And many cities around the world have local tribes. You can look that up at the link, sequoia.com, and follow the links there and see where the nearest one is, or if you can start one. They're all free. It's not that it's just set up for traders. So that might be something to look into too. If you find yourself in that emotionally triggered state, which we all really are to some degree or another, whether we recognize it or not. Just what do you do about it?
Yeah, and the culture is such that it's surprising how many people repress their feelings, right? Like even just some basic everyday feelings is super repressed. So anywhere you can have a safe space to let that out is, fantastic. All right. Thanks, Walter.
Definitely. Thanks.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this. Hey everybody, and welcome to another episode of the Trading Lifestyle Podcast. As you can see, it's been a while since I've done one of these, but I'm really excited to talk to Denis because he has this really cool software that's really going to help a lot of traders. So welcome, Denis, and maybe you could tell people a little bit about yourself and what you've been up to.
Yeah, sure. Maybe I can share my screen. Maybe, yeah, sure. I will just select my my screen right there. Don't know if you can see it. Yeah, you see it. Perfect. Yeah. So for the presentation, if you agree, we can have some summary about me. I have been a Walter Peters student a while ago. Now I'm trading since 2016. I think I started in 2012. It's been a while, so I'm a swing trader. I'm mainly trading the D1 and H4 time frame. I'm manual swing trader, so it's very slow style of trading, but it's my own style. A few years later, I had another website on which I presented my backtesting system, my results publicly, and at this time I had I sold some signals, and the link between this and my software is at some point I needed backtesting software. Backtesting is very, very important. I think you and Walt already a lot of time on your channel, but it's very important for in every activity. You need to train yourself. You need to build confidence during your trading journey. So you have to backtest. This is the only way to improve yourself. You have to test your strategies, your ideas on the markets, and the backtesting software is very useful for that. So I have been trading successfully. However, I needed to find new system with a more trade frequency, with a higher trade frequency. And for that, I looked for some softwares available on the market. However, there were only very limited softwares because I needed to customize my ideas. I need a modular software, and the available solution were not. It was not possible to do it with them. So I wanted to design my own system, my own software, and I came up with an idea. I had to build it myself, but first it was only for me to test, to assess my ideas, and I designed small backtest engine with some interfaces, and I needed for that to be fast and accurate with good quality data, because during the backtest, the data quality is very crucial, because it's the main point of emulating the financial markets. So at some point, I needed a user interface to assess the strengths of my ideas, trading ideas, and to have some statistics. Again, it's crucial, it's paramount when you assess a building system. So I end up with a backtesting software, in fact. So I told myself, if it's useful for me, maybe it can be useful for other traders who want to be traders, who want to test their trading systems. So I came up with the idea maybe of selling it, and right now it's the case. So I used this small software to improve, to add some new features for everybody to be like the average software backtesting software on the markets. So I had some needs. The first one is to be fast. I know, and I think you know, a lot of backtesting software, and sometimes they can be very slow to load some symbols, to assess, to test, to trade. So I want it to be very fast, because you can have quickly new ideas. So it has to be quick to test. The other point was to be modular, because again, it's important to test easily new ideas and not code, not use some word interfaces or word software. It has to be smooth in the process. I'd like to avoid, again, to save time, avoid the step-by-step time forward. I think you know it too. Just pressing the space bar it's useful, but when you are backtesting tons of system, you lose a lot of time just by pressing space bar to fast forward. So I needed to be faster than that, and other items like good data. I talked about it, and the efficiency. That's why there is a lot of statistics in the software to assess quickly the trading system. So maybe I can show you some features, but in the software you'll see there is a very common backtesting software features needed, like charting tools, like graphical tools. So yeah, here's naked markets. So it's pretty common backtesting software features. I will show you right now. So you can start a new backtest, and you can select the different symbols. You can select all major, for example. You'll see it's pretty quickly to load all these symbols, and after that you can fast forward. And for that, there are a lot of very simple tool to draw something. So yeah, you can change the time frame, of course. You can it supports the multiple monitors. If you want, you can detach the charts. So it's very basic features, but it's always needed for me and for every user. Of course, some other features, you can manage all the data you want to download. It's important to notice that all the data in the software are free. This is good quality data because it's coming from free and paying sources, but I wanted to be free in this particular software, and it's possible even on the Naked Markets website to download it for free, because it's just data. It's a very simple data. You just need to probe the market all day long, all year long, to have this data. So it's not very expensive to have and to gather, to be very fair and honest. So I don't see why the customer have to pay for this kind of data. So in this feature, you can select, you can update, you can choose your broker if needed. You can update and export data if needed. That's so you have common features like hotkeys to save time. We'll see after the rules, screenshot, yeah. Other stuff, pretty common again. So after that, if you want, you can set orders like pending or instant order. You have the indicators, of course. I think it's pretty useful for some users. So that's the point, I think. Yeah, some tools for the risk reward assessment. But yeah, it's the common features. But if you agree, I can show you the feature which is very interesting, I think, in this software. It's called the Rule Manager. What is the Rule Manager? The Rule Manager allows the user to define some kind of rules to customize how they enter or exit the market. They can pause the market. They can take some action. For example, if I create a new backtest, we can see on the left, so we're on the OZ daily chart frame. So we have all these rules here with some example. So maybe as an example, the engulfing buy rule. This is a setup rule. What is a setup rule? A setup rule is a rule containing a condition. Here we can see that we define a condition to be the last bar has to be a bullish one, an engulfing bar 2, engulfing 2 previous candles, And another feature is the bottom void bars. This is the space between the bars we can see here for the bottom. And here the action is to pause the backtest. So an easy test is to drag and drop this rule. We can set here, and automatically it will fast forward, and we can see that the software pause automatically. So it's very interesting to save time during backtesting, because instead of just pressing the spacebar, you can define what you want, like condition on the market, to pause. And after that, you can decide if it's good or not to enter or to exit the market, which is the main point to save time with this kind of software. So here, I can, if I want, enter the market manually by setting stop losses or take profit, or I can use the entry rules. What are the entry rules? There are some kind of other kind of rules like that. And we can define a way of entering the market. Here we can set the type of order, buy stop, sell limit, or other thing. And we can see here, this buy stop order, we can set the stop loss automatically. This is the low of the last bar. We can see the take profit, which is dynamically calculated. And we can set the lot size automatically or manually if you want. And you can set the expiration delay and the execution price, which is here the high of the bar. So instead of setting manually the order, you can easily just drag and drop. And right now you can see it's pretty easy to see how it's working. So this is one use case, very easy, but you can define a lot of rules. There are a lot of possibilities. I use a simple one, but it's possible. For example, here it's about the entry rules, the way we enter the rules, but we can define the way we exit the market. For that, we can, for example, change this rule, this entry rule. I will remove the take profit. I save the rule. So for example, I'm just there. I can set the order. There are no take profit, but I can see here the exit rules. There are some different kind of rules. The examples here are very simple, but still useful. PSR exit or a 3-bar exit, for example. So first, we enter the market. This is done, and we can use the 3-bar exit by rule. What is this rule? We have defined condition when the order growth is greater than 1. We'll see when the growth is greater than 1%. The action is to modify the order. And in fact, we modify the stop loss to be the lowest value of the last 3 of the previous 3 candles. So it's called the 3-bar exit. We can easily just drag and drop on the instant order. You can see here it's set, and we'll see when here it's not yet.
A lot of people just can't let go of that idea that you have to work hard for your money.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this. Hey, Walter, let's talk a little bit about cognitive dissonance in trading and how that can affect your trading, how that can affect your life, maybe even. What do you think about cognitive dissonance and how that affects traders?
Yeah, that's interesting. That's a really good topic. I'm glad you flagged that one. So So for people who don't know, cognitive dissonance is when you have like this friction between what you believe and like what is presented to you or what you're doing. So like, for example, if you think that all wealthy people are jerks and they have to be jerks to make money, they have to screw someone over to make money, and yet you want to be wealthy and you're working towards wealthy, does that mean you're trying to become a jerk? Right. And so there could be some things subconsciously that you're like, there's some cognitive dissonance, like, I don't really want to become one of those people. Yes, I do. No, I don't. And so there's kind of that friction, right? So in trading, one big one would be like if you have a bias. So for example, right now, I have a bias on the dollar yen where I put a trade in every day. In fact, I'm going to do it right after our podcast here. I'm going to put my orders in, and my bias currently is to buy the USD against the JPY. So buy the dollar against the yen. However, I put in buy orders and sell orders because it's kind of like a breakout strategy, right? So I don't really care if it goes up or down. I'll take both those trades and it'll be one or the other or neither. You know, if I was only going to stick to my bias, which, you know, I have a reason why I believe that the dollar yen is more likely to go up than down, but I would have a hard time actually taking the sell side. Right. And you kind of see this, if like, let's say you were in a trade for like 3 weeks. Okay. Maybe it was like a 4-hour chart trade, but it really went well. So, and you're using some sort of trailing exit. So then you spend all this time trying to figure out when to get out, right? Finally you get out, you know, you try and stick to your rules or whatever. You get out after 3 weeks, you make a nice, big fat profit. And then there's a sell signal immediately. What are you going to do, right? Mm-hmm. It's hard for people. Do you know what I mean? Like, you've already made all this money and you've already seen the uptrend, right? You bought and it went up, and then now all of a sudden you have a sell. It's kind of tricky, isn't it, to switch gears and do that, because there's some dissonance there, because you believe, or you did believe, that it was going up, and now is it going to be easy for you to take the other side when you've spent so much psychological energy on the buy side, right?
Yeah.
So will you be able to sell? So that's another thing. And then just like, you know, like, let's say, here's a big one, actually. This is my last one. Example. It would be this. You believe that the best way to make money from the markets is to find those turning points and hold on for dear life. So it goes up to a point, it double tops, and then you sell, right? And so you need to hold on for as long as you can so you can make a big chunk of profit. But your mentor or some strategy that you bought online says that you should trade the trend. Okay.
Yeah.
That's dissonance too, right? Because your belief is that this is how I should trade. And yet you're trying to emulate your mentor or someone who sold you a strategy in the dark corners of the interwebs, right?
Yeah.
It says you shouldn't try to find a turning point. You should just ride the strong trend. So what are you going to do, right? That's another like dissonance thing. So those are the way I look at it, kind of like who you're becoming or what you believe in terms of wealth and money, because that's a big one for traders. Whether or not your strategy fits your beliefs, and also the individual trades you take can also be a source of friction too, psychologically, because you kind of get married into one side or the other. So that's how I see it. Those are the sort of like 3 broad categories, I would say. What are your thoughts on dissonance?
Yeah, those are good ones. The only other one I would kind of add that kind of goes with your, you know, like going against what you believe about yourself, is that I think a lot of people kind of short circuit themselves because they have a string of winners and they make a lot of money or whatever. And then they think, oh no, I'm not supposed to be that successful, or I'm not a real trader. What am I doing here? And then they lose it all. They give it all back, right? I think that's one of the big ones that I see also. And I've done.
Yeah, they kind of feel like they're a fraud.
Yeah.
Sorry.
Yeah, I've done that too. So like it's definitely a natural thing for people to do. But yeah, that's the big one that I would talk about.
Yeah, I know really good traders that will pull all their money out when they hit like 100 grand or 200 grand or whatever. You know, they just start with a small account and they get to 100 grand, and then they're like, boop, I'm going to go back to 10 now, because, you know, they know that when they get over that 100 grand, they start taking huge risks and they get really, really aggressive and they wipe themselves out. So in some cases, it's other people that tell them, like their wife. You know what I mean? Like, it's like, So like, I mean, that's kind of one way to hack it. I think you should really get to the root of it. But that's a huge one, isn't it? Where it's funny, you know, we get told when we're growing up that you have to work to make money. You got to work to make money. You almost are told you got to trade time for money. And then all of a sudden this trading thing comes around and they're like, no. You're going to get paid for the decisions you make. So yeah, there's a lot of work involved in kind of building up your confidence and refining your strategy. That's where the work part is. But then after that, it's really more managing your mindset and just making decisions. So you can, like, I could sit down and take 10 decisions today and take 10 trades, and I would either lose money or make money depending on those decisions that I made today, right now, right? But that's not the case with most people. They learn that they trade money for time or trade time for money, whatever. So it's weird, isn't it, when you start thinking about it's a different way, But if you think about it, all the really wealthy people, they all have some sort of thing that's leveraged, whether they sold a bunch of books or a bunch of music albums, software, or do you know what I mean? Like they always have something where it's even like Elon Musk or whatever, he's an easy example, but he has different things that will, like, if the stock price goes up because he gets paid in stock or whatever, that so it's kind of a weird thing where if you really think about it, if you want to be wealthy, the two broad paths are usually real estate or the markets. And you could argue that real estate is a market as well, right? I would argue that, but it's never really trading money for time. You don't really see, other than like maybe surgeons or anesthesiologists or something like that, or lawyers, usually, and even lawyers, when you get high up, you're actually no longer making the money from your own hours because you become a partner. You're making you're making the money from the profits of the firm, right? Because you basically own a part of the firm as a partner, right? So you have a share in that. So even then, the big time lawyers, they're not even really trading time for money anymore. It's so important. It's so interesting how that's so ingrained in our culture. Like even in like healing circles or healing modalities that I've studied, a lot of people just can't let go of that idea that you have to work hard for your money. And I think that's something that everybody has to really work on and really evaluate. Why am I believing that? And, does that serve me or does it not? Yeah, exactly. I mean, I had a discussion with a friend the other day, a couple weeks ago, and he was saying, I just don't understand how someone could just, like, we were talking about cryptos or whatever. He's like, I don't understand how someone could just like all of a sudden be worth $1 billion or whatever, 100 million. He had like a big number in his head. And I was thinking, like, the Native Americans when the colonists came, the Native Americans, they didn't have a wheel. Now they did have a wheel for their kids. So their kids had little wheel cars, right? Like they'd give little things to push around and stuff because like little boys like that stuff, right? As we all know. But they didn't have wagons or anything like that. They had sleds, so their horses could pull like sleds, right? But they didn't use the wheel, even though they knew what a wheel was, and they actually made the wheel into toys. They didn't use it. Now, my thinking is, what if there was someone in a tribe that had come up with the wagon or like some sort of wheeled sled rather than the sled that they had? Imagine what that would have been worth to all the tribes, and imagine how many tribes would have wanted traded with him, because basically he came up with an idea, turn these sleds into wheeled sleds, and how valuable that would have been and how useful would have, provided that it worked. And the plains can be pretty rocky and rough and all that stuff. We know all that from the wagon trails, right? But I'm just saying, like, that's an idea to me. Like, that's an example of someone who could have, it didn't happen, but it could have been like $1 billion idea back in the old days, right? I mean, billion, whatever, whatever, however they traded back then. But, it's just really interesting to me to hear that mindset, because you're right. I mean, that's a big one. That is a big thing. You get taught from a very young age that, time is money. And you do homework during your home time, and you do schoolwork during your school time. And the first jobs you get are by money. Like my first jobs I got I was doing magic shows for kids' parties when I was a kid. And it was always time for money. Even then, it was, whatever it was, $80 an hour or whatever. It was really good money, but it was still time for money, you know, and I can only do so many magic shows on the weekend, right? So it's interesting how we just can't see what's all around us.
Yeah, definitely. All right, cool. Thanks, Walter.
Thank you.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.
Is your intuition actually adding anything?
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Hugh. Welcome back.
Thanks.
So I have a question here. This came up during our coaching clients call that we have with the coaching traders, and he's a really good trader, and he was talking about how he's back tested his strategy. He's now live trading. Okay, he's doing really good work with his psychology. He uses a hypnosis track that I gave him twice a day. He's good at journaling. He uses his subliminals. He's got an excellent track record trading, even with his live account, right? But he still questions himself, sees his rules. He sees the setup, right? He knows this is a valid setup, that he should take it, but he still thinks, should I be taking this setup? He still questions his abilities to interpret the charts as he should, even though he knows he's good at this, right? And this is kind of the backdrop, is that he's kind of transitioning over from back testing into live. I mean, he's been trading live for a little while now, but not that long. And he's just, he's at the point where he really wants to ramp up his account size and all that. So he's getting to this point where he's kind of questioning his abilities to interpret whether or not this is a tradable situation, right? What the markets are telling him. So what would you say about this?
Yeah, that's always a tough one, right? I think two thoughts on that. Like, number one, that might just be part of his personality and how he's wired. So he just might have to learn how to manage that. Two, which probably is more likely in my opinion, I was watching a Denise Scholl interview like a couple of days ago, and she was talking about how all these negative emotions that come up when we're trading link back to something else that happened in our life, right? Something that was programmed into us, something that our parents told us, something that society told us. And I think from her like traditional psychology standpoint, she says you have to kind of like just manage it, right? Manage it or stuff it down a little bit. And there's definitely some validity to that. And understanding where it came from, I think, in her opinion, is kind of like half the battle, and that kind of releases things. And it can, I believe. But I also believe that if there's something that you can't release through that method, I think it's some sort of trauma that's in your past that you have to like face and resolve. And that could be like before you were born, that could be when you're a kid, maybe you had a bad divorce or something like that. And a lot of these things have an impact on us that we don't realize the significance of. Like today, it might seem like a very insignificant thing, but back then it might have been a huge thing for you, and you might not have been able to process it at that time. And that could be causing what's, happening now. And she brought up a couple of examples of like, maybe not getting approval from your father or something like that. So, there's all kinds of things you can do for that, like hypnosis, whatever. There's a ton of modalities out there. But I think that's something to look at. If you're, obviously this guy is proven this guy is successful, but he still doesn't have that confidence. So I think that would be something to look into. What do you think?
Yeah, I agree. I told him we'll put a link in this show notes for those people who are not familiar with Denise Scholl's book. You guys can check that out. Yeah, so he's taking the You Get What You Trade For course, which actually is very closely aligned with Denise Scholl's ideas. Mm-hmm. And so he said that's been useful, very useful to uncover those things, like just like you were saying. So that's thing number one. And then the more sort of conscious thing I said was, to have your A grade trades. So you have like a printout or a screenshot of like the perfect trade and compare that to what you're looking at now, just to see, and to record your belief that the trade at the beginning of the trade, record when you take it, to record your belief that the trade work out. How confident are you on a scale of 1 to 10, for example? And then after you have hundreds of trades, you can go back and look and see, is your intuition actually adding anything? Because you can use that, you can leverage that if it's true, right? It may be exactly what you're talking about, which is why he's going through the You Get What You Trade For course and, uncovering all that, because that's definitely probably number one, right? But it also could be that his intuition is actually saying, hey, watch out, this isn't a good one. And it could be right. Now, I tend to think that's unlikely, but it's a possibility. So that's why we, you know what I mean? That's why I say record the data. So so work on your history and your psychology. Have a perfect example of a perfect trade so you can compare that to what you're looking at now, and then also record your intuition, feelings in your journal, so that again you can go back and you say, oh, okay, if I say it's an 8, 9, or 10, the trade is like twice as likely to work out and be profitable. And if it's below a 7, it's unlikely to be, it's more likely to be, a loser. So do you know what I mean? Like you can do things like that. So I think it's like kind of that multi-pronged approach is what we were talking about. So I think, but definitely, it could, like, Denise is onto something. Yeah.
Okay, cool. Yeah, try everything basically. See
try everything. See what sticks. Use all methods. I mean, the way I look at it is like some of it is subconscious and some of it is more conscious, right? Some of it is for your logical mind, like, oh, this is a perfect trade, and oh, I think this is a 9 out of 10. Like that's for your logical everyday. And then there's the real deep thing, which stuff is what you were talking about. Yeah, exactly.
Yeah. Okay, cool. Thanks, Walter. Yeah.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.
So if you want something different, reprogram your subconscious. Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Walter, let's talk about imposter syndrome. I know we talked about that a little bit on the last episode, but maybe we can go into that a little bit more in depth. Maybe you could tell us what that is and how that manifests in trading.
Right. So imposter syndrome is when you feel like you're a fraud, basically, right? So we talked a little bit about in the last episode where let's say you're a new trader and you start trading, right? And you have, in your first month, you make 30%. You make a bunch of money. Actually, I know a guy that did this. He went to one of our seminars and he was talking about this. If you feel like you didn't deserve that, if you feel like it wasn't you that did that, right? Then you can easily self-sabotage yourself, right? So you can do something to bring yourself back down to where you believe you should be. And I think this is something that comes along a lot with traders, like the traders we talked about in the last episode, who they could make a lot of money, and then when they hit a certain level, it's like a psychological barrier, and then they crumble. Mm-hmm. This is something that, to me, I feel like the root of this is really your core beliefs that you get when you're schooled at university or high school or even primary school, and your home life, the people around you that you trust and admire and ask questions of when you're growing up. You feel like, you're not worthy. Mm-hmm. So you're an imposter. You've lost, you've got something that shouldn't be yours. And in fact, there's a really good interview. I think it's the last interview of the first Market Wizards book. So it's called The Market Wizards by Jack Schwager. And I believe it's the last interview. It's either that one or the New Market Wizards. I believe the New Market Wizards has a different psychologist. I think the first one has a hypnotherapist. and he talks about this guy and how he it was kind of an imposter, but he was the other way around. So he had this imposter syndrome where he was a trader, right?
Mhm.
And he was losing money, and he wouldn't like look at his statements or something like that. Like he would get his statements from his broker and he'd throw them away or something. So under hypnotherapy, this all came out, right? It wasn't, the trader had come to the hypnotherapist to try and figure out, how can I improve my trading? But what come out from the hypnotherapy session was that he was basically felt he was a fraud.
Mhm. Yeah.
Because he was telling all of his friends he was a trader, but he was actually just losing money hand over fist,
Mhm.
And so he was talking about what he was doing with his statements and things like that. So yeah, the core of this is that you have to change who you are, right?
Mhm.
So you need to change, and we can change our personality. This is something that people think that, by the time you're 5, your personality is set. That's all BS. We know that from the recent research in psychology that you can change your personality, and you've probably done it. I've done it in my life, where you live in different places with different people, and you can kind of reinvent yourself and become a little bit more outgoing, or a little less outgoing, or a little bit more intellectual. You can change it's a progression. Our life is a developmental curve. It's not a straight line. You don't just stay an introvert or an outrovert or extrovert or whatever. You don't stay, simple-minded or whatever. You can improve lots of things.
Mhm.
So for imposter syndrome, what you can do is change your beliefs about yourself. And that's really, in my estimation, best done with subconscious tools like hypnotherapy, like subliminals. There's a lot of things you can do when you're falling asleep, but ways to seed your subconscious. You can use hypnotherapy. You can use a really good hypnotherapist. NLP is something that people talk about, neuro-linguistic programming, which is kind of on the fringe of psychology. And most psychologists that are academics will frown, but not all of them, but many will. But they frown at ESP research. So, whatever, and there's a lot of good research on that sort of stuff. So yeah, so I would say if you feel like this is something you're running up against, you would work on yourself, you would work on your core beliefs and change what you think about yourself. Because the way I look at it is your subconscious isn't out to get you. Your subconscious is just your program. So whatever you're programmed to do, look around your life. That's where you're at. Where you're at right now, where you're at today, that is your program. Okay. So if you want something different, reprogram your subconscious, and then you can get different results. The Silva method is another one that people look at.
Mhm.
That's another thing you might look into, if that makes sense to you. But there are lots of different ways to do it. What are your thoughts on the imposter in trading?
Yeah, so I was just thinking about that, and an interesting reflection of that kind of like the younger guy or the newer guy can't be successful is like, I see that in soccer a lot, right? Football.
Yeah.
So like you have these like 16 and 17-year-old kids playing on the senior team, right? With these 30-year-old, 40-year-old guys.
Yeah.
And you don't really see that in any other sport. And those kids could feel like, oh yeah, I'm an imposter. I don't belong on that senior team. I don't belong with those older guys. But no, these guys are just as good as the rest of them. So I think, that's a good way of looking at things and saying, okay, even if I'm not that experienced in trading, or if I feel like I don't belong here or belong making money or whatever, then you can kind of look at those kids and say, hey, this kid is doing really well at the highest level of soccer. Why can't I be at that level of soccer also? And
Right.
I think what you're saying is spot on in that you have to change the way you're programming. And at least from my perspective, there's two ways to do that. One is you can consciously change things, and that's if your programming is more in the conscious mind. But if it's more subconscious, then I believe that you have to get rid of a lot of the traumas that have been programmed into you or have been given to you, or whatever happened. And there's a lot of different ways to do that. Like you said, the Silva method, I've seen people get some good results on that. And some of the other stuff I've tried. So yeah, just try a bunch of things and, see how it works.
And it's important to remember that it's kind of normal, for people to feel like no matter what they've done, no matter what they've accomplished, that they're a fraud or that they're incompetent. I mean, that's kind of normal to feel that way, because there's always going to be someone who's better than you, right? Mm-hmm. Like that's just the case. Like when the models go to the runway, there's always going to be a model that's more attractive than they are. When the bodybuilders go to the bodybuilding contest or whatever, there's always going to be a bigger, more defined, stronger dude or whatever, you know what I mean? Or whatever. Like, and the same in trading. Like if you hang out with traders and you're starting to click and you're starting to make money, there's always going to be a trader who's trading bigger accounts or more, or making a higher percentage or whatever. And traders can be kind of jerks that way. You see a lot of like talks, traders give talks and they talk about how great they are and stuff like that. And it's funny. Like, I don't know. I just find it interesting. Like, how a lot of times traders will use their past to justify, maybe they feel imposter syndrome. You know what I mean? Like, maybe that's what's going on. Like, they feel like, I worked at, Bank of America and I was trading these huge amounts and I made this amount of money for my bank, and now he no longer works at Bank of America. He's no longer trading that huge amount, right? He's no longer doing that, but he still wants to feel important. So he'll tell those stories about what he used to do, and you know what I mean, and feel like, oh, I called the top on the pound and blah blah blah, things like that. Like, it's just, to me, it's just screams imposter syndrome. That's what they're. And there's a lot of that in trading. Even it's funny, they say, actually, this is a really good thing. I know I've talked about in the past, but it might be important for people who haven't heard this before. They say that one of the things I learned from one of my first psychologist professors was that you can get free therapy by going to a park bench, sitting on the park bench and watching people walk by, and listen to yourself, listen to what you say about the people that walk by, because that's the stuff that you're projecting out there. Do you know what I mean? So you see that guy and you go, oh, he thinks he's so smart and blah, blah, blah. Well, that's basically, it's a reflection of what you're saying, what you think inside about yourself. So so that's another thing you can do too, is catch that. Because if you don't know why it's happening, it's hard, right? Maybe you go see a hypnotherapist, maybe Silva method, maybe, park bench method, whatever. But there are a lot of ways to kind of get at that. Yeah.
All right, cool. Thanks, Walter.
Thank you.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.
Spend some time with the system and figure out how it works.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Walter, we have a question from YouTube. So this guy says, I've been watching the podcast for a while, and he hasn't gotten to watching all of it, but he's a beginner and he has a problem exiting trades. What he does is his stop losses are 10 to 20 pips, and he'll move to break even at 30 pips. And he says that he consistently can catch 50 pips, but a majority of the time he doesn't know when to take profits, and he's always hoping for more. And then basically it turns against him and he either loses or breaks even. So what are your thoughts on trying to fix that?
So I wrote about this in the Naked Forex book. Like, you kind of have to decide who you are, or you can be both, right? So I talk about this idea of being a runner, where you like the trailing exits, and you're going to have these really big wins occasionally, but a lot of times you're just going to have like middling okay trades, and you're going to give back profit, right? Or if you're a gunner, you use targets and you look for specific targets that can be based on quantitative data that you have. Like the pair usually goes this far in 10 candles or whatever. You know what I mean? Like, you can do something like that, but at the end of the day, you're just happy with the target. Now, I like to do both. So what I will do is I will have a target. Some systems, the target is relatively easy to achieve, provided the trade is winner, provided the signal's okay in this instance. And then the other bit of the other half of the trade, usually I will use a trailing exit on, because I like to catch those big winners occasionally. And anyone who's a trend follower will tell you that will make your year. That that time of the year where you get that really big trade or two trades of the year. So that's my belief, is that you can decide to be one or the other or split it up. Usually the test that I ask traders to use to determine whether you're a runner or a gunner is to say, all right, hey, Hugh, imagine you're in a trade and your trade is up 100 pips, but then it goes against you and pulls back, and you end up losing 50 of that 100 pip profit, and you're out at 50 pip profit. Okay, so that's scenario one. Scenario two is you are in a trade, it goes in your favor. As soon as it hits 50 pips, you get out and you're very excited. But then if you had waited just a little bit longer, it would have gone 100 pips. So that's scenario two. Which of those scenarios is more psychologically distressing? Is it scenario one? If that's the case, then you probably are a gunner. If it's scenario two, then if that's more, psychologically distressing, then you're probably a runner, and you'd be better off using a trailing exit. Or you can do like me and do both, and that way you can always, pat yourself on the back when when it's a winner no matter what, right? So yeah, it really comes down to that. You just don't know. Like you can use the ADX, and you can use the the moving averages, and you can do that, the MACD, and you can do all these things to determine whether or not the trade's going to keep going. But at the end of the day, the trade doesn't care where your stop is, if it's at break even or if you're up 900 pips. The market doesn't care. It is probably going to go up and down. Even when it's going down, even when it's going up, it's going to go up and down. So whether you get clicked out on your trailing exit or your break even stop, the market don't care no more. So what do you say about that?
Yeah, no, I agree. And I think, like you said, the data is super important, right? I think if you have a lot of data, you can really see, okay, does this make more sense to do this for me, or does it make more sense to let it run? One example recently that I tested, apparently it only works in the euro US dollar, the system that I tested, but works really well. And what I looked at was, I asked like several questions. Okay, how far does this run from the entry? What's the biggest run that it has? And then how often does it hit these other points, like 1R, 2R, 3R, or whatever? And I found out that you could get like 7R on some of these trades. So that was a reasonable target that you could put in there. I started using a 7R profit target at every trade, but my exit was on a moving average. So if it crosses over the moving average and it closes on the other side of that moving average, then I'll close it out. And that seemed to be the best balance between capturing some profits and still having that, capturing that big run also. So I think it really is about the data. Like, look at the data. Don't look at the data from a perspective of a particular trading system, but ask some questions like, how far does it run? How far does it get into profit before it snaps back? Or how often does your entry actually work as written? So those are some things to look at, and not necessarily just taking a certain strategy and going with that.
Yeah, you're right. I mean, and traders will find when they look at trailing exits that there are different types of trailing exits, right? There are like tighter ones that are going to bump up your win rate, but they're going to reduce your average winner size. And then there are looser exits that are going to depress your win rate, but your average win size is going to go up because it's going to more easily capture those huge wins, right? Those 9R, 10R wins and things like that. So yeah, so it really depends on what you want to do. I mean, I will say most of the time when I've looked at it, I have found, not always, but most of the time, the trailing exit is the way to go in terms of if you want gross profits, right? It kind of makes sense, right? Like you're letting the market give you as much profit as it wants to. That's not always the case, because what you'll find is that some systems, they kind of have like momentum signals, right? And it's just good for a little pop, and it's not, do you know what I mean? It's not necessarily likely to keep going. So it really depends on you, and how you interact with your strategy. So yeah, like what you were saying was really interesting. Like, if you look at the average distance that a trade goes, right? And then you go, well, the median is 75 pips, right? So I'm going to use that as my target, right? Because that's the median. And so, half of them are going to go further than that, half of them aren't. Remember, that doesn't mean you're going to have a 50% win rate or whatever, because it's just of the winning trades, right? So it's only the winning trades are even going to get on that side where the median is, right? So all those things you have to take into account. Yeah. So I mean, it's really interesting. I think when you're building a strategy, because you're forced to answer the questions like, what's important to me? I mean, kind of these sorts of things that come up a lot in trading. We talk about it in the podcast where all these things keep coming up. Like, what's important to me? How do I deal with this? What does this mean, right? And so when you're building your strategy, a lot of those questions come up because you're confronted with, okay, if I do this, then this is probably going to happen. Am I happy with that? Or should I do this so that I avoid this sort of feeling or this sort of, going down this path? So it's really interesting. In a lot of ways, it's like you're thinking like, who should I marry? Should I marry this person? Yeah, she's really great and everything, but she's got a cocaine habit. What am I? You know what I mean? Like, so like it's sort of like it's the same thing with trading systems. There's always going to be something you don't like about it. Even like the brilliant trading systems that have high win rates and high average winners and all that stuff. They usually have the problem of not trading that often, right? Like there's always something about so.
Yeah. And along those lines, like you're not going to find out about your girlfriend's cocaine habit unless you spend some time with her. So like the same thing with the trading system, right? You got to go through the iterations, you got to do the testing, you got to look at the data, you got to get on the screen and do some demo or whatever, live trading. So yeah, spend some time with the system and figure out how it works.
Great point.
All right, cool. Thanks, Walter.
Yeah.
See ya. All information in this podcast is for educational and informational purposes only and is not trading or investment advice.
Every day. So that's what I would say about that. It's totally up to you, but for me personally, I don't find that useful. I've tried other things. Like there was a supplement that's supposed to like those nootropics. Yeah. I tried that for a while. It didn't really seem to do much. It seemed like a bit of a scam, the one that I tried anyway. So yeah. So for me, I think you're better off doing like personal stuff like brainwave entrainment is what I would do that rather than just a substance. I find that to be well worth it, as opposed to caffeine. But that's just me. What have you found?
Yeah, I mean, I definitely like my coffee. It tastes good, but I find that it spins my wheels too fast, and I'm kind of just all over the place. The crash doesn't really hit me. Like I used to drink coffee before I went to sleep, and I slept fine. But it's that spin up of the brain, for me at least, that gets me all over the place and I can't focus on things. And I usually end up at the end of the day not achieving much. So I try to cut back, and I try to be aware of like if I'm in that state or if I took enough coffee to get me that state and I need to back off or whatever. So now I'll drink like half a cup or something. But some of those mushroom coffee substitutes are actually pretty good. I mean, they don't taste as good as coffee, but close enough, and you don't get that spit. I don't get that spit up, at least. I've tried the nootropics and they work, in a pinch, but I think, like you said, you're better off just doing like some internal work and some meditation or whatever to calm your brain, instead of relying on those nootropics. I think nootropics can be a good like bridge if maybe you're kind of, I don't know, you're depressed or something like that, right? It can kind of maybe give you a little boost until you can do it yourself. But otherwise, yeah, I don't see any long-term uses with that. I'd be interested in hearing your thoughts on alcohol, though. Like, what are you doing with alcohol? Do you still drink, not drink, or whatever?
Yeah, so in Australia, I'd be considered a non-drinker, but that's just because I don't. It depends on where the baseline is, right?
Yeah.
But I will occasionally. What I won't do is drink and trade.
Yeah,
that's a big like the problem. The problem over here, like in Australia, what happened? I've done it before. I've made the mistake where, like, I went out with some friends or whatever, came home. Okay, so the London session is raging, right? I'm coming home. The London session is raging. New York's or even New York's open if it's really late, and and then I place trades, and then in the morning I come back and look at my account and go, what was I doing? You know what I mean? So
Yeah.
I made that mistake. I mean, the last time I did that was probably like 2006 or back 2005 or 6. So I don't do that anymore, but I don't really drink that much either. I mean, they would say I'm a non-drinker, but I would drink. I would probably, okay, so here we are halfway through the year, right? So it's halfway through the year, so it's been 6 months. This year I've probably had 3 drinks, something like that. So yeah, I don't really think it really depends on what your goal is. If we're talking like trading wise, I think what we've been talking about, like nootropics or brainwave entrainment or meditation, something to help you focus, depending on what you need. Like what was interesting when you were talking about your experience with caffeine, that like I just kept thinking, yeah, that's like a classic reaction to what an introvert would do if they had caffeine, right? They would kind of get scattered, and you know what I mean? Like they would, you know what I'm saying? Like they would have all these things going on, and like and I understand that too. Like I've been there. I found that routine sometimes helps. So like if you have this routine with your coffee where you're going to do this, like you kind of go down a checklist, that might help from straying away from that or whatever. But yeah, so my belief isn't that alcohol will necessarily be a detriment to your trading, unless, of course, you're doing it and trading. But you know what I mean? Like that's the big. Or like even over here, like if you had a big night, and okay, so if I have a big night here and I wake up late, like this time of year in the winter in Australia, which is the summer in the northern hemisphere, like my daily candles, they're at 7 a.m. they're on. That's it. It's a new daily candle at 7 a.m. So if I'm not up, like if I'm sleeping in or whatever because I drank too much last night, that, you know what I'm saying? Like that then I miss trades or whatever, right? Or get a bad fill or whatever. So in that way, it could impact it. But I don't really think that, just having the alcohol in your system. I don't know. What are your thoughts?
Yeah, I mean, I think it's totally up to the person, right? Like how they perform. But it's interesting because in the past maybe couple of years, I've found that drinking beer really messes me up. Like even if I have a couple of beers, it's not a good thing in the morning. But like I'll drink, like I like whiskey, I like tequila, I like red wine, and I'll drink a little bit of that. And next morning I don't have hardly any effects. But yeah, it's kind of weird. But I don't drink that often anyway. And I found that on a day-to-day basis, it's kind of like it kind of messes up the signal, I guess you could say, like it from your brain to whatever. Like I'm a little slower. I'm not as quick. I'm not as focused. So on a day-to-day basis, it doesn't help. But yeah, so I've cut way back. I used to go to the store on a weekend and get a 6-pack of beer or whatever, but now I don't do that anymore. So,
right.
Yeah. That's what it is for me.
That would be like that would be common here where I live. I actually don't live that far away from what they call a bottle-o. Bottle-o is like a wine shop, whatever. Yeah, but yeah. So yeah, I mean it's interesting. It's like a lot of things in life you kind of learn over time, don't you? You learn over time. Okay, that was a bad. That was a bad choice. Okay, all right, Walter, we made a bad choice here, so we need to do this, right? So like you kind of just learn over like you've learned with beer and stuff. Like that's just kind of the way it works, isn't it? Like over time, you just kind of focus in on what's important, what works, what doesn't. It's like by the time you figure everything out, then you die. It's like, man, I had it right. I had it right.
What I found too is that I think a lot of the reason I drank was because I was stuffing these like negative emotions or memories or whatever, right? As I've done more of the inner work to release these emotions, like I don't need to stuff them anymore, so I don't need the alcohol. And I think a lot of people use alcohol for that. Like, at least it seems to me.
That's a really good point. Yeah, and it doesn't have to be alcohol; it can be anything. But yes, whatever. Yeah, that's right. Yeah. Good point. Yeah.
Okay, cool. Well, glad to get your opinions. Thanks, Walter.
Thanks.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.
The markets are not efficient. Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Hugh, so I have this question. A trader asked me something. He said, if the markets are efficient, then how is it possible to make money trading? Okay, so that's the question. Now, my answer to that is the markets are not efficient. In fact, they rarely are efficient. And this idea is very common in academia. You will have these professors who do not trade, do not make money trading, and frankly, don't understand the markets, come up with all these equations about why the markets are efficient and why it's impossible to make any money, and that the price is just a random walk and this and that, all these theories, right? And I this is my belief. And I learned this from my mentor. Or one of my mentors, right? My belief is that the markets are rarely efficient. And you know why? Because we have people who have gobs and gobs of money. So what that means is those people probably went down one of two paths. Either they had information that wasn't widely available to everyone else. I'm talking about you, Nancy Pelosi's husband. Or, right, you guys know the story about how the senators have outperformed all the hedge fund managers and stuff like that. Yeah. And Nancy Pelosi's husband's made this amazing track record. Actually, there's an app now where you can copy the trades of the senator.
Oh yeah,
I thought that was brilliant. That was the coolest thing I've ever seen. Coolest app I've seen since the one that tells you when to go and do a pee in the middle of a movie. That was a cool app too. But anyway, the idea is that if the markets were efficient, then you would always pay the right price, right? Mm-hmm. The price that you paid at that point would be the right price. There'd be you wouldn't get any value, you wouldn't get any discount, or nothing. It's just the right price, okay? If that were the case, it would be nobody would be able to accumulate big piles of money, but some people are. So either they have information that other people don't have, or they're crunching the available information in a certain way, which is what indicators do on our charts, right? They crunch the available information, high, low, close, open, not open, close, high, low, all that stuff, right? In a certain way, and they analyze it in a dispassionate, non-emotional way, so that they can buy when they should and sell when they should, right? Mm-hmm. And away from emotions, away from fear and greed, right? So that's basically it. I mean, that's the way I see it, is that the markets are not efficient. If they were efficient, we wouldn't see billionaires. That would be nearly impossible to come up with, right? Mm-hmm, mm-hmm. Because think about it, if you think about it in a broad sense, even people who come up with really cool inventions like Velcro or whatever, if the markets were efficient, there would be a lot of people, many, many people coming up with the idea of Velcro at the same time. Mm-hmm. You know what I mean? Mm-hmm. I'm not sure, but I think I heard that Velcro came from the U.S. Defense Department, whether it was the Air Force or something like that. So someone in there created it. That's what I heard. I don't know if that's true, but that's the idea. The idea is that if you have information that the broad market doesn't have, then there's an inefficiency there, and there's an ability for you to make money, right? Mm-hmm. So that's where stock tips come in, and people talk about that. Or if there's a way that you can take that information and quantitatively crunch it so that you get an edge, an advantage. And really that's what technical trading is in many ways, is when we look at patterns, when we look at MACDs, stochastics, moving averages, whatever, RSI, you're just taking the information, you're crunching it in a certain way and trying to come up with really good decisions based on, that information. So to me, the markets are not efficient. If they were efficient, I wouldn't be a trader. Trading wouldn't really exist as a career, because it'd be nearly impossible to do anything. You'd just always be getting fair value. Mm-hmm. And so the problem is people get in the way. The emotions get in the way. People get really fearful and they get really greedy. And so there's this gap, and there's gaps in information. For example, you may have been in a situation where like you sold something, right? And you couldn't believe that someone paid you as much as they did for that thing. Maybe it was something you were going to throw away, right? So for you, your perceived value of that was really low, but the person who bought it, like, like an old rusty bike that you're going to just throw away or whatever, or give away or something, leave it outside and hope someone takes it. That's what they do here in Australia. They just put it outside. They just put it outside their house and hope someone takes it, right? Like people do that, right? Yeah. So, but if it's really valuable to the other person, they overpay for it. So as in a specific sense, if you're a trader, you love those people, right? These are the beginner traders who overpay or underpay. They overpay for the euro, and then you go in and take the other side. So these are the people that you're taking their money from their accounts and you're transferring it into your account because they don't understand, right? Mm-hmm. So you need those, and those people need to learn those lessons. Either they need to learn to get out of trading or need to learn how to trade properly, right? So that's how I look at it, and I'd be curious to hear your thoughts on that, because this is a really, a lot of people have strong opinions about whether or not the markets are efficient or whether they're giving us, the prices are the real true prices or not.
Yeah. So 2 thoughts came to my mind. Number one, don't trust anything anybody says. And if somebody says something, look for evidence of the opposite. So like what you're saying is that look for evidence that traders make money in an inefficient market. And that's obviously true, because Wall Street would not exist if traders could not make money. So obviously that hypothesis is not true. The second thing is, when you look at markets on the surface, like you said, it should be logical, right? This is in your best interest, so let's do this. But people are emotional, and you have to factor that in. And if people, like you said, don't have certain information, or they're in a certain situation where they can't do a certain thing because of something underlying, for example, like houses, right? Like I used to buy and sell houses. So people always wonder, a buddy asked me, why would somebody sell the house to you for way less than what they bought it for? Well, maybe they need to move. Maybe they are having a tough divorce and they just need the money. Maybe they like you and they want to deal with you instead of somebody else, right? So there are all these factors that can come into play. And a lot of that is emotional baggage, emotional connections. So same thing with trading. Like people can get emotionally attached to a stock. People are dispassionate and they don't get emotionally attached. So that's why they do better. But, all these things can come into play. So I think that this idea that the market is totally efficient is, of course, ridiculous. And you should evaluate every single idea on those premises of, is there evidence to the opposite? And what are the other factors that are involved with this transaction?
Yeah, it's true. And I was just thinking about something when you're saying that. When I sold my car when I left my country to come to Australia, and I knew that the price I put it at was low enough that I would sell it in a day. Mm-hmm. You know what I mean? Yeah. Like I kind of used that. I knew that the market would pay more for the truck, but I sold the truck at that price because what I wanted to do was drive the truck as much as I could until the day I had to leave. So I literally wanted to sell the car the day I had to leave. Mm-hmm. And I did that. And so what happened was I put the ad in the paper or whatever, and all these people called me. Like I got all these calls because no one could believe that price, right? And so I had all these lined up. I said, okay, you can come at 12. All right, you come at 12:30. You come at 1. I had all these calls lined up because I knew someone. And then, what happened was a guy called me and I said, I've got all these things booked out, to see the car. Do you want to come at 5? You know what I mean? Like mm-hmm. The other 10 slots are booked out. And he goes, what time are you going to be there? I go at 12 at the park. He goes, I'll be there at 11:30. And then he bought the car. You know what I mean? Like he was the first one to see it and he bought it. And I said, look, I'm going to give, here's the pink slip or whatever, in a week, I'm going to, we'll make the transaction. Right. Mm-hmm. But you know what I mean? Like, it was like that. It was so funny. And then all these people called me and they were really upset at me. They're like yelling at me on my messages, saying, "Whoa, you're so rude. I can't believe you did this to me," and stuff like that. So, but that is a great example of, understanding the market and like using that to your advantage. So by, just like you were saying, like if your buddy's selling the house really cheaply and people are like, why would you do that? You're leaving money on the table. There's always reasons why, you know what I mean? Either you're stupid and you don't understand the market, or it could be like you just want to drop it really quickly. And we understand that intuitively when we're selling things like couches and stuff, right? Or cars and stuff. But when you think about trading the markets, it's the same thing. We just have to keep that in mind, I guess. You know what I mean? Like that's the same thing that's going on. And I love what you said about it, because if you're thinking about what other traders are doing on the opposite side of your trade, then you're in a really good spot as a trader, because there's two reasons. One is you understand that, you know, what you believe may not be right. Okay, you may be wrong, all right, for a number of reasons. And being early is the same as being wrong, right? And the other thing is you're questioning so you understand what other people are seeing and what they're thinking, and then you're questioning whether or not what you believe is correct. And so you're trying to coordinate your theory with evidence, right? And I feel like that's what trading always is. You're taking the theory, which is, oh, the price should go up, and then the evidence comes in, another candlestick prints, prints. And each of these are pieces of evidence that now you have to decide, can I assimilate that into my theory, or is it blowing my theory out of the water? What's going on here, right?
Or am I going to fight it to the end?
Yeah, exactly. Exactly. Which is such a beginner mistake, isn't it? We've all been there. Yeah. I'm going to fight it to the end. Yeah. I'm going to move my stop because it's not going to hit it, you know, that sort of thing. Yeah. It's so true.
All right, cool. Thanks, Walter.
Thank you.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice. I think starting with day trading just increases your chances of blowing your account out way faster.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Walter, I thought we could talk about personality types and which personality types should avoid short-term trading or day trading or scalping or whatever you want to call it. What do you think?
Okay, first of all, everybody. no, so I think we're all kind of, if you think about in a broad sense, we're all kind of built to not do well. Just trading the markets, full stop. I mean, you'd have to be a weird individual to be built, I think, to trade well, like out of the gate, right? And that's just because of our cognitive biases and the way that we operate in the world. But for your question, it's a very good question. I think it's impulse control. So if you look at, you can take a personality test. There's several of them out there, like the Big Five, or there's the Gardner's one where he has like different domains, like there's like interpersonal intelligence, athletic intelligence, like body. There's like mathematical and verbal, and there's all these different ways of looking at intelligence. But the one, if you can find a test that has impulsiveness, that's what I would go with. I know there's a lot of talk among the people. I think it's called the 16PF. It's either the it's not the 16PF. 16PF will have impulsiveness in it. So that's one you can take. And we can put a link in the show notes, but you can just search online for 16PF free personality test. And I think the Myers-Briggs is the one where it has like the four letters. Is that right? I believe that's the one. And there's some talk like INTJ is meant to be the best for traders. So there's a lot of talk about that, right? But your question is who should avoid it? And I would say, if you take like a 16PF or any personality test that has an impulsive scale on it, or even just an impulsiveness scale, that would be good too. You could find that as well. If you're high in impulsiveness, then you're really, you really need to fight against that, because day trading, our friend Adam actually talks about this, I think, at the London conference. Like he was talking about how
my argument has always been start with the higher time frames and then maybe lower, go down as you get more experience as a trader.
Mm-hmm.
And it happens in slow motion, right? That's one of the advantages of trading. Like right now, I've got like, I don't know, like 15 or 16 trades on the daily charts. Okay. And so it really does happen in slow motion. Like one day you'll be down 50 pips, the next day you're up 100, and you know what I mean? And like the targets are so far away, there's no telling what's going to happen. Like literally last night I went to sleep when it was before the New York Open, right? And I'm testing some stuff on 2 different accounts, and one account was basically break even, slightly down, and the other one was way up, right? But the trades hadn't cashed out because they're daily targets, right? And then I come back this morning, and the one that was way up was up still, but about half what it was when I went to bed.
Mm-hmm.
And then the one that was break even is now down. You know what I mean? It's like, and this is the kind of thing you go through with daily charts because it's always such a slow motion thing. Whereas when you're scalping, it happens really quick, and you get, like Adam says, the advantage of that is you get almost instant feedback, near instant feedback on your performance, right? On how well you did with that trade. The disadvantage of that is that you can go after like revenge trading, and you start thinking, oh, I've lost 2 trades now, I really got to go in hard on my 3rd trade, or and that's the impulsive mind, right? That's the kind of trader who would do poorly with near instant feedback on your trades. So that's what I would recommend. I would recommend finding out where you are on the impulsiveness scale, and if you're high on impulsiveness, I would either don't trade or really work on patience and putting yourself through certain hoops like back testing and a checklist on your trades, and probably even trading the higher time frames. That's my opinion. What do you think? What are your thoughts?
Yeah, I mean, in talking to traders and working with traders over the years, I mean, I think that's the best advice. You just start on the higher time frames, and I think actually a very, very small percentage of traders are actually built or could mold themselves into a short-term trader. I think that's a very small percentage of people. And I think a lot of people will do much better on the, like you said, daily or the 4-hour or even longer time frames. It's like if you're like an investor or whatever. And I think that day trading really does get to that part of us that flips the switch on like revenge trading and over trading and trying to get back at the market. And I think very few people are able to get that under control. So yeah, I would agree. Just start on the higher time frames, and then those concepts will filter down if you want to do day trading. But I think starting with day trading just increases your chances of blowing your account out way faster.
Yeah. And it's an interesting point that you said about investing being, like you're saying, even a higher time frame, like if you think of investing. And that's actually a really interesting way to look at it. Like if you look at investing is almost like really high time frame trading, right?
Mm-hmm.
In that sense, I think that's a really good way to look at it. I mean, in that sense, what you're saying is that I am not married to this position doing well immediately, right? So it's kind of like the same on the daily time frame, but maybe on the monthly or something or whatever, right? So if you're investing, and I actually that's a good way to look at it. Like I've been recently, with the way that the markets are right now, I feel like I'm missing an opportunity, if I don't start looking at depressed assets right now, like ones that I think are going to do well in 10 years or like a higher, like a longer term goal. And so, I'm it's kind of what I'm doing, isn't it? Like I'm looking at, and that's what you'd be doing as a long-term investor, is you'd be looking at this idea of, okay, what's really cheap now? What's sort of almost like too cheap? And is that going to last like 10 years out from now? Like 10 years from now, am I going to look back and go, wow, I really should have bought this, and you never really know for sure, because this kind of gets into fundamentals and stuff like that. And people can, everyone has an opinion when it comes to this sort of stuff. But I do think that what you're saying is true. Like if you think about, like if you're a daily chart trader, just stretch that out to like monthly or something. And that's kind of what investing is. Like, so for example, if I'm a daily chart trader, I want to give my trade, like say I take a trade today, and I want to give my trade at least 2 days before I can like reassess. So 2 more daily candles before I kind of reassess what's going on with with this trade, in this individual trade. And if you think about it, like as an investor, you
you might be looking at 2 months, right? You might be taking the trade this month, and then 2 months from now you can come back and reassess and go, okay, how am I doing here? That sort of thing. I think it's a really, and the other good thing about the longer term goals, which are inherent in investing, is there's less pressure. Think about trading the 1 minute chart. Let's like max pressure versus investing. It's such low pressure. I mean, that's why like these guys like Warren Buffett and Charlie Munger, they can do this for so long because, I mean, really all they're trying to do is identify where the market's obviously wrong, right? Like they're wrong about this asset, so we're going to buy it, and then the market will later figure it out, and then at that stage we'll have some profits, right? Like that's really all they're doing in a broad sense, I would say. I mean, it's oversimplification, but that's really kind of what they're doing. I know they look at balance sheets and all that stuff, but it's really interesting that you say that, because I think that's a really good way for traders to look at investing, is sort of like higher time frame trading. Yeah.
And that brings up a good point too, that some people are kind of just built to see the value on a certain time frame, right? Like, so I know this one guy is really good at scalping, but so he's really good at seeing that, okay, this is a good opportunity within the next 2 seconds or whatever. He takes it and then he's out. Whereas a person who has a longer term view would be able to see the value 10 years down the line. Oh, this company is going to do well 10 years down the line. And like I in the last downturn, I bought like Citibank, right, at $1, but I didn't have that long term time frame. So I sold it quickly and I made, whatever, 300%. But had I kept it, I don't know what it's at right now, but it split several times along the way. And I didn't have that long-term view of it. And if I had that long-term view, I would have made way more money. So I think that it really is all about, number one, like check what time frame makes sense to you and where you can see value. And number two, can you expand that scope and maybe go longer, go shorter? And a lot of people won't be good at all of it, but maybe you have 1 or 2 timeframes that are good for you. So I think it really is about the perspective and like how you see time.
Yeah, definitely. I agree. I mean, you like our friend Colin, his best trade ever was when he took a trade at the beginning of the summer and he forgot about it. And then he came back. I'll never forget that story when he told me that. He's like, yeah, I had a pretty good summer, he's a but because he wasn't trading, right? So he's like he wasn't really looking at the charts, and then he came back like in September. He's like, oh, I forgot about that trade, and it was like massive profit. It's so funny. And I heard about this guy, or I think I saw a video about this guy talking about how he bought Netflix at $5, right? And I think it's I don't know what it is, $500 an hour or something like that, $400, and then he said like a couple of weeks later he sold it at 4 to book his tax loss. So he wanted a loss so he could write off his taxes, and he never bought back in. So now it's like at $500, and he's like, well, got my tax loss, don't have any profit, So it's funny, but like it's just the patience is so useful, isn't it? I mean,
yeah,
and I mean that's what Buffett said, right? Warren Buffett said the markets are an instrument for removing money from the impatient and giving it to the patient, or something like that.
Yeah.
So I'm paraphrasing, but yeah, it's so true though. It is so true, and on every time frame. Like you can be patient as a 1 minute trader or 1 minute chart trader. You can be patient. You can have you have a target, you get out, but you hold on to a percentage, like a half of that position, and you trail it, and you see, that 5 pip profit on the first half of the position, and then you have another 25 pip profit on the remaining part. That's by being patient and not taking profits in 3 minutes, but having to wait 35 minutes for it to unfold and for your trailing exit to kick you out at 25 pips. That's the kind of thing that we're talking about here. It doesn't really, it applies to all different types of trading, whether it's investing or 1 minute trading or whatever. Yeah, but it's so true. Yeah.
Yeah, totally. All right, cool. Thanks, Walter.
Okay. See ya.
See ya. All information in this podcast is for educational and informational purposes only and is not trading or investment advice.
Chat with Traders is brought to you by Trade the Pool. Did you know that every now you also have
platform more information?
Fifield. Welcome back, everybody. Great to have you here for episode 200, which is a nice milestone to hit. So I'd like to say a quick thank you for your continued support of the show. It is very much appreciated. Now, as an extension of the previous episode, I present to you the second installment for the Best of Trading Psychology. This is, of course, a compilation of snippets on psychology and mindset taken from previous episodes of Chat with Traders. And I feel like this is a fairly important topic to highlight, given the psychological aspect can really make or break many traders. With any of the snippets, if you would like to hear the full episode, links will be in the show notes at chatwithtraders.com/200. Otherwise, go direct at chatwithtraders.com/the episode number, which I'll indicate full time since 2010. Lance could be described as a discretionary price action scalper. Although it pertains to psychology still, this clip is a bit unique in the sense that Lance speaks to how he adapts the mindset of other market participants and how that then drives his decision making, something he refers to as the meta game.
I'm not really a pattern trader, but more of a looking at the internal nature of price, the strength and weakness of how the price swings show on the chart, and also metagame aspects. Do you want me to get into that?
Yeah, go for it.
All right, how do we do this? The ultimate aim of my approach is to identify, if I want to simplify it, a short-term bias for market movement. Okay, so price, is it the next 2 or 3 price swings going to be bullish or are they going to be bearish? Okay, and then we're looking for a price movement against that bias. So I'm looking at people pushing the price against that bias. Now, as I'm looking at that pullback against bias to try and time my entry, I'm not looking from a pattern perspective. I'm looking from 2 alternate perspectives. The first is the nature of how price is moving. Is it pulling back? If we take an uptrend, for example, is the bearish pullback sort of occurring with bearish strength or is it weak? And I'm really looking to fade weakness. If it pulls back with strength, that's information I wasn't expecting. I'm standing aside and waiting. So I'm looking at the internal strength and weakness of the pullbacks, but I'm also looking at a metagame perspective. And this is the people perspective. I'm really trying to get in the mindset of the people who are trading that pullback. Who's getting trapped? Who's in a losing position? When are they feeling fear? When are they praying to the market gods that, come on, please, just once, give me a winning trade? I'm trying to feel that fear, and I use that to time my entry. Basically, I'm looking to identify the point where these people know they've got it absolutely wrong and then profit from their exit order flow by entering at or before that point of their failure. So while I'm a price action trader, it's a little different to most. I'm not looking at heads and shoulder patterns and triangles, etc., etc. It's really looking at the internal way that price is moving and the people aspect. The idea metagaming, for people not familiar with that term, it's really, to put it simply, it's just the game hidden behind the game. For me, most people are stuck in the game of price. Just they look at price moving and they're trying to identify when do we buy, when do we sell based on these chart patterns. And for me, I recognise that that's not actually the real game, because the price itself and the price movement comes from order flow, and that order flow comes from traders making trading decisions. So in trying to identify the cause of a price move, you really need to be getting down into sort of analysing what the traders are thinking who are making these price patterns occur. And so that's the metagame. That's where I operate in timing my trades.
Yeah, and I think that ties in very well with something I read on your site yesterday, actually. And you mentioned the aim of analysis is to identify where you know others will buy after you and identify where others will sell after you.
Yeah, absolutely correct. And that's the metagame approach. Actually, I think the article that comes from was the rock, paper, scissors one. Is that correct?
Quite possibly.
Yeah, the rock paper scissors is a good analogy for what a metagame is, and there's a Simpsons episode which I mentioned in that article where Bart and Lisa are they're disagreeing over something, and so Lisa says, "Well, Bart, there's only one way we can solve this, and that's rock paper scissors." And then they go to Lisa's thoughts process, and she's thinking, "Poor predictable Bart always chooses rock," and Bart is thinking, "Good old rock, rock never fails." So he throws rock, Lisa throws paper, Lisa wins. Lisa was playing the metagame. She's not playing the rules of rock paper scissors, which is basically that hey, it's all random. You've got a 30% chance of winning, 33% chance of losing, 33% chance of draw. She is actually playing the game of thinking, getting inside the thought processes of her opponent and using that to her advantage. And that's what I'm trying to do in the charts. When you break it down to first principles and go back to sort of what is price, how does price move, what causes price to move, and I think that was a critical part in my development when I actually stopped to look at cause and effect. I realised that it's all trader decisions, and it doesn't matter what technical patterns or indicators you use for entry. If you buy in the market and no one buys after you, they're not going to drive price further. So you lose. So really the game comes down to sort of identifying the places on the chart where people are going to buy that after you. You're getting in before them. Or if you're short, people are going to sell after you have already sold. And that is essential for driving price in your direction. It's essential for profit. And so I think if you're not looking at the market from that perspective, you're doing yourself a disservice.
Next, this snippet comes from the series My First Year Trading Full Time. It's episode 196, so a recent one, with Ryan Trost. Ryan's a junior equities trader at the NYC prop firm SMB Capital. You've hinted at psychology a couple times during our conversation here. And I know one of the things you've said in the past is that traders shouldn't underestimate the psychological aspect. How come?
Because I think that it's so easy to, get caught up in the idea that this is all systematic. It's all patterns. It's all, you buy these breakouts and you sell when you reach your target. You risk this amount per trade. You only take good setups at work. And none of that is really taking into account that you feel a certain way when you make or lose money. Anyone who denies that, I think, is fooling themselves. I feel a certain way when I have my best day ever. I feel a certain way when I have my worst day ever. And those emotions and psychological aspects that come into play aren't never going to go away. It's impossible to be robotic. Even the best traders at this firm, you read their reviews or you talk to them after a good day or a tough day. And it all comes down to, were they in the right frame of mind? Were they putting themselves in the mental state where they could perform at their best? Did they meditate? Are they taking regular breaks to, refresh themselves? Are they doing some type of best practice to take their temperature? That's a saying we have here at the firm. You take your temperature and at 15, 30-minute intervals on the day and say, okay, maybe I just took a loss really early. Why did I take that loss? Was I in this trade because, I was chasing the symbol, or I had a fear of missing out, or it was a boredom trade because there's not really anything else going on today. All of those things are not really a product of your system, but they're a product of your personality and the way that you think about the day. And I think that if you don't really focus on the fact that it's impossible to completely devoid yourself of emotion unless you're a strictly algorithmic trader, it becomes not about fighting your emotions, but learning to use them in a way that is productive and leveraging your own personality and your strengths. You don't have to avoid your demons. Tom is pretty active on Twitter and he'll always talk about how, there's certain things that make all of us tick. There's certain things that get us happy. There's certain things that get us excited, sad, frustrated, angry, overconfident. All of those things are going to play into the role of a performance-based job. And that's what this is. You can only be at your best if you put yourself in the right mental state. Dr. Steenbarger talks all the time about how there is an analogous relationship between us and professional athletes. Professional athletes, sure, you can focus on what are the plays that you need to run. lift, exercise, get your body in shape, have the talent, be at peak physical performance. But at the end of the day, there's a reason that field goal kickers miss the game-winning kick all the time. There's a reason that basketball players miss certain free throws that could be game winners. It comes down to, is the mental aspect of your game there? And trading is no different. You have to be able to put yourself into the mindset where you can perform at your best. And the longer you spend not thinking about that, the more likely it is that you can continue to make those same mistakes over and over again and not really understand what's actually making you do that.
Are there any tricks that have helped you as of late, or any practices you've been putting into place to help you with the psychological aspect that comes with trading?
Yeah, so I think the biggest thing that I do is, I'm not trading from 12 to 2. So during that time is when I reflect on the morning and prepare for the afternoon. So, did I do a bunch of nonsense in the morning that was I not involved in the right stocks, or was I involved in the right stocks and just executed improperly? Did something happen outside of work that has me, off my basis today? Do I need to really look at my entries and exits in the morning and figure out, what was going on? Am I tired? Do I have too much energy? Did I expect too much from the day? All of that for me is really done during that 2-hour block, where I can kind of refresh myself, go get some lunch, take a walk, prepare for the close, and really figure out where I'm at mentally. So that's one step of it. And the other 2 steps are, pre-market prep, relatively the same thing. I take my energy levels. I think about, am I tired? And how am I feeling? Did I get a good night's sleep? Did I eat well the day before? Taking physical journaling notes of all of that and keeping track of it. Doing the same thing on the close, reviewing every one of my trades. Again, taking my temperature at the end of the day. Am I happy with how the day went? Am I not happy with how the day went? Why? What can I put into practice the next day to change that? So it all really comes down to review. I do things outside of work as well. I exercise as much as I can. I try to go to the gym every day, keep myself in a good headspace. My girlfriend is always on me about eating better. I don't say I eat the best, but I do try. And, that's all plays into getting yourself in, peak performance state.
Now, I'll share a couple short segments from a popular episode I recorded back in 2015. It's episode 39 with currency trader Tom Dante. And here he speaks to some of his observations while trading in prop.
It was understanding how seriously these guys approach the market that I think was one of my biggest lessons. But like I say, it's hard for me to give you specific examples because I took so much from so many different angles. Another thing was composure under pressure. Watching guys have big down days and not seeing it rattle their confidence at all. Seeing them be able to walk up the office, head held high with a big smile on their face. And you knew for a fact that the guy was down a massive amount on the day. Like we're talking tens of thousands of pounds. And again, it kind of drilled into you that right mindset that you didn't have a pro trader get his ass handed to him on a day and then turn up the next day and go, I'm fucking scared. I'm scared to click the mouse. I don't know what to do. And it made you stronger, if that makes sense. It kind of made a man of you, I guess, if that's the right way of describing it.
You have a quote which I really like it. I think it's an awesome quote, and it goes, "If you're not working on your edge, someone else is." So now I'd love it if you could expand on this for everyone listening and speak to the competitiveness of trading.
Right. You should know that there are guys working so hard on their edge. And it's often the guys that are huge that are working the hardest, right? Which is why they're huge. You often hear people saying that they want to get into this game so they can make loads of money and they can retire and, sit on a beach sipping pina coladas and, placing a few trades from their laptop. the fact of the matter is that these guys I worked with that have made enough money if they wanted to live that kind of lifestyle do not. They are the first in the office every morning, and they are the last one to leave. And the reason that they've done so well is because of the amount of hours that they've put in. And they are the guys that are essentially taking your money. These are the people that have done the work that most people are not prepared to do. And at the end of the day, you're paying them, right? So I'll give you an example. When I was in prop, and I often tell this story, there was a couple of really big guys there. We're talking like a couple of $100,000 a week that they would be making. And they were huge. And one day, one of the guys had a stellar day. I don't know how much money he'd made, but we are talking a lot of money. And everybody was kind of, had heard about it, and there was a bit of a buzz. And he was just, he was just cool. He was just, staying, emotionally cool, but had a smile on his face and was chatting with some of the guys. And anyway, I left the office at about, 5:00, and I got the train home. I got right to my front door, and I realized that I'd left my key in the office to my front door. So I thought, well, I'm not going to call a locksmith. I'm going to have to go all the way back into central London to the office, get my key. So I get all the way back to the office. By the time I get there, right, it's about I reckon it's probably 9:30. Like, the market is closed at this time. It took me ages to get back, and the market is closed now. I come into the office, right, and all the lights in the office are out. There's just a little light on at the back of the office. And so I'm like, okay, somebody's here, but all the markets are closed. Lo and behold, there is one guy left in the office, and it is that guy that had that huge return, and he is sitting there recording his trades for the day, and he's writing down, what went well, what went badly, and making a plan for the next day. And that, to me, it was a real eye-opener, because, again, most people are thinking to themselves, if they want to make money in this game to live the easy life. And yet the reality of it is that most of these guys that have got all this money are working so hard. A lot of them don't have balance in their lives. That's just the way it is. So when I say somebody is, if you're not working on your edge, somebody else is, I mean that, these are the kind of hours that people are putting in. They're taking this game seriously. They know their statistics. They know their edge inside out and back to front. I mean, I personally spend a lot of time number crunching. So I crunch a lot of things to, when I see patterns in the market, I look at the probabilities of certain things happening. And sometimes I see guys call trades out, for example, on Twitter. And I think to myself, and I honestly don't want to come across in a kind of smug, know-it-all way, because trust me, I get it wrong, massively wrong from time to time. But sometimes I see people call these trades, and I think to myself, you know what? If you'd have done your homework, you would never be taking this trade, because there's no, there's very, very little probability that you are going to see that. See that make money. For example, I might see them, trading a pattern that I know has a very, very low strike rate. And again, it's not to say that I'm always right, but this is what I mean when I say that people have done this work, and a lot of the time, they're the guys that, the newer traders are making ill-informed decisions and ending up paying the bigger guys that have done the work and put that time and effort in.
The following clip is taken from episode 106 with Tony Duff. Tony's a former Wall Street hedge fund manager at the infamous Galleon Group, with one hell of a story containing plenty of excess, a cocktail of drugs, alcohol, sex, money, and power. This clip comes from the end of our interview as Tony reflects on his current situation, having now moved on from the fast life.
My life is very simple. I'm paying $1,300 a month for rent. I barely get by every month, but I managed to do it. And I'm just trying to stay sober. I'm trying to write, and I'm trying to be the best dad, friend, and son that I can be. And interestingly enough, I've never been happier.
You made a lot of money during your stint on Wall Street. I think you said you made about $10 million. Where is that today?
I wish I knew. So let's say I made $10 million, just for sakes. We'll say, I lost 3 of it just from 3 or 4 from taxes. I was the owner of a fast food or a casual dining concept called Fat Burger for the state of New Jersey. So I put $1 million in that. That ended up being a 0. I bought a house in 2007 at the height of the real estate bubble. I bought that for $2.1 million, put another $500,000 into it. I ended up selling that for $1.2 million. So I ended up, taking a bath on that. In my early 30s, I was living in a 2,700 square foot apartment, paying $9,300 a month in rent. I lived like that for a couple of years. So it was a combination of some bad investments, a house, an apartment that I bought, and living like an asshole for many years. And the money just went.
Yeah. Sure. And you say that you're pretty much never been happier than you are right now. Why do you say that? I mean, because I presume that when you were living in this New York apartment and living life big, you must have thought that was happiness at the time. Were you ever content with where you were?
No. So that's one of the things. I was never content. When I was at Morgan Stanley making $22,000 a year, I would say to my friends at the bar, if I could just make $50,000 a year, then all of my problems would be solved. And when I made $2 million, literally I said out of my own mouth, if I could just make $3 million a year, all of my problems would be solved. So that was never going to end. And so there was a moment back, after I'd left the business where, I'd kind of gotten my life back together and I still wasn't happy. And so I ended up going to the computer and I searched what the pursuit of happiness meant back in 1776 when they wrote the Declaration of Independence. And what I learned was that happiness used to mean courage and integrity and honor. And it was about how you lived your life. And I was like, when I read that, I was like, what? Because I always thought happiness was pleasure and material things and stuff like that. And so on that day, I was like, you know what? I don't even want to be happy. I was like, screw it. And I kind of just said, I just want to live a good life. Like I want to be a good person. And once I made that shift, so I went from a guy who wanted to live the good life to a guy who wants to live a good life. That's when it all clicked for me. And that's when I became happy.
Yeah. So I think a lot of people listening to this right now, and maybe even myself a little bit, we understand exactly what you're saying, but are you only able to say that and actually believe it because you have experienced it, because you've had that life experience?
Yeah. I used to say, I would say any asshole who says money can't buy happiness never had any money. Like that was my frame of mind, and I truly believed it. And so it's so cliche and you probably hear it all the time. So it's a difficult concept to grasp unless you get it, because and I'm not pointing the finger at anyone, but like no one wants to look in the mirror and say, hey, I could be doing more, or if only I had these things, my life would be so much easier. Because you know what? It's true. Money will make your life easier in a lot of respects. So it's hard to look beyond that.
Next up, a 10-minute segment from episode 30 with Tom Baso. Tom's a systematic trend follower of futures and currencies and a retired money manager. His firm TrendStat grew from a few guys running an investment club to a fund with 600 million AUM. And Tom was also profiled in Jack Schwager's series of the Market Wizards books. Note, just a little forewarning, as you'll soon hear, the sound quality from this segment isn't great. It's quite poor, though the content is quite good. And I think I could almost quote you saying from other interviews that psychology is probably the most important aspect of profitable trading. So why do you believe this to be the most important aspect?
All right, well, I would say good trading falls into three different things that have to happen. The first one, which everybody spends all their time on, is the buy-sell decision. You have to have a way to say, this is how I would buy or sell a market, a stock, or whatever it is that you're trading. Secondly, you'll have to answer the question of how much should I buy and what types of instruments should I buy. I call that whole area the sort of portfolio management, risk management, volatility management area. And you have to be successful at that too. The third area, and the most important one in my opinion, and the one that a lot of people spend the least amount of time thinking about, is your own psychology. Because you as the human being who ultimately, even in the case of fully automated TrendStat back in the day, I had the power as the owner of TrendStat to go in and pull the plug on the computer or override it or do whatever, because I owned the company 100%. So if my psychology wasn't in good shape and my knowledge of what we were doing comfortable with what we had created, then the first time I go through a drawdown, I'm going to start second guessing myself and all those computers. And I'm going to start telling my computer staff, oh, we need a whole new way of doing things. And let's go research this latest hot strategy that seems to have made 50% last year. And I could go buy black boxes or build black boxes. What's the difference? And keep switching and trading and fail time after time after time because my psychology wasn't right. So even though I was automated, you still have to have a good balanced mind about what you're doing. Trading, like for instance, a good example that I've heard Dr. Van Tharp talk about, good trading is following your strategy that day. It is not whether you made money or lost money that day. It's simply following your strategy. And that's a very profound thing. Hit me a long, long time ago when I heard him say that. I thought, yeah, that's perfect. That's exactly what I do every day. And that's why he and I worked together a few years at least. I helped him out with some seminars he was doing, and I found it fascinating to meet a lot of people around the world. And we had a good time doing them until my schedule got so busy it got unreasonable to do them anymore. But that was a very succinct and smart way of putting it. Good trading is following your strategy. It's not, good trading isn't making money and bad trading losing money. Good strategy development is what you need to do. Once you have that strategy, you need to follow it and to actually execute it. And the time to change your strategy isn't at the heat of the moment, halfway through the trading session when your particular position is going against you by 3%, and you're unsure whether you should pull the plug on it or not. You should have already figured that out, and it should be just blindly done. And when you're out of the position and the markets are closed, if you want to sit back and think about what just went on and try to come up with a better way, all good and fine. I'm not saying anybody shouldn't be constantly striving. I was sitting here, one of the reasons I called you a little bit late today was I got completely mesmerized by some stock research that I was doing. So I still am doing it here at 62 years old, retired. And I think you have to keep working and getting better, but you have to stick to whatever it is that you're coming up with unless you can figure out a better way. And I think a lot of people don't do that. I think they pull the plug on it, or they buy the black box and 6 months later they throw it out and they change everything they're doing, and they're adding so many layers of filters. I've had people at Facebook give me a message and ask me questions, and I'll say, well, tell me what you're doing, and I'll see if I can react to it. And I'll go into this involved explanation of all the different filtering this, and they only do it if the ADX is that, and on and on and on and on. I'm wondering how they ever get a trade to happen. They get so many filters in the thing that they're trying to achieve perfection. And it's so complicated, it's probably not workable, and they're likely to miss those 2 or 3 very large trades that are going to pay the way. And because they filtered those trades out somehow. So I encourage people to really understand their own mind. I think some people are a little more cut out for trading than others. I think that sometimes extremely cerebral, highly intellectual, they view themselves as smarter than everybody else. They're brilliant. They sometimes have a hard time with trading because they just know too much. And some of the best traders, if you look at some of the floor traders, the people that have come off the streets that really didn't know a whole lot about investing at all, certainly don't have the MBA or anything, but they're successful traders because they find something that works and they stick to it, and they don't let the markets beat them up because they don't really have that mental side of them that wants to analyze and theoretically understand everything out there. They just want to make some money and go home, and so that's what they do. And so it's something to think about. Everybody needs to study their own psychology and try to ask themselves, what could they be doing to balance themselves out more so that when they're doing actual trading functions that they can stay in the now, they can analyze where they want to be fairly unemotional about it, and react quickly. That's really what good trading is. And that's psychology. And the first 2, you can do all the work you want, but if you don't have the psychology, you'll never execute those first 2.
And when Jack Schwager interviewed you for the New Market Wizards, he actually dubbed you as Mr. Serenity because of your cool, calm, and collected style of trading. So, I mean, how were you able to actually achieve this and maintain this evenly keeled mindset, even through times of drawdown?
I've asked myself that question a number of times, and the only thing I can think of that seems to play in my mind about history and my life looking back is that I was so gall darn busy doing so many things that didn't involve sitting by a phone or in front of a quote machine. And I had so many varied interests that were outside the markets. I've run into people that in the middle of the night wake up and they want to see a quote machine down by their bed and to know what the euro's doing tonight, or weird. That's obsessive to me. I like, if I'm going to cook dinner tonight, I like helping other traders. I yesterday was pruning my front yard. I love to do sort of an Italian landscape scheme with everything's flowering. I hand prune all my bushes and trees and do it myself. And there's so many things for me to fill up my day that trading just becomes sort of one of the many, many things. And by doing that, it sort of removes the attention to my conscious brain of all the different pre-crisis is doing this, and oh my God, gold's up $10, and all these different things that go on that could capture your mind and all of a sudden pull you down some kind of a psychological hole. Because I was so busy, because I allowed the computers to do their things, because I spent time programming those computers to do what I wanted them to do, and I knew they were doing that, it sort of gave me that peace of mind to, wonder what I was going to cook for dinner that night, or something else, or concentrate on my golf game, or have fun vacationing someplace. I didn't have to be obsessed with every day, read the paper, read the quote machines, look at the charts, agonize over everything. That's where I think a lot of traders, including Jack, I believe, back in the day when he interviewed me, he was very caffeinated. He New York, fast, go-go personality, constantly, driving, and a lot of the market wizards that he interviewed, some of which aren't around anymore, were pretty fast, high-risk guys in the end, and some of them blew up and didn't make it over the long run. by comparison, I was pretty boring. But where I was unusual was the kind of the systematic, keep it simple, don't get stressed out over it. I think that appealed to Jack in a way because he sort of wanted to adapt some of that for himself. He was just the opposite, and I think that he found it appealing in a way. And that's probably how that chapter got written somehow. But it was a fun process. I enjoyed Jack, and he's a great guy.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I'll now play for you 2 parts I've pulled from my interview with James King. See episode 133. Having studied sports science and performance psychology, James was brought on as the performance director at a commodity trading firm in London. Here, James talks about building resilience and stretch goals, a method for expanding your comfort zone. So here we're talking a lot about resilience, and you're using some pretty, I guess, advanced methods of training for resilience or testing for resilience. For the trader who's at home, the trader who's listening to this, are there any methods or exercises they can try to help build their own resilience? Because, you know, you're kind of mentioning it here as though it's a key trait to have. It's can be very beneficial for traders to build up their levels of resilience. I mean, what would you suggest to someone at home might be a couple things they could try to help?
Right. Well, this is where I guess I'm going to be controversial. The thing I would suggest is that resilience is something that's in everyone already. It's there. If it's something you're struggling with consistently, then there's probably some more deeper sort of root cause problem you might want to look at. And it all comes back to that first point. Make sure you're chasing the right goals in the first place. Make sure you're using your strengths. Make sure you're doing something you genuinely, sincerely find meaningful. And make sure you're clear about, you know, what you're getting from doing that. Again, when you're in that sweet spot, you're instantly at the best, operating at the highest level of resilience you sort of have in you. So that's where I'd always start, because the goal's not, if you're not sufficiently motivated to pursue the goal, then you'll find any excuse to be unresilient, and you'll be constantly distracted, and you'll constantly want to perhaps do minimum effective dose everything and do the bare minimum. And if you find yourself doing that, then I would certainly, or the first thing is I'd remind you that that's not you. You are not resilient. But what is happening in those sorts of situations is that it's a clear indication to me that you're probably chasing the wrong goal, and it's not really got you firing on all cylinders with regard to motivation. The second part of that is that resilience is built by stepping out your comfort zone and making sure that you're sort of taking small steps, and it's a capacity that's expandable. So the other thing that could be happening is that if you are finding that resilience is perhaps an issue for you, then perhaps your steps are a bit too big. So what I'd encourage someone to do is, before we start talking about any resilience quick tools or hacks, these are sort of the foundation things. So the first one is, make sure you're chasing the right goal in the first place. And then secondly, check the step size. For instance, if you're sat on the couch for 3 months, you suddenly decide you want to go out and run a marathon, and then the next day you decide, right, every day I'm going to go out and run 5 miles. And then you find yourself that you're giving up, not doing it, or sort of you're quitting halfway through and making all the excuses under the sun. I mean, the point I'm sort of arguing is that you're probably trying to do too much too soon, and you need to build your capacity for that. And small, slow, steady steps are going to be better. And what happens is you set yourself small targets, you complete them, and then the unconscious message to yourself there is that I said I was going to do that, and I did it. And that reaffirms, and it becomes sort of a spiral of sort of uplifting sort of success there. And then that's where you build your identity around, I am resilient, I am confident, I am motivated. So make sure that your sort of step size is appropriate. I think we do live in a society where people watch an advert or are sold on something and then go from 0 to 100 very quick. And I think it's really important to really reflect, and before you pursue any goal, make sure you really are aligned with it. And then secondly, baby steps, and then those will very soon compound, and you'll find yourself going exponential. But general resilient tools as well. I mean, a lot of people are talking about meditation. Works for some people, doesn't work for others. I think it's about just experiment with stuff like that. I think you'd be silly not to try these things out, trying them on. Apps like Headspace are great, and I think that almost every trader I've met sort of has that app somewhere, pulls on it from time to time.
One of the things I've heard you speaking about in the past is a thing called stretch targets. Now, I'm not sure if this is something you've come up with or if it's something that's maybe a little bit more widely known, but it sounds kind of interesting. I'd like to hear a little bit more about it. I mean, what are stretch targets and how are they used amongst the traders you've worked with?
Stretch targets, if you can imagine 3 zones. The first one would be your comfort zone, and that's the zone in which you know what you're doing. Okay, you don't learn anything or adapt or improve anything in your comfort zone. It's maintenance at best, although probably some entropy sets in when you stay there too long. And then the next zone would be your stretch zone. Essentially, the stretch zone is an area where you're having to switch on in order to sort of successfully operate or to perform in that area. And that's what that does is it creates a gap between your current ability and the ability required in order to be successful in that moment. And it's that gap which causes your body, your brain or body, to make the changes physiologically and neurologically that will enable it to successfully complete that task. And then essentially what happens is your comfort zone expands, and what was initially stretch would become comfort. And that's the process of learning and growth. Beyond the stretch zone, you've got your panic zone, and that's when essentially you haven't got a clue and you're really shitting yourself, and it's just too much, and as you just absolutely body's full of cortisol, adrenaline, and because of that, it's just too overwhelming that no learning occurs. And so it's really important to get that sort of steps you take in order to improve are small, iterative, and then you can progress as your confidence and resilience to deal with sort of more stretch increases.
I think where I heard you speaking about these stretch targets was a video that you created for Mandara. I'm just trying to think over the example you gave in the video, which was kind of cool. You said...
Oh, I think I know. Okay, so this comes back to... I think I know what you're talking about now. So this comes back to... So earlier we were talking about, when you're this sort of pattern of thinking whereby, okay, I'm crystal clear on my current condition. I know what everything's like. everything looks like, then I've got my target condition over here, which is why I want things to look like. Now, where we talk about stretch targets there is that if we were to ask a guy at Mandara let's just, for example, say, okay, you made $1 million last year, we want you to make 1.2 this year. The problem with that is that the sort of solution that most people would jump to there is, okay, well, I'll just do a little bit more of what I'm doing now because I need to make a little bit more of what I'm doing now. Whereas if you sort of almost 10x that, you'd be like, okay, well, I want you to double that next year, and also I'm going to remove this resource from you. You're not allowed to do that. Also, I want you out the office by 4 every day because it's not sustainable the hours you work. That suddenly forces the individual to look at the problem in just a completely different way. And they've suddenly become a lot more creative, and their lateral thinking sort of goes through the roof.
What are some of the ways that you would encourage them to rethink things? I'm just trying to think, like, if someone at home or someone who's listening to this wants to try and put in place some kind of stretch goal, a stretch target for themselves, I mean, what might be a good way to think through that or actually try to apply this type of thing?
Starting off with a blank slate. So forget everything you're doing at the moment and just look, okay, this is the target. How do I do this? And then think about where you have leverage. Okay, so where can I leverage something in order to produce a new result? It could be, okay, so there's the classic ones, time and effort, which everyone sort of jumps to. The capacity, let's hire more people to do it. Then there's things like and there's other areas which are sort of out of the box. So there might be things like, okay, well, what if I designed a new tool? What if I leveraged technology? What if I shared a resource here? What if I partnered with this individual? What if I, even looked in a completely different area? What if I started trading more products? What if I started trading new time zones? What if I automated half the stuff I'm actually doing? Because that is sort of taking up 60-70% of my time. So it's asking those sorts of questions, looking at every area. What if I sourced expertise from an individual here or there? Or what if I go and speak to someone who's had this problem before? But they're the sort of general questions, and that's where the sort of human ingenuity comes in, and that's what we're good at, really, brainstorming, brainstorming solutions. But again, it really helps doing that if you're crystal clear on what your process actually looks like, and actually get down on paper how you spend your days and how you actually engineer the results.
This next snippet features Charlie Bathgate on episode 73. Trading has been a part of Charlie's life pretty much for as far back as he can remember, as his father was a professional trader. And today, Charlie's a partner at Sanglucci and a true fanatic on psychology and biohacking matters. I'd like to ask you, what is it about this aspect that really fascinates you, and what makes you think that it is such a big part of a trader's profitability and success?
I think that it's just the way that psychology has always been the way that when I look at the world, that's what explains how things work for me. It just kind of makes sense. I think everyone, to a certain degree from a natural predisposition, has some discipline that when they try to understand why things are happening the way they are, that explains it. For some people it's physics or economics or whatever. And for me, it's just psychology. It makes sense. And a lot of it comes from experience, both watching growing up with my dad, with, watching a lot of other traders and that we knew, that were kind of close to my family and whatnot. The guys that had a grip, a handle on their psychology, on their mental health, on their consistency, tended to trade better. They tended to not blow up. They tended to not make, poor decisions, impulsive decisions for the wrong reasons. They tended to execute their strategies with more discipline. And the guys who had other issues, a lot of times it really bled into their trading. Oftentimes some of the guys who were really, really smart, really talented, it didn't matter how much knowledge they had in their brain if the filter to execute it was broken. If they had a mood disorder and they were, emotionally all over the place, it doesn't really matter how smart you are or how good your understanding of the markets is. You don't have a shot at that. I kind of gravitate towards the mental health side of things sometimes, but oftentimes it's not that severe. It's just like, if you're sleep deprived, if you've slept for 2 hours a night for like the last 4 nights, like your ability to make decisions and to react quickly and to execute is diminished. And there's a lot of guys I've heard a million times from people who are like, oh no, actually I'm like, I can get by with like 2 hours of sleep. It doesn't really affect me. And I'm like, you're full of shit. Like, it's just not, like, you're a human being. I'm sorry. At the end of the day, like, it's going to add up. It's going to affect you. And maybe the adrenaline in the moment, could get you back up to where you would be for like, a 5 or 10 minute span, but like, you're going to come down. So I think just in part from personal experience, watching it happen, over and over, with people that I knew in my personal life. And then once we started doing everything that we're doing now, witnessing it, more on the professional side, and both in the traders that we've provided education to, and then also people that we've either worked with in the hedge fund or considered working with, in moments of honesty, and when people were saying, okay, really, this is the reason why I can't trade consistently or whatnot. It's often they just turn to the psychological side of things. They're just like, I can't get my head around XYZ, or I really can't focus because of blah, blah, blah. So, I don't have any beyond just a lot of personal experience and watching it in observation. I think it also comes down to me and my own obsession with it. I think I get kind of obsessed with like the compass effect, right? So if you have a compass, if you're standing in the middle of the woods and you have a compass and it's pointing directly north, and you start walking that direction, you're going to end up just walking directly north, right? If you move it 1 degree and you take 1 step, you're not going to be that far off from where you would have been had you stayed on true north. But if you do that for a mile, the distance, how far off you are is from where you would have been if you would have stayed going north, is pretty far, and if you sort of extrapolate, like, okay, if I had my sleep cycles down, if I did this, if I did that, if I, went through a list of things that I could do in each one of these things, maybe improved my performance, maybe improved, what I was capable of by 1% to 2%. Let's say I do 10 of those things a day. I give myself between 10 and 20% more, right? What compounding effect is that going to have over 20 to 40 year career? That's how I think about things. I don't think about it as much in terms of the day to day. It's much more like, okay, long term, like, what do I want to look back on and say, damn, I'm glad I did this because it gave me that much more, and it allowed me to achieve that much more. So I think in my own life, and really always trying to foster the resilience that is kind of required for, in an entrepreneurial setting, like, I've just learned I really have to be on my game in terms of, taking care of myself. Otherwise I'm not going to be able to make the best decisions on the fly. I'm not going to be able to have difficult conversations, with employees or partners or whatever. And you don't get to choose when those moments come up. That's the pain in the ass of it. Like, if you could just say, all right, all my difficult stuff, like the market is only going to throw shit at me on Mondays, that'd make things a lot easier, but it's just not the case. You kind of always have to be prepared. So, and then I think growing up with my dad and seeing, not only his, the fluctuations in his sort of temperament and his psychology, but also the other people in his life, I just saw firsthand, I experienced it on a really deep level, the degree to which the markets can whipsaw you around and can really come to dominate your life, and affect every area of your life, not just your professional life. If you, don't have the walls sort of built up around you, if you're not prepared if your psychology isn't really robust about it. So I just think both from an entrepreneurial side and then, looking at other traders and saying, I don't want anybody to have to kind of lose control of how they feel and what they're capable of on a day to day. And if you can build up a kind of a robust psychological, profile and kind of approach to things, then you're just giving yourself a much, much better opportunity to be in control of your life and I think to execute at a high level.
Coming up now, equities day trader Peter To, who was a fantastic guest featured on episode 98. I've included this clip in the mix because, yes, Peter is a talented trader, yet he's also quite forthcoming about his vulnerabilities when it comes to psychology and the influence it can have over his trading. Well, let's get into that a bit more. I think that's really interesting how you kind of embrace the fact that you aren't a cold-blooded assassin, as you described it, and that you do allow your emotion to affect your trading in some ways. And I was reading on your blog before we got on this call, and to anyone who hasn't seen your blog, I strongly encourage you to check it out. It's incredible.
Thank you.
You do a really awesome job of it. You spoke about a point at the end of 2015 where you took your longest break from trading. You kind of like lost confidence in what you were doing. Do you want to tell us a little bit about what happened?
It really wasn't anything crazy. Like in hindsight, it really wasn't anything crazy worth. Like I'm gonna say, like the Fannie Mae trade that I made, which is my most popular blog post, which is my biggest loss ever. That was a crazy thing that happened. You know, that's one of those where did that come from type of loss. What happened in November of 2015 when I took that break is, I think it was just a really gradual buildup where, you know, I would have these on-off periods where I would just get into trading, get burned out, get into trading. I would take like a 1 week break, and then a few months later, a 2 week break, and then a few months later, a 3 week break. And in November, my emotions were kind of like at highs and lows simultaneously. So it kind of exacerbated that effect because I had made my best trade in the first 2 weeks of November by shorting this biotech, AVXL. And then I gave back more than half of that money by just being an idiot, you know, and like just donking away money by God. And, you know, it just built up all this, like all these negative emotions that I just couldn't really deal with at that time. I would wake up and I'd feel all this dread about trading, and I'd be like, I'm sleeping in today. I don't want to have to deal with my mistakes from yesterday. And that's one of my one of my weaknesses. A lot of really good traders I admire. I'm like totally jealous of this. They just treat things like, oh, I lost a ton of money, but hey, next day is a new day, right? You know, I can tweet that, I can say that, but it will never actually be that sincere feeling that I feel inside. You know, I can carry a lot of baggage with me, and you know, I'm a bit of a front runner. That's why consistency is very important to me. Like being green almost all the time, because when things when the wheels fall off, like I get really, really hard on myself. I start to feel that self-doubt, you know, creeping in, and it just becomes impossible to trade. So I decided I have to take a break. I can't take this anymore. I hate trading. You know, it's a love-hate relationship. I hated it. So it wasn't anything crazy. It was just bad trading, you know, run-of-the-mill bad trading.
Right. And is taking breaks something that you like consciously decided that you were going to do, or is it just something that, you know, like you said, these mistakes kept kind of happening and you just didn't want to face them, and you just kind of got to a point where you couldn't be bothered, so you're like, I'm not trading this week? Or was it an actual something that was predetermined as like a good thing that you would have a week away from trading?
When a boxer gets like knocked out by a punch, did he decide to lay down in advance? That's how I want to put it. That's just the visual that came to my mind. Okay. You know, you just reach your limit and then you're done. Like, I mean, that's how it is for me. You know, I didn't calmly sit aside and say, okay, I'll just take a loose period and it'll be like, and then everything will be okay afterwards. It's just like, I'm just like, I can't do this, you know? And like, I don't know when I'm going to come back and trade. I really don't. Like, maybe I'll never trade. I started having these worries that I'll never trade again. And I think that's what makes me trade again. So I'm always kind of on that emotional edge. In fact, I'm on that edge right now. I actually did have my worst month this October. It's my only red month. So I'm actually kind of on that edge. Not to the same extent, because I've had a good year overall, but still. I'm actually dealing it right now as kind of as we speak.
So why do you think that October was your worst month? Is there anything you can pinpoint that to?
I started trading these OTC names again. You know, they used to be so lucrative for me. I haven't been trading them for what feels like 2 years because the order flow just died and people moved on. And then they started trading again, and they were they just became like, I mean, the way they traded, it was just so crazy. Like, the market makers take away all these routes, and you can only route through ARCA, and it's like, it's just so hard to get in and out of the stocks. Whereas like executing on the OTC used to be a strength. It just became a sudden liability. I would get into the size and I couldn't get out of it. And so if I thought I was risking X, I ended up realizing a loss of 3X. And that just kept happening, and that got to me emotionally, and I started revenge trading, and it just became like this terrible spiral. And so there are structural reasons why I lost the money. I feel like I kind of ran into a buzzsaw in some sense, but in another sense, there's some indeterminate percentage of my losses that I would attribute to myself. I took existing losses, and I probably made them a little worse.
Now, last of all, I'm tacking onto the end here another clip from episode 86 with mental game coach Jared Tendler. Jared was also included in part 1, but whereas in part 1, Jared spoke about various types of tilt, in this clip he speaks more so about emotion in decision making. And, we're starting to get into the emotional aspect of it. So, this is one of the things you're an expert in, is removing emotion from decision making. Talk to us a little bit about that. Like, why would you want to remove the emotion, and what's the benefits of doing so?
Well, I guess I should qualify it and say negative emotion, or actually, in a sense, excessive emotion. Because you can be excessively positive as well. Almost too happy, too overconfident, too excited can be problematic. And the reason is because it's going to impair your decision making. That is not just an opinion of mine. It's sort of a neurological reality, and this comes from some research on the brain, and also a pattern that's been was realized about 100 years ago in something called the performance stress curve. And so, putting those two concepts together, you have a process in the brain that many people think of as the fight or flight mechanism, but that really only kind of like oversimplifies what this reaction is doing. But the basic idea is that when your emotions rise too high, they actually have the power to shut down higher brain function. So people often think about their decision making, right? The thoughts that go on in their head. They think about that space in their mind in a way that is inaccurate. That when your emotions rise, it actually starts to eat away at the number of things that you can think about and the strength of those thoughts to turn into action. So if you've ever had a situation where, like, that you should not be exiting this trade, or you should not be forcing a mediocre trade, and yet your hand still moves over and clicks exit or enter. And you're wondering, like, how the heck that can happen? Well, it's happening because the emotional system has become overactive, and it's decreased the strength of your mind to take that thought and turn it into action. And so that is the main sort of reason why we want to remove the emotion, is to be able to retain sort of full conscious control, clarity of mind, and then obviously, precision in terms of execution. So this performance stress curve basically shows the relationship between, it kind of looks like an upside down U, right? If you kind of think in that bottom left-hand corner of this graph, in that scenario, you have very little emotion, and your performance is also very low. Right. So you could think about that as a scenario where you're super bored or you're just really tired, right? Your performance is going to be poor. Well, your performance is going to be equally poor on the other side, where your emotions are super high and your performance is also going to be really bad. There, you're very excited, right? You've made a ton of money and now you're going to keep trading, right? Or you're super angry, really fearful, or greed has taken over. so in that scenario, you're sort of equally as bad because the emotional system has done roughly the equal thing to your decision-making process. Now, as you kind of climb the hill, in a sense, to the peak in the middle, that's where your emotions are most balanced. And that's what we're after. That's the point where you're in the zone, where you're in that flow state or in peak performance. That is where there's almost no friction from you being able to access the technical expertise that you have acquired over the years, matching it with your senses of the market and being able to create those intuitive reactions where you kind of just know what's going on and you're able to make lightning fast decisions without any hesitation, right? As I said, without any friction. And so really what my job is about is, in essence, removing those points of friction. I kind of liken the mental game or what I'm doing in my job to like the oil in an engine, right? The engine is really what makes you profit. That's your skill. And if you don't have enough oil, right, too little or too much emotion, then the engine's either going to overheat or it's going to seize and obviously not perform well. But when you have things just kind of humming, that's where you're making the most money because your decision-making process is at its peak.
How do we get into a state where we're, as you called it, humming? Like, what are some of the exercises that you run through with the players and the traders that you work with to kind of help them keep their emotions balanced?
Yeah. So to be fair to like what I'm trying to accomplish with players, it's not a simple thing, but it's also not overly complex. And I say it's not a simple thing because part of what I've tried to do with my work has been not to take the sort of traditional sports psychology stuff and just kind of plug it into poker or trading or even golf. And the reason I say that is because a lot of sports psychology will say block out the emotion or try to use previous experiences where you've been humming or been in the zone as a sort of a reference point to try to recreate it today. And I don't think that works long term. It might work temporarily in the short term, but something that we might not be able to prove is more than a placebo, right? Like a sugar pill that isn't really producing anything of real effect. It's just a temporary, manipulation of the mind. And so really what I'm after is isolating all of the specific reasons why your emotions are either going to be too high or too low, right? And so we look at anger, for example, as a cause of too high, or a lack of focus or a lack of motivation as a cause of it dropping too low. And we actually try to systematically go in and understand why it is that you're getting angry in those spots, why it is that you're losing motivation or focus in other spots, and put in specific corrections for those things. And as a byproduct of making those corrections, you are automatically more emotionally balanced. It doesn't mean that you're going to be permanently emotionally balanced and humming, because there's a constant evolution that exists within your skill set, within your mental game. And so there's a constant need to be improving all aspects of your trading. But at a minimum, right, anybody that's listening right now, the first thing that you can do, and I think the most important thing to do, is to start to study your own emotional reactions that you have throughout the day, right? So often when I start working with new traders, or not new traders, but new clients, their knowledge about their skill set, or about their emotional skill set, is really poor, right? They'll come in saying, I'm losing a bunch of money here. I feel myself, kind of hesitating. I'm forcing trades here. I'm losing focus here. But when you actually start to break it apart, they don't really understand why. They don't know the specific situations in which it's occurring. They can't recognize the thoughts or the reactions that they're having in those spots. And I'm not saying that what they're coming to is not something I can work with, right? It's a start, right? So the easiest way you can start doing this is to start by identifying the specific trading errors that you have. Okay, the trading errors that you have may give you an indication that there's some emotional reaction, whether too high or too low, that's present. And when I say may, right, it's really important to know that sometimes a trading error is simply a tactical one, right? I'm not going to over prioritize the importance of the mental game, but here's where I can almost guarantee that a trading error is caused by a mental one. When you have continually made the same trading error year after year after year, and you keep trying to learn more about the markets or learn more about the stocks or the companies that you're following, you think that the solution to that trading error is more technical knowledge. then you know that it's mental, right? Then you know that there is some anger, some hesitation, some lack of discipline that is present in that spot. So basically, your C game, right? In poker, people, really just in sports, people think about their A game, right? But they don't often think about their C game, the worst aspects of their decision making. That's a really important thing for people to begin paying more attention about. What are the situations in which you suck, right? It's very easy to just say, oh, that was just, the market went crazy, yada, 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 I lost a bunch of money. Or to say, oh, that only happens once a month, not a big deal, right? But the problem is that by not fixing those mistakes, you are limiting your ability to continue to progress as a trader, not to mention the amount of money that's being lost there. So I know I haven't gotten into really specific nuances about how to actually fix this stuff, but hopefully this framework is at least helpful to get started.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Traders, investors, welcome. This is episode 201. I'd like to introduce you to my guest, Hayden Beamish. For the past 5 years now, Hayden's been a portfolio manager and director at Endeavour Asset Management, a hedge fund based in Melbourne, Australia, with AUM in the ballpark of $300 million. The hedge portfolio that Hayden manages ended the 2020 financial year up 28% after fees, in comparison to the Australian All Ordinaries benchmark, which ended the year down 7%. So the main objective of speaking with Hayden was mostly to gain insight to his institutional investment process. This includes talk of researching companies and prerequisites for investing, the role of analysts and brokers in providing information and flow, plus many details. And something Hayden speaks about in the later half, which I found particularly interesting, are the various types of execution algorithms he'll use for buying and selling large volumes of stock. So if you're an intraday trader and much of what you do relies on tape reading, while you may not be trying to get set in multi-million dollar positions, this part should also be of interest to you. Now, I know this is quite a long episode. I did actually consider breaking it up into 2 parts, but then I figured I'll jot some timestamps and topics in the show notes, and you can just listen to it in multiple parts if needed. Last of all, for the purpose of context, this interview was recorded early June 2020. And as per usual, none of the stocks mentioned are recommendations to buy or sell. You are entirely responsible for your own trading decisions. And that is all, folks. Here is Hayden Beamish for episode 201.
Because we're an investor in Kogan, and that's normally the first point of call. But
okay,
yeah, time didn't permit, but they've normally got everything.
Kogan's been on a nice run lately, hasn't it?
It's been on a tear, yeah.
You must be rubbing your hands over there.
Yeah, the valuation's definitely getting up there now. So we've been trimming since about $8, but yeah, I know David Schaefer, the CFO. Well, we speak to him a bit. That was one of the ones we bought in the coronavirus pullback. So it's just when the companies like this have such a run, it's unbelievable. Sometimes you think it's expensive and it can just keep going.
It's literally gone up in a straight line.
I don't think I've ever seen a V shape turn into the tick like that. It's just gone straight up.
Yeah. So when did you start getting into that?
So we were there at the IPO around $1.80, and then the IPO was a poor IPO. It sold off, and we actually sold our shares, and then they upgraded 4 times within 12 months. We started buying more, and rode it all the way to the top. It's actually one of the better ones we've traded. I've got plenty of stories that didn't go this well, but we did sell around the top when Ruslan started selling. So he was the CEO. This was at $10 back in 2018, and they were talking up these new verticals like the MBM vertical and doing these great road shows. And then he started selling shares. We thought it was good enough for him. It was good enough for us, and it was trading on about 40 times at that stage. And then late 2018, we bought back in again when it came down to 15 times, and this is when Kogan Mobile was doing really well, and it was all about the verticals, not so much the online brand that we all know. And we've held that core position really until the coronavirus pullback. Yeah, we started chipping away, and now they're just printing money. They've spent a lot on marketing, and they're acquiring these customers that would have never used the site before. And I think if you haven't gone to the website, you've got you think it's a pretty poor brand until you buy a few of their products, and they've got this marketplace where you can buy other brands now. And it's ran all the way back up to $11, and unfortunately we don't have enough of them.
Yeah, it's interesting because I actually don't know anyone who shops on Kogan, or none of my mates have ever told me they've bought something from Kogan, but I don't know. It seems to be doing all right. Well, the share price is anyway.
That is funny. So they've only got, so online retail is 9% of the total retail sales in Australia, and they've only got 2% of online retail. So it's a big market cap for what it is, but in the scheme of things, there's still a lot to go if they keep on delivering.
Wow. Okay.
That's my conflicted view.
Of course, I guess probably a starting point, just to kick things off, would be to talk about what you were doing prior to being a fund manager at Endeavour, which is obviously where you are now. So tell me a little bit about what you were doing leading up to this.
I grew up in Perth, Western Australia, which, for those who don't know, is the most isolated city in the world. And it's a city, it's a state actually, that's abundant in resources. And from a young age, I always liked maths, odds, and I've been fascinated by businesses. And we've had this market rally from 2010 really onwards, post GFC. That's been sort of tech and disruptors and high quality growth companies, but the cycle before, from 02 to say 06, which ended in euphoria, was it was very much commodities and property and the rise of China, and WA was abundant in resources, still is today. And to wrap some sort of context around it for the listeners, I'm sure many are aware, but so copper from 2002 to 2006 went up 600%. Iron ore went up 600%, oil 400, gold, even the risk off. If you were bearish and you went in gold, you made 300% in this period. And it felt like Perth was the center of the bull market. I'm sure it wasn't, but everyone was talking stocks and resource companies. And I remember my first investment. This isn't a unique story in Perth, but it was a friend who worked at a coal company, CDS, and that went from 40 cents to $4, and I put in $5,000, and went 50, and it was a lot of money for me, and I rode it all the way back to 40 cents in the GFC, and sort of heard of everyone making money, and there was a real willingness to take risk at that time, and it created a bit of an entrepreneurial spirit in Perth, which I think is still alive today, and Buffett certainly wouldn't have approved, because you were conditioned to invest, I think, outside of your circle of competence. And what I mean by that is not many people really have geology degrees. You don't know the specifics of a mine or the grade or the capex and the return on capital. But as opposed to this market rally we're in at the moment, like Apple, Zoom, Microsoft, at least you know the product, or you can understand the price and competitors. But sort of back in that 02 to 06 period, investors were conditioned to take risk, and a lot of that time the risk was rewarded, and wealth was made and destroyed, including my own family. Like my dad was a property developer. He made a lot and gave it pretty much all back in the GFC. And I think a lot of that experience growing up in Perth is just maybe more risk averse, and that's why part of the reason why I run a hedge portfolio today, which we can talk about later if you want. But I think there's a few aspects that attracted me to investing early on, and another is the qualitative side. There's a big human element in my investment process today. I like to get to know management of sort of these founder-led businesses we invest in, and I find the psychology of the market fascinating. You have to learn when to trust people, when not to, understand management's motives and brokers' motives, which are obviously conflicted a lot of the time, and you have to think about thematics and what's changing in the world, if it's technology or politics, ESG, health is a good recent example, and you have to assess whether all of this is in the price, and that is depending on the future outlook of the business and I guess the quality of the business. So it's a bit of that like qualitative side as well, which isn't black and white. And I think to outperform, you have to do all of that quicker than the rest of the market. So you're constantly tested, and it's the same as trading for 5 minutes or investing for 5 years, 50 years. It's the same that the scorecards there live every day for everyone to see. And if I put a stock up at the investment committee that I think we should invest in, and it goes down 20%, there's nowhere to hide. And so you're sort of constantly learning, which can be tough, but you're forced to improve, which is great for sort of personal development and makes you a better investor over time. Yeah, but in terms of my career progression and before Endeavour, I have a finance and economics degree, and between studying and sort of playing poker and barding and wakeboarding, I was trading futures, and it was sort of mostly unsuccessfully early on, but I was really drawn in by price action and chart patterns, and the supply and demand behind these patterns that kept on repeating over time, and just on like my uni, I had a lot of fun. But for the young people listening, focusing on the fun stuff definitely made my pathway a bit harder. So I wouldn't follow my lead there. You have to do the hard work eventually to get to where you want to. Otherwise, you eventually have to catch up and work harder later, or you might regret it, I guess. Yeah, during uni, I worked at Patterson's as a dealer's assistant. Was my first real job, and this was when the GFC hit. So the GFC sort of came in later in Australia because commodities held the market up. So I think you had the subprime crisis was kicking in around 06, 07, and Australia lagged the US by a few years, and that was about the time I was working as a dealer's assistant. And I hated that job. It was admin for brokers, and times were tough, and it was really good to see inside a broking firm. But the economy was in a tough time, and it was hard for the brokers. So it was a bit of a grim atmosphere in the office, and a job popped up in a insolvency firm called PPB Advisory, and that was just restructuring and turnaround management of these businesses that were most of the time had taken on too much debt. And I learned a lot about over leveraging and not to be fooled by the optics. Like, there were managing directors of these companies would come in, and they'd always be in the new leased, well, not always, but a lot of the time, like the new leased BMW or nice new car, and they were the first things to go. And there was a bit of a culture of overspending. It wasn't just the car; it was just that culture in these businesses that went under. And I think I really saw the fragility of success at PPB. And this was until, say, I was there until about 2013, 14. So we're sort of coming through the GFC by then. And I got a call from the head of research at Euros Securities. And Euros is a publicly listed in Australia stockbroking firm. And the offer was eventually got an offer to join the research division, which for me was a dream. It was to get paid to analyze stocks. So I was 25 at the time, and the job was to build financial models for analysts and join company meetings. And it was really inspiring, actually, to join Euros and just be surrounded by these people who are all really successful. And this is one of the bigger broking firms in WA, and they were the first point of call for a lot of companies to come public. So they were able to invest early on, and there were some great success stories in that firm. And it was sort of a year of building models for the research guys, where I was recruited internally to join their listed investment company, which is owned by Euros. It's called Westoz, and had about $250 million under management. And that was suddenly a whole new world again. Like, this was now on the buy side, managing clients' money and sort of working with some highly intelligent people. And the mandate was to invest in WA businesses only, which, while I was learning a lot and really enjoying it, but this was when resources were now in decline, and it felt like resources were last cycle, and I was frustrated we couldn't adapt to the market conditions, and we're sort of in the early stages of this bull market we're in still to this day. It was technology driven, really, and there were these great opportunities happening in East Coast Australia. And for those international listeners, the East Coast of Australia is pretty much like a real estate, construction, services orientated economy. But there was an analyst from the research desk at Euros who was a great investor, and he joined Endeavour and called me soon after and said, "Look, a job's popped up here. Would you like to come over and have an interview?" And Endeavour is where I've been for the last 5 years. I'm a director and portfolio manager here. Very, very happy. We've got 300 million roughly assets under management, and a good track record. And one of the things that really attracted me to Endeavour was that ability to invest anywhere, mainly the ASX, but now globally with my hedge portfolio I'm running. And I think I'd sort of pushed for this portfolio for a few years, because I think managing money really has to reflect your personality, and that's something you hear time and time again from. I've read The Market Wizards, and that was sort of repeated often. And whether you're investing for a long or short time frame, like personally, my flaw, I guess, in investing is I'm inclined to act quickly, so I can take profits really quickly, and I can also cut losses quickly, so it helps with the risk mitigation. But if I'm concerned about the macro, I'll be inclined to take profits. And so we've set up this hedge portfolio where I can protect clients' money and can hedge the portfolio quickly. You can, if you're worried for any reason, you can go from 100% long equities to 0% net exposure with the click of a mouse. So that portfolio has been running over 12 months now, and I'm the portfolio manager there, and it's doing pretty well. So clients are happy, which is great.
This hedge portfolio, is that the only fund which you manage, or do you manage multiple funds there?
Yeah, we have multiple. So I'm the manager of, we have a growth, balance, high conviction portfolio, and the high conviction's a smaller one. It's got about 50 mil under management, and that can go, that has no restrictions. It's anywhere on the ASX. And then we have growth, which is 85% top 200, and balance, which is 75% top 200. And so we have multiple, two portfolio managers and one CIO on those three portfolio managers. And then the hedge portfolio, I'm the sole PM of that portfolio.
Okay, so you are involved in all of these?
Yeah, that's right. Yeah.
Gotcha. Speak to me a little bit about the objective of the fund. I know you briefly touched on it there, but just if we could go into it a little further, what is the objective of, I mean, you can describe any one of these funds or all of them if you like, but obviously each hedge fund has different objectives. The funds come in all shapes and sizes. Some are just there to try and outperform the index by a couple %. Some are trying to produce smoother returns. Some are trying to produce uncorrelated returns. What is it that you are actually trying to do at Endeavour?
It's a good question. In our growth, balance, and high, or really for all the funds, we're just trying to maximize performance. The main three portfolios that have been around for sort of 10 years now, they're long only. They're benchmarked against the market. So people act how they're incentivized, and we're incentivized to beat the market. So that's what we're trying to do every day. So we will take into account, saying Australia has a high weighting in financials and our positioning versus the benchmark, and our job is to outperform. So for our clients, they have allocated to us just their Australian equities exposure. We won't tend to manage all of people's wealth. It's just we're doing our job there, and that's to beat the market. So if you think about, we've got a fairly high conviction portfolios between 30 stocks, and the hedge portfolio is 20 stocks, and there's a big overlap in the companies that we're investing in, and we're just trying to find high quality businesses that we can hold for 3 to 5 years. And we're very much people orientated investors, so we like to get close to management. We like to invest in founder led businesses where they're aligned to the same outcomes that we are, and we look for a few different attributes. We'll look for high return on invested capital. We'll look for high margins. Say we run a screen every day, a live screen that pulls in all consensus forward looking metrics. And I think, in this day and age with rates where they are, if you have a margin over 10, 15%, somebody's coming for you, and they're probably well funded as well. And I like to screen for high margin businesses that are increasing their margin over time. And the return on invested capital really is one of the main ones for us. And then we'll look at, do our own DCFs valuations and look at the multiples. And the end goal is really just to hold this portfolio of great businesses where we don't have to worry about the share prices every day. We're happy if the share price is going down, it might be a reason to buy more, because they're businesses that can weather whatever storm they're in, and they're preferably growing into large addressable markets. So a lot of our holdings are offshore, or they have operations offshore, mainly US, and they're not tied to the economic cycle.
Okay, so here we're getting into your investment process, and I'd really like to spend a bit of time on this and sort of get a little bit technical if possible, or as technical as you would like to be. Where do you begin? Like, how do you even begin to identify an opportunity? Like, where do you start? And if you like, I mean, you can even refer to a recent example if that helps.
There's plenty of examples that have gone right and wrong. Happy to talk about either, but I think it changes all the time because the market's changing all the time. But we're obviously watching the market. That's an easy one. But we have a screen, like I mentioned, and that we might have a screen where we've got certain metrics we look for, and I'll rank all the metrics. Say it's margin, forward EPS growth, insider ownership, return on invested capital, a few others, and can rank the whole market from say 1 to 3,000 in Australia, and that's updating live, and that's just a rank screen that's trying to put our process into numbers, which is really quite hard to do, and it's not an exact science, but that does turn up ideas, and the quant side is never enough to invest. Obviously, we'll look for these businesses that'll pop up on the screen, or say through contacts or clients. Actually, are a good source of information for us. We have about 150 sophisticated investors, and some of those are directors of companies that we've invested in that have liked how we've done things and then given us some of their money to manage, maybe when they're retiring. And I find it's always helpful to speak to people on the street, like whether it's friends or family, or just management of private companies. You always learn something. And so we find an idea, and it's come. There's also brokers and analysts, obviously, on the sell side as well, and it sort of ticks the boxes for us early on. Then the next step is to meet management. Is the main criteria. We need to meet management. We need some third-party verification. So we like to speak to whoever will pick up the phone, say customers, competitors, ex-staff members, whoever we can really in the industry, just to get a bit of external verification. And sort of like I was saying at the start, you never know what management's motives or brokers' motives are. There might be a capital raise coming, which is why they're promoting the stock, because they want to get a high market share so they can tell the company that they're the main broker on the stock, and then they'll get looked after on the capital raise, which is sort of where brokers are making their money now. The brokerage rate's declining. It's all about that market share and capital raises for companies. But once we've taken all that into account, we'll meet management. We like to go and visit the assets. So an example, actually, our office is in Melbourne, Australia, and one of the businesses around the corner from us was Polynovo, which is a Burns business. Aaron, I'm sure you're aware of this company, having watched the Australian market, but it's been a great performer. We saw one of the directors of a company we've owned for a long time, which is MVP, and MVP owned the Green Whistle. So if you've seen in say Bondi Rescue, which is an Australian TV show, or sports globally, when people get injured, a lot of the time they inhale a green whistle, it's called, and Penthrox is a drug, and it's just used for short-term pain relief. And we've been a long-term shareholder of MVP, and we saw one of the directors actually selling his shares in MVP and buying shares in Polynovo, which happened to be around the corner from our office. And we went and met the management of the company Polynovo, and they were telling us about this synthetic matrix that they'd developed with CSIRO, and it treated burns, and it was 50% cheaper than the incumbent Integra, which is, if you go into a hospital now and you have a 3rd-degree burn, it's actually treated with pig skin, and a lot of people react, unfortunately, to the pig skin, whereas this is a synthetic version, and it turns into lactic acid, and it's absorbed naturally by the body. It's got some great benefits. And he went out the back and he showed us the factory line, which was sort of two guys on this very small, sort of just looked like a printer, but it wasn't. But it was printing these sheets of mesh out that were selling for $10,000 at 90% margin, and we were sort of thinking this is amazing. It felt like it was in the price to a certain extent at that time. It was a 360 mil market cap business, and it was doing about $3 million of revenue. But this is probably another thing worth sort of talking about with our process, and I think maybe institutions generally is it's always forward looking. Like, we're not too concerned about what has happened to a share price, even though it had gone from, say, 10, 15 cents to 60 cents, that as long as we could see upside to this valuation, which we could in the end, because it had a addressable market of $1.2 billion. And we spoke to a surgeon in the US who had just started using this, and he was head of the burns in the US, and he was saying he's replacing all his patients 100% with Polynovo's product. And we're thinking if we can extrapolate this out to not 100% of the market, which will make it'll get you some crazy numbers, just say 20% market penetration, there'd still be some great upside in the share price. And we sort of we invested in the high conviction portfolio around 60 cents. And we found out half a year later, there was a Burns conference in Las Vegas, and my co-portfolio manager, Richard, actually went to this Burns conference. It was for industry participants, so he was pretending he wasn't an investor, and he was going around. He actually spoke to some of the Integra sales reps who were saying, the first thing we've seen in 20 years that's a threat is Polynovo, and one of them was thinking about going to Polynovo, and he just got these great comments from inside the industry that really helped with our conviction. And that share price is $2.70 now. It's a $1.7 billion market cap, and we've been saying for a long time it's expensive, but it just keeps on going up because now they're becoming successful in burns, and now they're talking about the next market, hernia, which is an even bigger market, and they've got a breast sling product, and they've got a beta cell diabetes solution, and it sort of continues. So we've been trimming, but we're still comfortable with the upside. So that's sort of what gets us maybe to the last step in the process, is that selling discipline, really, which is just all about the valuation, which we're watching and the updating as often as we can.
Okay.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
One of the things, I'm just going to pull apart what you said a little bit there with a few different questions. One of the things you highlighted right at the beginning of your answer, and you've also mentioned it, I think, earlier on as well, return on invested capital. Can you just explain why that particular metric is so important to you?
Yeah, because the return on invested capital, I think, is just a great shortcut for how well the company can compound over the years. So if the business is earning money and it's retaining that money, so it's making a product, say Polynovo, for example, they're making $8,000 per unit they sell, and if they are reinvesting that into the business as opposed to paying it out in a dividend, and they're reinvesting it and generating a higher return for the company, then that's how you get these great compounding businesses. Like, I mean, Amazon is is a great example that they have not generated a profit really from the retail division, and AWS is, but they've just poured all this capital back into the business and generated these huge returns for shareholders because management's showing that they have an ability to allocate that capital efficiently, and they're seeing opportunities within their business where they can generate some good outcomes for shareholders. And a lot of the time, that's why we want management that are aligned to the share price as opposed to taking a salary, because it's it might be a top 50 company in Australia, which Australia is a small market. It's easy to become mature quickly and grow with economic growth. So if you have these sort of entrepreneurial focused businesses that can generate some huge returns internally and you can hold them for the long term, that's where they can really compound returns for yourself as an investor.
This example you gave of Polynovo, they have some sort of product which helps burns. Now, I presume that prior to this, you didn't really know too much about burns. And I presume the same goes for a lot of the companies. Like, you're not an expert in the products or services that these companies are involved in. How do you get familiar with that? I mean, is it purely just from talking to management and doing your due diligence up front? Or, I mean, what are the shortcuts that you take to sort of get across an industry or a specific product or service?
Yeah, it's a good question, and I think it's part of what I find really exciting about the industry, because the burns is a great example, and we'll come across these investment ideas that are sort of great ideas on paper, but then you need to dig deeper into the industry and make sure that that you're not taking too much risk with your investment. And we're generalists, so we're looking at the whole market, and I think because of that, we're not resource or healthcare specialists, and we tend to lean on externals maybe more than most. So I think a good thing about being an institutional investor is you do have that access to information. So there's sell-side analysts are a great first step, obviously after speaking to management and understanding the business. But the sell-side analysts, they might only cover, say, between 10 and 15 stocks, and you have to pay a bit of commission per annum. It's about, I think the minimum cutoff would be between $100,000 and $150,000 a year in brokerage for the top tier firms, just to be able to sort of speak to these analysts. And if we come across a company and we want to get up to speed really quickly, that's what the analysts are great for, because they've might have covered the stock for years. They know it inside out, and you can ask and delve into the areas where you're lacking in knowledge. I don't find them so useful for market timing, but they're just great for that company knowledge and can introduce you to other contacts in the industry. There's some expert opinion groups that we use occasionally, but rarely. Primary Insight is one example. So say Polynovo, just sticking with that example, if we wanted to speak to a surgeon in the US, you can call these expert opinion groups, and they have a panel of people who are working in these industries themselves. They're not in financial markets, and they'll arrange a call with you, and you can just try and get another perspective, which again is really helpful. And then there's just personal sort of relationships and client relationships, and we just really try and speak to as many people as possible, and you can get up to speed very quickly. And sometimes there'll be a capital raise on for a company, and it's an industry you haven't looked at before, or it's a new business, and the capital raise might be closing on that day or the next day, and you can really speed through the process if you have to. And I think also a lot of the time, we do a fairly thorough process before investing, because we have a small number of stocks. We only have between 20 and 30 holdings, but there might be some funds with a larger amount of stocks. Say you have 60 stocks and you're only going to 2% in your fund, and you might start investing after a meeting, and and continue doing the work as you're building your weighting, and hopefully if your gut instinct was right in the early stage and you find something sort of deeper along the investment process you don't like, you can hopefully sell for not too much of a loss or hopefully a profit. But it's mainly sort of to answer your question, it's really comes down to the network and just speaking to as many people as possible and not being afraid to ask the stupid questions.
Right. Yeah, I guess that's a big one. Just before we move off this particular subject too much, for someone at home who might just be a retail investor, what are some quick numbers that they can run to get to do their own kind of valuation on a company and to determine whether that might be, worthwhile the risk in investing? Like, are there certain metrics? I know return on invested capital is one we've already highlighted, but are there certain kind of, metrics, hard and fast numbers, which you like to look for?
There are that we like to look for, and that is in the context of the type of businesses we're after. So I guess if you're a growth quality investor, you would look for, say, I like to screen for a company with return on equity above 15%, return on invested capital above 15%, a EBIT margin above 20%, EBIT margin that's growing, say at least 10% per annum. And these are all not black and white. They're not going to produce results that you can just invest in straight away, because all these forecasts do change over time as well. But I think they're just some great simple hurdles. The strong return on equity is a good one, and a high margin, and you could go deeper and do a simple valuation, because you have sell side analysts who have the time and cover a small amount of companies. They might have a 500 line valuation with it's a three-way valuation with the working capital and the cash flow statement, and we keep it very simple. We might just forecast the free cash flow, and I think this is a great exercise to do. And you can find some templates online for a discount cash flow template, and you can plug in some free cash flow and you can discount it back with today's discount rate, and it's always a good exercise to see what is the current share price assuming. So don't put in your assumptions for the earnings growth, because that's it is guessing at the end of the day, unless you have some real knowledge or an information edge. But if you can plug in numbers that equate to the current share price, and then you can decide if you think those numbers are too ambitious based on what you know about the company or not, then it's a great exercise to run through. It's probably not essential. It's just good to understand the valuations behind the businesses that you're investing in.
How much do you... I know you said earlier that you have like a 5-year horizon. I guess that's on average when you are looking at a company or you're investing in a company. Obviously, the stock becomes very volatile during earnings or on an earnings announcement. How do you react during that? Like, what if it's the earnings are, the market perceives it to be an underperformance? Like, what do you do in that situation?
Yeah, so the 3 to 5 years is the target, and obviously that doesn't always occur. And I think we do all this work, speak to all these people, do all the valuation work. We spend all day looking at it, and we still get it wrong. Often I would guess, say, a third of the time we're still getting these investments wrong, and it's all about sort of how much do you make from the winners and how much do you lose from the losers, and things pop up that you can't forecast. And say there's an announcement in Kogan before market, and actually Kogan has they funnily enough put out announcements. It seems to be quite close to the market open, so often 20-30 minutes before the market open they'll put out an announcement with some numbers that don't actually say what the underlying earnings are, but they put the drivers of the earnings in there, and you have to go back to previous halves to work out, because they'll give you the growth rate, so you have to work out the growth from previous divisions to figure out if they're on track for their numbers or not. And I guess if an announcement comes out, and a lot of the time, so if it's unexpected, a lot of the time the traders beat us to it. So a stock will match up or down, and it seems to be relatively efficient most of the time in the match price. So Kogan, for example, might bring out a new update as tracking ahead of guidance, and the stock will be matching up 20%. So if we wanted to buy, we'll do the numbers based on the new price, and if the price is up 20%, but we think there's upside, then we don't really mind how much it's up or down, and we'll be happy to participate on market, and by that I mean just buy on market at the market price, and that's normally we use like the volume weighted average price of VWAP to accumulate, and on the flip side, if there's an announcement that's unexpected, which does happen, then we will try and speak to management, try and understand if it's a one-off or whether it's a real change in the business that we need to be concerned about. And as these positions, when they go wrong, they become a smaller part of the portfolio. You can really see why stocks become oversold, because there might be a manager with 60 stocks, and stock's down to half a percent of the portfolio because it's been a losing investment. They bring out a negative update, and this manager might manage $1 billion, so it's a significant amount really for the stock, and they'll be happy just to exit it at any price, and that might be for a number of reasons.
That was an interesting point you brought up about announcements being dropped or released so close to the market open. For someone who's an intraday trader, prop trader, retail trader, they can normally react to those sort of announcements pretty quickly. For someone like you who's managing hundreds of millions of dollars, and of course you don't have hundreds of millions of dollars invested in a single company, but you have a large stake in these companies, how quickly can you react to that kind of announcement?
Does depend on the announcement and how much time is required to investigate the issue, if it is an issue. So sometimes you can just speak to management, you can get some clarification. Other times you might not trust what management is saying, so you need to speak to other people in the industry, or say it's a stock where you've leaned on an analyst on the sell side. They often take longer because they have to go through their compliance processes. They have to write a note. They can't selectively brief you before releasing a note, so you might have to wait a few days if you're leaning on that analyst, but that doesn't happen too often. I guess if it's most of the time, if it's a company we know well, then we can act quickly. Like, we've got nothing stopping us from buying immediately on market, but often you still have the share price already matching up or down by a certain percentage, and there's rarely an opportunity to buy or sell on the day at a better price than what you think it should be, if that makes sense. It's funny how quickly, and maybe it's hedge funds or the intraday traders in the market, but a share price, say that with a positive announcement, might already matching up 10%. So we go, okay, we've missed the opportunity. You always need to be in before the news to really experience that gain, and then we'll assess whether it's worth buying at that price or not. And that's why I think you often see companies, they'll match up during the day, and they might pull back a little bit as you have these short-term traders take profit, and then they might just steadily rise as you have an institution buying over the day.
Let's get into that. The execution part's something I'm quite interested in. Just to set the context for this, for these next few questions, in terms of notional value, what would be a large position for your fund to accumulate?
Would probably be around between $15 and $20 million at the top end.
Okay, and so there are companies currently in your portfolio where you have $15 to $20 million of holdings.
Yeah, there's a few of them.
Okay, so how do you execute an order like that?
So with those businesses will rarely go in with that size at the start. We'll buy them when they're small, and hopefully over time they grow into that size position. And that's our top holdings. That has been the case. Sort of, they've been companies we've held for many of the time. But say you're trading make a call on a big upside top 200 company where we'll exit one and buy another, and that, $300 million, which things is actually relatively small in the institutional world. So in the top, we can get the liquidity to trade for 5 million, another in for 5 million small caps, which is about half of our assets under management, where it just, so we will often accumulate time, and there's one at the moment we're just buying every day. We have been for 2 weeks because that's a company. And when we do that, look at the price every morning, and we'll set a limit price that we're happy to buy under, and we'll just set the hour limit price. And there's a few different ways you can set an algo. You can just do a limit price, and then you can cap your volume. So we're happy to buy stock and we're happy to participate in 100% of the volume. But the time we won't do that, we'll say volume a bit lower, might be for the volume, and that way we know that we're not impacting the price. So we're not creating, and then doing all of the volume afterwards, and you could have got it. There's some and we have that commission, and he was telling us that 90% and the Australian where there's also a sniper algo, it's called. So that's where you can set a price limit, and you can choose whether you want it to only take liquidity. So that algorithm will never actually show any size on the screen. Say we're buying dollar limit, it'll wait until an ask pops up at $1, and it'll just snipe that dollar without putting anything on the bid. And you can actually choose whether you want it to leave liquidity on the ask. Say you might say, I want to take everything at $1, or I just want to snipe at $1 and make sure there's a residual balance left over, so that seller doesn't get scared. There's also a stealth algo, so that's the same as a sniper, but it can show some liquidity, and that way you might earn the spread, say $1, and you show liquidity at 99 cents, and the seller might come down a few times, so you sort of earn that cent gap. And the stealth algo also tries for the dark pool. So in between the bid and the ask, there are the broker dark pools, and nothing's disclosed there, but sometimes there's a lot of volume sitting in that dark pool, and you can not often, but sometimes you can fill your order in that dark pool because there might be an institution selling that doesn't want to disclose their size either. They're a few of the main ones. You can do a chameleon algo, so that algo will change its algorithm based on certain triggers. So you could say, once we're at 50%, we want to move from VWAP to sniper because we're comfortable we've got a significant amount of the order on board. And then you can put in certain restrictions around that chameleon. So say once you move to the sniper, you want to cap the limit at say 100 basis points of the arrival price when the sniper's activated. So it'll only hover around that price when the algorithm's switched on. So they've all got sort of these, they've all got great great names, but it's all really comes down to the parameters within, and they're highly flexible. And we speak to the algorithm desk, and they just say a lot of the flow they're seeing now is coming away from the traditional institutional broking desk towards these electronic desks where it's algorithms, and you might have funds with more in-house traders themselves managing these orders, and then the traditional broker is actually more used as a facilitator to arrange meetings with companies and the sell-side analysts and arrange conferences and site visits and that type of thing.
Wow, that was awesome. I have questions about all of those. The first one you spoke about there, the limit volume algo. I can't remember the exact terminology you used, but pretty much you were saying that you might be like 10% of the volume at $1 if that's kind of where you want to buy it.
Yep.
How does that algo work? Let's say price is trading around $1, but then it starts to drift higher. What's your algo going to do then? Is it going to continue? Is it going to go from bid at $1 to now bid at $1.01 or $1.50, or how does that work?
So it'll only work within the limit you've given it. So in that case, the percentage of volume algo with a limit will only work under that limit. Say $1 example would say it drifts higher, then the main parameter is the price limit, and the percentage of volume only works within that price limit you set. But a lot of the time, the volume limit will be used with a VWAP order. So you're working over the day at whatever the price the market takes the share price to, but you might only cap the volume at 10% so that you're not altering that price and pushing it up and having to pay a higher price. But yeah, it's pretty black and white that the algorithm won't. There's no AI sort of side to it. It's if you set the parameter of the price limit, and it will not move outside of that price limit.
Okay. And the commission sharing arrangement, I know this wasn't an algorithm, it's just something I noted while you were talking there. Can you just describe how that works?
Yeah, sure. So we give all our orders to one broker. So the way brokers get paid, obviously, is commission, but they get paid for their services through commission. So they're paying for the analysts, they're arranging conferences, they're arranging overseas trips to visit these companies, and you pay them through giving them an order. And a lot of the time it's an order that they, in the stock that they would be the house broker on. So say, Kogan, the analyst, best analyst in the market, in my opinion, is at Canaccord. So we would give our Kogan order to Canaccord to sort of reward them for that effort they put in and for the help that they've given us. But what you're seeing more now is a commission sharing arrangement where one broker will put their hand up and say, we'll take all the orders. So they're almost like an in-house trader for you. And there's a trust factor there as well. And then out of that commission that you pay them, they would take a certain amount, say hypothetically a quarter of the commission, and 3/4 of it goes into a commission pool. So that commission pool is part of the commission sharing arrangement. And then if you use the services of another broker, because you're not paying them with an order afterwards for their services, you will pay them out of this commission sharing pool. And so our broker who gets all of our orders will send a check to whatever broker we ask him to at the end of the month. So it's just a way of, it doesn't change how anything works, but it's sort of, you can add a bit more science around it. So instead of us just giving orders based on who we feel should get the order on the day, we sit down at the end of the month and we look at where do we get value from in the market and who do we need to pay, and then our broker will send them that the money that we tell them to.
And these algos which you're running, are these algos which you've developed in-house, or are these algos which you kind of instruct the broker to run for you to fill your order in a particular way?
Yeah, so these are all provided by the broker. So most of the big brokers will have them. Say those ones I was telling you about were Macquarie and Morgan Stanley, Goldman Sachs, UBS. They all have similar algos. So it's different to your broker relationship. There'll be an electronic desk, and they'll come and integrate into your systems, whether it's Iris or Bloomberg, and then we can direct orders to the algo internally. So our trader will put the algo order on without having to speak to anyone, but the commission goes to the broker.
Gotcha. Okay. That's really interesting. I had a question around the VWAP algo. So what is that exactly doing? Obviously, I know what VWAP is, but when you're running a VWAP algo, like what's that trying to achieve? Obviously, let's say you're trying to buy a stock, you're trying to accumulate a stock, and you're trying to accumulate it with a VWAP algo. Like what's it doing? How does it determine where's a good price to buy?
Yeah, so it's just trying to match the VWAP for the day. So the VWAP's calculated live, but obviously at the end of the day is the VWAP for the day. So ideally, if you put a VWAP algo on, you should get that same price at the end of the day. You should get the VWAP price at the end of the day. So the share price deviates from the VWAP during the day. So if the VWAP's $1 and the share price has actually run ahead to $1.10, it would slow down the buying, and vice versa. If it's trading below the VWAP, it would speed it up automatically, and it would try and match that price. So it'll also save a bit of the volume for the match, where obviously on the ASX a lot of volume's done in the closing match, and that's going to be closer to the VWAP. So it'll manage its orders or manage the volume during the day based on how much is normally traded during the day versus the match as well, and generally it gets pretty close.
Okay. So the further price gets, let's say you're trying to buy a stock, you're trying to get long, the further the price gets away from VWAP, above VWAP, the less it's going to buy.
Yeah, that's right. That's if you're doing a VWAP algo, which is a passive instruction. So I generally am not a fan of mean reversion as a general strategy, because I always think if there's some mean reversion, someone knows something I don't know, and that's why it's reverting from the mean. And you sort of have brokers all the time say, we had a good example today that CSL, which is a healthcare company in Australia, is trading on the biggest gap between the All Ordinaries on a PE multiple that it has in 10 years. And that was a reason to put the trade on, and sort of my view as well, there's a reason that's happening, and I don't want to assume it's going to revert to the trend, because it always works until it doesn't, and you'll find out afterwards. So if there's a stock where someone's buying during the day and they're saying, I'm happy to own this at any price, then the share price might keep on going above the VWAP, and we won't, if we have a VWAP algo on, we might not receive the best price, because the algo will have to buy more later, because it's going to fill the volume, so it might have to be more aggressive towards the end of the day. So that was probably a bit of a confusing answer, but yeah, it will slow down if it's below the limit, or if you're buying and the price is above the VWAP, it will slow down and wait for that price to return.
Right. Out of all these algos you've described here, are there some which you kind of use every day, and some which are, only special occasions?
Yeah, it's definitely like VWAP is majority of the time, and then I think within the others, it really just comes down to how you implement it. So you'll have your implementation shortfall parameters where, say when you put an order on, if we're doing a basket, say we have a new investor come in and they're buying all the companies, and we're staggering that over a week, and we're sort of not finessing that as closely. We might do an implementation shortfall parameter, which will target the midpoint when you put that order on, and then you can say target the midpoint, but limit it, say 100 basis points away from the limit from the midpoint. So you've given some flexibility to the algo. So that's what sort of our trader at Endeavour does a lot of the time. But I'd say 90% of the time for the large top 200 orders, it's a VWAP. Occasionally because there's an opportunity in the market, and this happens a lot in results season when a company announcement will come out, and if it comes out intraday, so traders haven't had time to digest and funds haven't time to digest, so it hasn't gapped up or down straight away, and we might say this is a great opportunity now, we need to go at this price, and then we'll go hard and we'll put a limit on, and we're happy to buy as much volume as there is. But that's a rare scenario. Most of the time we're just happy to participate over the day and receive the market price.
Okay. Just one last question around these algos, and then we'll move on. But the last one you described, you called it a chameleon, and you said there were certain triggers that would cause it to do certain things. Can you give some examples of what that might be?
So the chameleon can adapt, it can join any of the algos based on different parameters. So you might say sniper until we have 50% of the volume. Oh, actually, let's reverse that. You might say VWAP until we have, say, 50% of our targeted volume. Then once it hits 50%, and this could be any, this could be 10% or 90% of our volume, or, this might be until a certain amount of minutes from the close, or it might be until the volatility of the stock is above a certain number, and there's a few metrics you can choose. And once it hits that parameter, then you can change to a different algo. So you might change from a VWAP until you've got 50% of the volume that you want to buy to a sniper, because then you've got at least half your order on board, and then from there you're happy to be more sort of opportunistic and take liquidity once it's there, as opposed to just buying over the day at the market price. So yeah, there's a few different parameters, and you can really make it do whatever you want it to do. Just as long as those parameters are defined.
All the orders you enter into the market, are they all done algorithmically, or is there ever an occasion where you sit there and click the mouse?
No, we don't click the mouse, but actually the minority of our orders are through the algo, and the majority are through our broker, and then we'll instruct our broker and he will use an algo on his side, and that's either a limit or a VWAP. I'd say that's 4/5 of the time it's quite vanilla, and we are not ever sitting there ourselves trading the stock, because it's very time consuming exercise, and we like to spend our time sort of on the research analytical side. So, and that's what the brokers are there for. They've got traders on the desk. They don't take lunch. They'll never leave, and they'll let you know if the price is deviating far away from the instruction you gave them.
Okay. Just on execution here, I think this ties in. Do you always trade the stock? So when you're investing in a company, are you only ever trading the stock, or do you sometimes invest in more sophisticated derivatives, maybe corporate bonds or options, etc.?
Yeah, it's just equities for us, and that's for the long-only portfolios. Now, the hedge portfolio, that's 100% long majority of the time, and then to offset the risk, to hedge off the risk, we'll do that through an ETF. So we could short a correlated ETF or buy an inversely correlated ETF. But again, yeah, all publicly traded equities.
Okay, so let's speak a bit about how you look at risk as a portfolio manager. I presume it's very different from how a retail trader or even an individual prop trader might look at risk, monitoring daily P&L and that sort of thing. Give me a bit of an overview for how you assess risk and monitor risk on a portfolio level, etc.
Yes, on the P&L, one thing I've found, and this is only from 2 institutional funds, but also from speaking to a lot of other portfolio managers in the industry, is that we never look at P&L. We look at every morning all during the day, we look at our portfolio of companies and we look at the weightings of the stocks in the portfolios, and we're only ever looking at the share price and the valuation of those companies and whether we think there's more upside. And then we also have a bench, say, of probably between 10 and 20 companies at any one time that are looking to make their way into the portfolio. So we're always assessing how does the upside of the companies we own compared to the upside of these potential new entrants. So just that always forward-looking nature, I find it really helps you to hold the big winners, because it doesn't matter if a company's gone up 10 times. If you think there's upside, you hold it. And that's because I think institutions, they're not going anywhere. You can't go anywhere because you can't go to cash quickly, and that's the major edge you have as a trader. But we're investing in this portfolio, and when we're too old to, someone will be doing it after I can't, and it's just growing this pool of capital. And I see it with like the retail, or mainly the CFD providers are great at it. That you see your profit, your P&L, and if the stock's trading down, you've got a big red bar in front of you, you've got that negative however many $1,000 in your face, and that just triggers emotions. Whereas looking at a stock, looking at a portfolio just based on your weightings, it doesn't trigger emotions. You're sort of thinking, well, at least I am thinking longer term. And the only concern is really if the valuation's stretched. So I think, and also I'm talking from my experiences, would be considered like a mutual fund as opposed to a hedge fund, where a hedge fund, like we have a hedged portfolio, but that's not a hedge fund. That's just a long equities portfolio that can hedge to offset risk. So we're mainly long equities majority of the time. And yeah, I think as a mutual fund, because you're long only stocks majority of the time, you're not looking to cash up, and we're not as sophisticated in our risk assessment because we're benchmarked against the market, and our job for our long only portfolios is to beat the market. So as long as we're not taking excessive risk within our weightings, like we're attracted to these high growth, high quality businesses, but we won't have a portfolio of 100% tech. We'll try and spread out a bit of risk, and if we've got significant weighting in these great businesses, but they have higher multiples, we'll try and get in some businesses that have lower multiples and maybe a lower growth outlook, but less volatility. So we're always sort of managing the risk just on sector and diversification. So we don't want to be invested all in the same industry. And yeah, it's very different to say the hedged portfolio, the one I've been running for a year, where I'm tracking the Satino ratio there. I'm tracking the beta. I want low downside deviation. I'm quick to hedge off risk with that portfolio with ETFs, and that portfolio has performed really well. The last 12 months, the market's down 10%, and that portfolio is up 30%, and a lot of that was being able to hedge quickly. Say in March when the market pulled off, the market was down 20%, and the hedging added 22% to the performance because it was short the market, and that really protected investors. But it's mainly our discretion and our feel. And there's a lot of the time the volatility of the portfolio is also not a true reflection of the risk, because we might have some smaller companies that are more volatile, but we actually know them very well, and we're comfortable with that volatility. So that's why some of the risk metrics sometimes aren't helpful as well.
You touched on emotions there at one point, kind of making the point that I guess an individual trader can be a lot more vulnerable to their own emotions. And, I don't think many will disagree with you there. But do you feel pressure in a different way, like pressure to perform and to impress? I don't know if impress is the right word, but meet the expectations of your investors? Like, do you have different kinds of emotions at play?
Oh, definitely. Yeah. And and having the portfolio, not looking at the P&L, like you still suffer from the same emotions. There's a great example is Afterpay, a company we invested in, met management at $8. We were a top 20 shareholder in Afterpay, and we were there until the company rose up to $28. We just sold in March, as before the market started to tumble, or as it started to tumble. So we sold at $28. The share price pulled back to $10. We felt smart temporarily. We had a call with management at $10. Oh, this was the day after actually it had come down to $9, and this was about the low. We spoke to management, and the day after the share price gapped up 20%. So it's up to $11, and we've gone, oh no, we can't pay up. We can't pay up 20% at the time. And this is when, you think about it now, and it would have been such an easy decision, but at the time there were so many unknowns about how the retail industry was going to play out, and we just couldn't get conviction over the valuation, and the share price never looked back. It just hit $50, 10 cents, taking a significant stake in the business, and that hurts. You can't hide from the emotion from that. It's we could have easily been there at $11, and we suffer. Everyone's human, suffering from the same emotions, and that's why the efficient market hypothesis, it's unequivocally not true. The market is driven by humans, and well, less so these days, but it's still a lot of humans running these quant funds and HFT firms, and but behavior, the human emotion and behavior does drive a lot of these share prices. So we suffer from that. You get the FOMO, you get the companies that you meet, and we'll meet with say 500 companies a year, and you look at the market at the moment, and everything you look at is going higher. So you're missing everything besides the 20 to 30 companies you own. So that's always there. You're always wondering if you could have done better. And then you have client expectations. So in the year before last, say our high conviction portfolio did really well. It was up 40% for the year. It was a great year. And then the year after that came back, and our rolling year came back to low single digits. I think it was down to 5% for the rolling 12 months at one point in time. So you have clients that and you have clients that have done well over the years, but they may have built lifestyles around the performance, and because we know our clients personally, it's great, changing people's lives and seeing the impacts if they can go on a holiday or buy a new car or whatever it is. But you feel the same on the flip side, where when it doesn't go well, you definitely feel it.
Yeah, you mentioned Afterpay there. That's funny.
Yeah, that one hurts.
Yeah, I think that's probably a sensitive topic for many. I perhaps should have asked you this question a little bit earlier. I don't know if it quite ties into risk as much as it maybe does to execution, but can you share a little bit of insight to the importance of receiving insight to flow from the brokers who you work with?
Yeah, that's definitely important in small caps. So if we're looking outside of the top 200 in Australia, especially, there's not a lot of liquidity in the market. I think Apple does more turnover every day than the whole Australian share market. So out in these mid caps, it is you're reliant on lines of stock. If you want to come onto the register, you often need a line of stock, and that's where you lean on the smaller stockbrokers, because they might have done the IPO or the capital raise, and they've helped put the register together. So it's helpful in a stock. So there's one at the moment that we're buying that's a property play in Australia, and we've been bid for $10 million worth of stock this week and last week twice from the same buyer. So they obviously can't find the stock. It only does $500,000 of turnover a day. So it's fair to say that the stock's going higher, especially because we know the fundamentals, and they've got some good short-term momentum. So that can give you some conviction, and I mean, it's not it's not foolproof, because say that investor, they're obviously a large investor and they're not big enough to buy on market, but maybe they bought a little bit and then they can't find a line for the rest of the stock, so they might sell what they own out. But you never know the specific circumstances, but it does give you a lot of insight. And you also, in a company, if you own a company, the brokers are looking for buyers and sellers all the time, because they want to get both sides of the transaction and double their commission. So you hear a lot about the sell lines that are out there and the buy lines that are out there. And if there are, in that property play, there's a buy line, and we sort of understand the reason why. But if there's a lot of selling coming through, it might be a catalyst to speak to management or chat to an analyst, and maybe there's something else happening that and that's a catalyst to investigate the stock further.
Sorry, I might not have caught that properly. Are you bid for this stock off market, and you're trying to find a seller to cross with?
So yeah, I probably didn't explain that as clearly as I could have. So it's really, brokers are just trying to look for the other side of the line. So if they have a buyer or a seller, they will send out their flow and they'll email it out saying, we're buying these 5 stocks and we're selling these 5 stocks, and this is the volume we're looking for. Do you have the other side? So then they can cross the stock. And that might be because it's a liquid, or it might be because they want to get double the commission, or it might be both. So you get a lot of those insights from the market, and you can find out in companies you own. Say you own a company and there's 3 people selling and they're looking to find a buyer, and they're coming to us saying, hey, can you buy any more? And we might say, no, we're comfortable with our waiting, we have enough. And people keep coming back saying, well, we've got a seller. Then it might be a catalyst to speak to management and just make sure there's nothing going on that is untoward.
Okay. Hayden, let me ask you one last question, and then we'll wrap things up here. I've kept you longer than I probably should have.
Oh, no problem.
I'm sure you want to run off and enjoy your evening. For someone who's been listening to this podcast and they really like the idea of becoming a fund manager, obviously it's not for everyone, but there will be some people who it might be something they aspire to. It might be like their dream job, let's say. What advice would you give to someone who wants to get on the right path to becoming a fund manager? How should they go about it?
I think a pathway that a lot of fund managers have followed in the past, and probably the easiest, I think, is to join a broking firm. So this is on the sell side, and ideally on the research desk, but maybe as an institutional broker. But the research desk is the best starting point, because you're learning the valuations and your job is to speak to the institutions. So you develop a relationship with institutions who are picking your brain about a stock that you've done some work on, and a lot of the time those institutions, if they're dependent on someone, they will poach them to come to the buy side, work in the fund, because they value their opinion and they might want that opinion to themselves. Or it's probably someone that they built a relationship with over the years that they trust and they would like to work with as well. So that's probably the most common, and especially at the smaller brokers. I'm not sure what the graduate programs are like these days, but it might just be calling up a broker and asking if there's any open positions. And I find like once you're in a firm, it's easier to move internally, or at least in my experience, that's what I've seen. So even if it's on the retail desk as a dealer's assistant, and a job pops up on the research desk, then you can put your case forward.
Yeah, a lot of it's about just getting your foot in the door, I guess.
I think so. Yeah, that's right. And that's what happened to me. I got a call from the head of research in Euros, and from Euros, and that was actually when I was in uni. I put my resume in I was looking for dealer's assistant jobs, and for some reason he held on to my resume for 3 years, and he called me 3 years later, and there's a lot of luck involved in life, and that was lucky.
Yeah, and here you are now.
That's right. And there's also, it's pretty easy to find out the funds and the institutions in Australia at least. And we don't ever get calls from people who are young aspiring investors and they've run a portfolio and they've outperformed and they can pitch a stock to you, and you never know, it might be worth trying.
Yeah. All right, Hayden, let's call it a wrap. If someone wants to follow you online, I guess Twitter is probably a good place to do that. Would you like to share your Twitter handle and any other place online where someone can go if they want to find out more?
Yeah, sure. I've been incognito online for years, but I've just started actually posting on Twitter. So my handle is at Hayden Beamish. So that's HaydenBeamish. And I'm putting a bit of content up there from sort of things I'm seeing during the day from brokers and some macro pieces as well. And then I'm also on LinkedIn, but yeah, probably Twitter's the main one.
Excellent. Well, Hayden, I want to give you a massive thanks for taking this time and speaking about a bunch of things which I guess we haven't really covered in previous episodes. So it's always nice to cover new ground. Yeah, really appreciate it, man. This has been a lot of fun.
Yeah, no problem, Aaron. Great to chat. It was a pleasure, and I hope it was helpful for some people.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, folks? Welcome to Chat with Traders podcast number 202. Featuring on this episode, I have with me Wayne Hemmelstein. Wayne is a clever, mathematical mind who views markets through a quantitative lens. He started trading on a proprietary trading desk in the mid-90s doing statistical arbitrage. Come 99, Wayne launched a fund and began managing money for clients and institutions. Then, in 2011, Wayne founded Logica Capital Advisors, where he currently takes the role of Chief Investment Officer. Logica is a 6-person team using various model-driven strategies which, for the most part, generate alpha from trading volatility. So that's essentially what this episode is all about. After some brief discussion about Wayne's early prop days, we then move on to talk about trading long volatility, modeling methods, and Wayne imparts some wisdom from his 25 years in markets. Just an FYI, this interview was recorded 9th of June 2020. And if you do like this episode, Wayne's also done a really good interview with Real Vision TV that you might want to check out. I'll pop a link in the show notes. Anyway, let's get to it now. Here is Wayne Hemmelstein for episode 202. One of the places I'd like to begin with, and we won't spend too much time on this, but it might just be good for a little bit of context. You began trading mid-90s, I believe. Where did you start out, and who were you trading for?
Sure, yeah. So the firm, you're right, it was mid-90s, specifically 1995, so can't get more mid than the middle. The firm was called Carlin Financial, and I say was because they actually acquired around the year 2000, they were acquired by Royal Bank of Canada, so it became RBC's prop desk. But Carlin it was a really cool firm, and some history to that is, of course, I'm sure you've heard of Millennium Capital. So Millennium was started by two individuals, Izzy Englander, who's of course now famous for his involvement with Millennium, and built it up. And then his partner, when it was first started, was a gentleman named Ron Shear. So they had started together, and I guess over the first few years, returns weren't so hot, or it wasn't working out as hoped. And so Ron and Izzy had some disagreement about the future and split up, and Ron said, I'm out of here. And he left to start a proprietary trading firm of his own, which was Carlin Financial. And so it was Izzy's ex-partner. And of course, the funny future story is that Millennium and Izzy went on to become one of the biggest, best hedge funds in the world. And Carlin, of course, was a good prop trading shop, but certainly not the magnitude of growth of Millennium. So, but that was its history. And Ron was an amazing trader, and I think what was most beautiful about the environment was the diversity of trading styles on the floor. And so I was at their Midtown Manhattan office. I think they had about, let's say, 50 or so offices around the country. It was a decent sized prop firm. I think one of the larger ones at the time. But the Mid Manhattan office had some of the better, I guess, traders who had been at generally bigger shops before that, and now had come to trade a mix of either their own capital, the firm's capital, a bunch of smaller hedge funds. But the nice part was that everyone, for the most part, had really good experience at some meaningful place. And I remembered, of course, so well, the guy who sat immediately to my left had been on the floor of it was either the SIBO or I forget exactly what, but he had been on a trading floor for, he told me, 13, 14 years. And so, everything that would come out of his mouth would be how you'd see the order flow on the floor. And so that's like on my left ear. And then my right ear was a Lehman Brothers fixed income arbitrager, and hit 9 years at Lehman. And so he had just a completely different view of the world, and one's on my right, one's on my left. And so and this went on as you went on to the different desks, or around the floor, I should say. There were that much diversity in views and approaches, and so that was just a beautiful experience to come out of college. I came out of UC Berkeley, I had a great education, but then to be immersed in this world of just knowledgeable traders doing so many different things, and all very interesting. And me, just like I was just so immersed and absorbed in how much I could learn and grow in that environment, and I did.
Being surrounded by such a diverse mix of traders, how were you trading in those early days? Like, what type of strategies did you gravitate towards?
Yeah, that's a great question. So it's, of course, we always gravitate right to what is more naturally us, I guess, generally would be the path. And so for me, I had a really strong math background. I was always a quant at nature. And when I say at nature, when you're like, I just looked at the world numerically or geometrically. When I as a little kid, I'd note things that were symmetric and things like that. So it was who I was. It was in my blood, so to speak. And so for me, the natural inclination was anyone doing anything really quantitative. And so the discretionary traders who had ideas they talk about in companies, I was less interested in that, but I'd go sit down next to people who are running big spreadsheets markets and doing some other forms of programming and try to understand what they were doing and how they're viewing it. And the easy answer, high level, was quant. And then the more granular, the more mathematical it was, the more it intrigued me. And I remember one of the early models that got my attention was a quant model in StatArb, and that was the first strategy that I fell in love with. Was statistically looking at a statistical view of the market to understand what was kind of normal or abnormal. I guess people would call it anomalous behavior versus the normal, and using statistical methods to derive that or to extract that. So that fascinated me, and of course, therefore, I went down that road.
What sort of products or assets were you trading the arbitrage between?
So at the time, my initial entry was through equities, and I was just trading just as simple as you call it, stocks, right? And I think that's certainly the right place to start. It was a good place for me to start, just to get familiarity with markets. I was happy that I learned both the long and the short side early on. A lot of traders start out more long biased or tilted, and I think for me, the idea of being around a lot of arbitrageurs who would take on trades, of course, that were both long and short, especially in StatArb. There's always a pair. I mean, in fact, they called it pairs trading as a nickname. So with that initial take on the market, I didn't have this early on get brought up, so to speak, with a directional view that the market had to go up. And so I was equally looking for long or short trades in equities. And then over the course of time, I started to get intrigued by options. And of course, once again, the mathematical nature of optionality and the mathematical modeling behind converting an underlying an equity into an option was all just, of course, Black-Scholes is the standard model, but the math behind that and how something could be a derivative of something else just pulled me right in. And so I got into options trading. And between the two, between equity and options, that's where my career has gone from there on with those two instruments.
Okay. Did you still go through the same stage of trial and error like many new traders do? I mean, I guess it was a great advantage that you were in this particular environment where you were surrounded by so many more advanced traders, but did you pick it up pretty easily?
So yeah, to your first question, did I go through trial and error? I cannot say without any or I'll say with absolute certainty is yes, I did and have continued to. I think trial and error is the crux of everything, and I think all we do is, as we age and get wiser in the markets and learn more, it's going through those trials and quicker and finding the errors better. But trial and error will never stop. That's the bane of markets always changing on you. But so that was to answer that question. Yes, I went through trial and error, and yes, I had a leg up in the sense of the wisdom that was around me. Sorry, I forgot. What was the second part of your question?
Did you pick it up? Did you pick
I
up
pick
trading?
it up quickly? Yeah. So I did because I guess I'm a smart guy, so that helped. But particularly on the quant side, the stuff was really intuitive to me. I was call it a fish in water, and so I loved it. I picked it up quickly, and the more I picked it up, the more I wanted it. I think there's this common among people who get good at stuff is having a passion for it, because that drives you to want to put in the time. And so for me, I was right away passionate, and I remember half the trading floor, if not more than half, the majority of people would leave after the close. By 5 p.m. Eastern, everyone's gone, and I stayed, and I was out there using all the computers and the systems. I'd stay till late in the evening. I was like one of the only people there when it got dark. Just because I was so immersed in wanting to understand and wanting to know. And yes, it was easy for me, and yes, I was passionate. So put those two things together, and you get better at stuff.
Yeah, it's like when you're good at something, you kind of want to see how far you can take it.
Exactly, and it's enjoyable. I remember at the time, people telling me you work too hard. They still tell me today, and I'm like, yeah, but I don't feel like I'm working. I'm having the time of my life doing this stuff. So I'm not really. I don't know what they mean when they say that.
Right. So let's jump forward many years. I know we're missing a lot out here, but fast forward to, I think it was around 2011 when you formed Logica. Can you just briefly describe what is Logica today?
Yeah, Logica today is, I'll say, the culmination of all my trial and error over 15, 20 years. But the thesis was primarily to use, I'll call, mean expansion investing or long volatility investing. And it's the way I understood markets from an early standpoint is go back to the statistical arbitrage and all the different arbs that people do, is that there's a lot of reversion trading going on. And whether it's value investing, which is buying a position that people expect to revert back to the upside, of course, and then or arbitrage trading where there's a pair that's on, and something that is out of whack should come back together, quote. So all of this was one side of the big market that a lot of people were doing, and I early on took this approach of the other side of that, which I call mean expansion. So that world fits into, for example, momentum or trend following. It's where you expect things to continue. It's the exact opposite of a reversionary trade. So all my education into investing in, I don't want to call it momentum because that really dilutes it's such a broad category, but things like stocks that would break out to the top side, or the convexity of options, that the ways to participate in through option structures. These versions of long volatility or mean expansionary investing all came together for me in my mind, and with starting Logica, to say, as I want to come up with a better mousetrap for that type of investing. And one of the problems with long vol or trend following and all the things that fit into the mean expansion category is that they tend to have a low hit rate, meaning they can do well for a period of time, but you need to wait for that swing. It's like you have to be patient, and then a big swing comes, but you could wait a long time, and people will know that in options world you can lose money month after month, and then eventually you have this big payoff. It's like the lottery, right? And of course, you get paid a bundle when you get paid because you have such an asymmetric payoff structure. But it can cost you either in actually losing money or just in not making any money and being flat in the period of waiting. And so I understood this, and I love long volatility mean expansion investing. That's where all my career had been. But I understood its flaw or its void, which is having to wait or lose till you get that big payoff. So Logica was set up to say, how can I fix that hole? How can I be a long vol investor, but make money along the way, like they do in mean reversion, like they do in arbitrage? And that's what's so widely loved about the whole other side of the world, the mean reversion side, is, and all this arbitrage, is that it's consistent. People pump out 50, 100 bips a month like clockwork, right? Because that allows for it in that type of investing. But then to their void, they have this once in a while big drawdown, and so it's got what's called negative skew. It has a lot of little ups and once in a while a big down. I like the idea of either flat and once in a while a big up, or being up a little bit and then once in a while an even bigger up, right? And so that became the core ideas. How do you achieve that? How do you take something that does have those big ups, but layer on it an ability to make money along the way? And that became, of course, many years of research and work.
Okay. Well, I'd love to drill down into this further and spend a bit of time here talking about trading long vol.
Sure.
So just in very simple terms, what does it mean to trade long volatility? Like, what is the objective here?
So going back to, I guess, what I just said in that last paragraph, or however long I was talking, was that volatility is mean expansion. So something is going to take off in a direction. And so I guess that's one side of it. I'll answer it in two different ways. So it's that pop or expansion that you want to take advantage of. That's one version of long volatility. Is you want to be long a big change. If you want to take the word volatility is just, of course, uncertainty. So that's another way to think about it. But it's change, right? Low vol is less change, and high vol is more changing. So to be long change is to say, I expect a bigger change to occur. It's that simple. So if you expect a big change to occur, buying a lottery ticket is betting on a big change. You have $1 and you're going to make 100 million, right, on this one exchange or on this one transaction. That's a long vol payoff. That's one way of thinking about it. Also, being long vol is saying, I believe more that there's going to be more drastic change in the future than there has been in the past. So you in a way bet against stability. You bet against an environment that is just status quo and say, well, something drastic is on the horizon. And there's a big difference. People often associate long vol with being more focused on market downside, but for me, it's not. You can be long vol to the top side too, meaning the easiest version of that actually just happened the last month and a half, where we came off the March bottoms to now being basically at flat on the year on the S&P with the V recovery. That vol itself crushed, but you could be long that expansion in the market if you had have bought the bottom on March 22nd or whatever that date was, that was the absolute bottom, and held that through today. To me, that's a mean expansion position in the market. You rode that whole thing up, and so it's a little bit of a conundrum, because volatility itself, that the way it's measured in the market, did come down over this period, but that would be that payoff structure in let's say, had you bought a long call in the market, would be a long vol payoff, because there's an extension to an extreme of the distribution. So people talk about it in different ways, and I guess more of the world is focused on volatility being to the downside, but I see it on both sides, and so we're trying to take advantage of both sides of volatility.
Okay, so just to save any confusion, the way you positioned, you are market agnostic, like you have no bias on direction.
Correct.
Okay.
To me, it's dangerous to have that bias, but yes.
Right. So can you give an example for like a long vol model? Like, how would you express a long volatility trade idea?
Well, I mean, long volatility is the simplest way to think about it is through an option, right? If you're long vol and you want to take advantage of the market going up, you buy a call. That's as simple as it gets, because by owning a long call, you are long volatility. You're in a volatility instrument, i.e., a call option, but you're betting on the market's upside. You're betting that the upside will be much more extreme than other people think. And so what do I mean by that? I mean, as if you think the market's going to just cruise its way up over the course of time, you would want a linear you'd be okay with a linear payoff to that upside movement, to that trend. If you believe the market's going to take off rapidly, there's convexity in that. You'd want a better payoff if you knew that information. If you knew that was going to happen, that'd be this huge upside move. You want to take a bet on that right tail payoff, so you do that through a call option, and then hence your long vol for what I'd call an up capture. And it's different than, say, we don't use the words long or short, because we are long all options. But if you're long a call, you're long up capture, and if you're long a put, you're long down capture, is the way we talk about it.
Okay, so I think it might be interesting to pick up on one of the things you highlighted a little earlier. You spoke about how there can be kind of long periods where you may lose a bit of money, or you certainly don't make much money, but then every now and then there's a huge payout.
Sure.
So how do you hedge your portfolio to minimize the bleed during those periods of what I presume would be low volatility?
Yeah, so that's the magic, I'll call it, and that's what was spent many years. We spent many years trying to figure out, because that's the whole problem: is how do you make money while you shouldn't be making money, while you should be losing. So if in that easy example, if you were betting on market upside, you can just get long a call, and if you did that naively, you'd say, okay, I'm going to buy some S&P calls, and you're going to hold them for the month and roll them till the next month. And if the market doesn't do much that month, that's going to cost you. You're going to pay theta. You're going to pay for that cost of ownership for that long vol that you're buying, for that convexity that you're trying to own. That's going to cost you, of course, with the price of the option and the decay of that option over time. So the easy answer for me, and I guess first, generally, I'll say that the way people traditionally finance that trade would be to sell optionality elsewhere. So if you want to be long in the market, you might say, okay, I'll buy a long call at this level, at this strike, and I'm going to short a much further out call to give me some income to pay for this call, because I believe the market will go up maybe 10%, but there's no way it's going up 25%. So I'll short some up there where I think it's highly unlikely, and that income will pay for where I want to be long. So that's the traditional approach. I did not like that approach because I viewed it as being a counter trade. You got kind of going against what you want to be doing. And so my version or my method to paying for that ownership was I realized could be through trading. That was one of the components, meaning instead of just buying that call and holding it for the month and waiting for the market to do what it's going to do, one could trade around it, right? The way you might think a market maker could trade, right? So my experience on a trading desk was learning to trade. So the cool kind of realization for me was being able to lay over or combine trading with holding long volatility. And so how do you do that? You say, okay, instead of buying and holding this call for a month, I'm going to do I believe that I can, the market's going to be a bit down over the next few days, let's say as a swing trader, I'd say, okay, it looks a bit toppy here, so it's going to pull in. So I'm going to sell some of the calls I have, and the market pulls in over the next few days, and then you buy them back and you buy a bit more because it looks a bit oversold, and then the market runs up for the next few days, but you had more than you needed because you bought a bit more when it sold off. And so after it runs up, you take some off the table. You're taking a little bit of profit, but still keeping some of the calls you have. What you've effectively achieved, or if you can do that well in as a trader, you've maintained this long volatility exposure, scaling up and down your holdings. You're modulating your inventory, but by doing that, you're scalping. You're pulling out little profits out of the market, all the while holding on for this big pop for when it's going to happen. Right. So if that lasts for 2 months, you're trading the noise while you're waiting for the pop. And that's the idea. And that's what ends up working out, I guess, fairly well. And in fact, it has for us. And even more so is aligned with volatility, because volatility itself tends to be a more mean reversionary asset, meaning like it moves up and down a lot, right? So if you think about a low volatility environment, and I'll use an easy example of this, the year 2017. Most people would agree was a really, quote, low vol year, right? So you'd say to me, well, there's not much volatility there, Wayne. It's the lowest vol it's ever been. Let's say VIX down at 10. Yeah, sure, it was low vol. It was down at 10, but it didn't just sit at 10 every day. In fact, it moved from, let's say, 10 to 13. Let's just give it that small range. That's a small range, 10, 12, 11, and it's bouncing up and down with a little bit noisy around there in a few points of vol up and down. But 10 to 13 is 30% of movement. That's a ton. If I told you a stock's going to move 30% tomorrow, that's an incredible thing to trade as a trader, right? That's like trading Netflix or Google or whatever it might be. So, or probably Tesla, right? That's the kind of thing that moves a lot that you want to trade if you're a trader. So that idea that even in a low vol year, you get a lot of noise. And so if you could buy that vol every time it dipped down to 9, you bought up the VIX, and then it popped up to 11 and you sold some, and then it popped back down to 9.5 and you bought it back, and popped up to 11.5 and you sold some. You're long the VIX the whole time, but you're trading the noise. You're scalping, and all that requires is being a good enough, I guess, swing trader to be able to buy those lows, sell those highs while maintaining your long vol inventory. And it even does exist during low vol years. That's the beauty.
When you are trading around in the noise, are these directional trades you're placing?
They're directional partly in the sense that, yeah, if you buy more calls, you're buying more up capture. Right. But so there's a bunch of answers to that question. So the first answer is yes, they're directional in the sense that you're adding or subtracting to a direction of the market. At the same time, the instrument itself has a convex, of course, upside and a concave downside. So go with the example that you buy some calls. If you're wrong the next day and the market continues going lower, your delta shrinks, right? You've got negative gamma, so you're less wrong than had you bought that underlying, because it's like a built-in stop loss. The amount you're losing is shrinking really quickly. All you could lose at the end of the day is your premium. So if you had $100 and you spent only $1 or 1% of capital on this long call, sure, you could make $10 if you're right, but if you're wrong, you could only lose $1. So in a sense, you're going more into a direction, but you've still, as a trader, capped your downside. So that's one kind of piece of the more complex answer. The other pieces of that is that at Logica, because we're market agnostic, we're going to do that same thing on both sides. So as much as vol's coming down, I'm buying some more calls. I might be buying some more puts. Effectively, we're adding up capture and down capture at different times. So we are definitely tilting, but then you end up trading not one side, but I guess the position would be called a straddle. Right. And once again, a naive straddle would just be saying, I'm going to buy 100 calls and 100 puts from at the money. And so you wait for this V shape to pay off. You're long both tails, or you're long up capture, you're long down capture equally. The way you do it as a trader is say, I'm going to do that same thing, but I'm trading around the noise, but on both sides. So I might be adding a few puts, selling a few calls, adding a few calls, selling a few puts. Therefore, all the time, you're anti-fragile in the sense that if the market goes extremely in one direction, you have convexity to that direction and concavity in being wrong, right? You're going to lose your premium on your puts and you're going to make a bundle on your calls, or the opposite's going to happen. You're going to make a bundle on your puts and your calls go to zero. It doesn't matter because you're long the other side. But you could trade the noise on both sides, and then each side is, quote, paying for itself. And collectively, the whole thing is paying for itself. That's, to me, the most beautiful trade there is, because you are long the extremes. You're going to participate in both directions, but you're managing yourself. You're making money while you're waiting for those big pops.
Now, just another question on this still. Trading around in the noise, are these trades model driven still, or is there some discretionary which comes into play?
Yeah, so there's a beautiful interaction between the two, and I always struggle with this question, not personally, but as a, like, to me, that it's such an inner weave in the sense that, a model is discretionary because we, the human, built the model, right? I don't mean to be all philosophical here, but in a way I do, because I build a model, and it's a model, and everything that went into that model was how I understood as a discretionary trader how that thing should go. And all I've done really is codify the rules in my head. Okay, so now that's done, and that's a model. And I say, okay, it's fully systematic, and then it starts trading, and let's say a month later it does something that I'm saying, well, wait a second, that's not exactly what I would have done there. It really bought too much on that dip, and I don't like that. So I go back to the model and I tweak it for not being as sensitive to certain moves, or changing its rate of modulation, or whatever it is that I'm going to tweak as a parameter. Now it's a new model, or it's a refined model based on my, once again, discretion. So for me, the idea of being systematic is nothing ever that's going to be, plug and play, or let's plug it in and leave it alone. It's going to be forever infusing my discretionary understanding of markets and interweaving the two. Yes, I'm trying to codify all the rules, and we want to just be able to plug it in and let it go. But that it never works out that way, because markets are always a little bit different, because things change, because this V recovery was unprecedented. The rate at which the market went back from its lows to now is just, I think it's definitely on record as one of the biggest up moves in history. So had you built a model to all past behaviors, well, you wouldn't have captured this. So models work and then they don't work. And so I'm a big believer in a systematic approach to I'll say set the boundaries of your trading, and to give you a framework with which to trade, but we'll never stop. Every day I'm in the market, understanding what the trade that's going on, and asking myself, is that what I would do here? And if yes, all good. If no, go back to the model. And therefore, is it systematic or not? I'm not sure. It's both.
Okay, that's a great answer. And I have quite a few questions for you around modeling, which we'll get to in just a moment. Just one last question before we do. You spoke earlier about, the insurance costs, I guess you could call it, the bleed, which can go on during low volatility periods, and how you try to hedge against that. I guess that is one of the risks of running a long vol strategy. Are there other risks which are inherent to these types of strategies?
I mean, I think all of the risk surrounds the cost of ownership. You call it the cost of insurance or the bleed. It's just how much of that risk, right? So, in other words, if you know the market can go, I guess you can be directionally wrong, but in a straddle, that's not going to happen. So, if if one gets tilted too much to one side, if you only bought calls or only bought puts, you can be in a much worse situation than if you're buying both, because of course you can be directionally wrong and you can bleed. But given that you're in or that you take a market agnostic approach, you can't really be totally directionally wrong. So then it just becomes about the bleed. But the bleed itself isn't just you can bleed. There's many ways in which it can bleed, right? So you can bleed in, of course, just the market being still, right, and not moving much. And you can bleed in being whipsawed, where you can, I guess, that this would be really not as much a bleed, but more a directional misjudgment, where it goes one direction, you get tilted to one side, and then it goes the other direction, you get tilted to the other, and you keep on getting it wrong, because the market's just not doing what it's quote supposed to in your mind, right? So that's a kind of directional mismatching. But the other form of bleed is in vol crush, where the market can go up and vol could drop a lot. The vol doesn't always totally associate with what's going on in the world. I mean, right now, we'd say we've come back to all-time highs. I guess the Nasdaq's made, the Nasdaq QQQs have made all-time highs. S&P's right about flat on the year, but vol or the VIX is still up around 25. That's still 2 times the historical, or close to 2 times the historical vol on the S&P. So there's still, with extended vol, you can be right in a direction. But if tomorrow the market goes up 1% and VIX crushes, let's say 7%, you could have been right in buying your call, meaning your direction is perfect, but you lose more because vol crushed more than the delta made, right? So your short Vega is worse than your positive delta. That's the problem. So that's what I mean when I say there's different types of bleeds. You're more subject to bleed when the overall environment is at higher vol, and so you have to be more right on your directions, or you have to do something else to manage that height of bleed. So I guess I can call it the magnitude of bleeding changes, and that's relative to where vol is and how choppy the market is around that position or around that vol.
Okay, gotcha.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Wayne, let's focus in a bit on modeling, just in general terms, and perhaps some words of wisdom for aspiring quants out there. My first question around this might be, what are some of the mistakes or the flawed practices which you made early on at the beginning of your trading career?
I think, I'm very happy to say that I didn't make one of the worst mistakes or flaws, which is overfitting. I understood that from the very beginning. I understood that if you search enough in data, you can find anything. And I think that's not something that I was subject to so much, but I believe that that's something that is very prevalent or widespread. And so that's what I caution everyone about is the ability to find something. It's so easy to find something. Everyone's out there searching for different data sets and looking at different things at different angles and trying to find a pattern in data. And if you do that enough, you're always going to find something. It just doesn't have any meaning, and it may not last very long. And so that's my biggest caution is the whole curve fitting mining concern. But I think that's known generally as a risk by people. I think the problem is not understanding in testing how easily that can creep up on you. And I think that's where. So I guess going back to myself, I knew intuitively that I don't want to just search for a pattern. I want to have an idea in my mind, and I want to look into the data to try to confirm that idea. Right. So it's not seeking a pattern. It's seeking validation of something that my mind thinks it makes sense. So that was step number one. And therefore I had curve fitting or data mining licked from a top level. But where it went wrong for me, I guess where trial and error helped to learn, was you can make those same curve fitting mistakes even though you start with that premise. Right. What I mean is that, let's say you have an idea and you test for confirmation or validation of that idea, and it doesn't come out exactly as you hoped it would, right? And then you say, okay, well, let me turn that, let me shift, instead of buying it every 10% down, I want to buy it every 9% down, and you test that. And so what you've done is you've started out with a good thesis that was independently hypothesized by you, and it's got a sound approach. But once you start testing and not getting the outcome you want, you start tweaking until you get the outcome. That's terrible, right? So that's like, it's terrible because you started out with a good thesis. You started out trying to not be a fitter, but then you became a fitter in the testing process. That's something that I probably made mistake, not probably, I definitely made mistakes with early on, and learned very quickly how incredibly aware one has to be on every test you do and every iteration you make to know that you're not biasing your test. It's almost unbelievable how we check ourselves today before. I'll say the time it takes, the biggest caution is taking time to set up a test. Today, when we have an idea, we don't just go do the test. We talk for hours, like brainstorming, like, is this the right test and what are we missing? And like you want to go through all this brainstorming and discussion just in setting up the experiment to know that you haven't done anything wrong in the experimental phase. Then you go test, and if the results don't look right, then you move on to something totally different. I guess that's the biggest learned or trial and error learned lesson I've had over decades is getting better at that feature of testing. And it's just so easy to do. We so easily fool ourselves as humans, especially when we're, of course, biased to want to find something, right? We all, when we're sitting there as quants testing, we want to find something. We want it to find dig for the gold, and there's a little sparkle in the ground. Oh my God, I found it. And we want to make money. And so we're so inclined to believe quickly. And it's much harder than people think to find things that work. And so most things don't, and therefore spend more time being sure and spend more time setting up one's experiment and expect it not to work. And the anomaly should be when something does work out really well in testing.
Okay, that's interesting. So you spend a lot of time, as you said, brainstorming these ideas all before you actually go to running a test. And if you run a test and the first iteration of that test shows, undesirable results, you pretty much just abandon that idea altogether.
Yeah, it's a good. I mean, that's a great follow up question to what I just said. But the problem is there's nuance there, right? So would I say I abandon that idea altogether? Sometimes yes. Other times I'd say if there's something about the idea that struck me, then I may not abandon it altogether. I might sit there and think or discuss and talk about what did we miss. What I will not do is say, okay, let me just shift this one parameter by 7 degrees and retest. That's the big no-no, right? So there's somewhere in between tweaking parameters of a model and going back to the drawing board and saying, okay, we believed, and what's some silly thesis, we believe growth outperforms value, right? And get into that big debate, but and that's not the kind of things that we do at Logica, but just to talk about that one as an easy concept, right? So you could do that and say, okay, and you do a test and it doesn't work. Say, okay, let's try, instead of big caps, let's try small caps. And well, it worked over there, right? So that's interesting because we understand the difference between big caps and small caps, and why growth would be more powerful in small caps makes sense because there's perhaps more room to grow if you're small versus when you're already big. So in that example, there's when you tweaked that parameter to look at not large caps, but small caps in trying to identify the benefit of growth or the alpha in growth, you've not just tweaked it by some mathematical metric. You've sat at a table and said, wait a second, maybe large caps don't have as much room to grow versus smaller companies because they're by definition there's more room. And of course we'd say this is not true of Amazon or some of the bigger boys, but put the anomalies aside, is that there's a sound reasoning behind changing a parameter, now going to a new test where you've deliberated and you've understood what was wrong in your first experiment and why in your next experiment you've stuck to the core idea that there's alpha in growth, but you've changed a parameter that has a reasoning for it to change and a logic behind why the new one should work. So that's the difference between just saying I'm going to run this array of tests and find something. Does that make sense, or is that helpful to that answer?
That does make sense, yes. As you stated that most or in all cases, before you run any test, there's always a goal and a brainstorming process which takes place beforehand. For newer traders out there and aspiring quants in particular, where do those ideas come from? How do you form those goals?
Yeah, that's a great question. The toughest part is the paradox, I guess, is that you said for aspiring quants, is that for me those ideas have come from experience. So how do you put experience in a new trader, right? That's tough. On top of that, though, I think there's, if I had to say, like the merging of three different things. So one is, of course, experience. Two is reading and just absorbing from other great investors / traders out there. I mean, when I was young, I was just, when I stayed late at the trading firm and then I went home and read a book, right? That's all. It's just absorbing yourself in what all the wisdom before you has had to share, reading and taking in all you can from those who have done it. The third thing is trading on your own capital. I can't stress that enough. This idea of simulating and the idea of paper trading and all that is just absolute nonsense, because there's all of it comes down to how emotion, where people try to build systematic approaches because our emotions can do us wrong, and as much as they're systematic, people go in and try to trade a systematic approach and they end up over trading it or disagreeing with it, and because the emotions always come in and you say, oh, this doesn't feel right, and you do something different. And so for me, the biggest gain in ideas has been just literally to put money in an account and start doing it. And I tell this, I get into a bunch of conversations. I do a lot of tweeting, and I guess I like the Twitter environment. And a lot of people ask me, they DM me, new traders, what's the best way to start? And my answer generally is open an account and put in some money and start trading like that. I can't think of a better version of gaining real life experience on your own capital, to feel what it feels like when you're sitting there and you think something's a good trade and you get in, and then the floor just drops and it just starts falling rapidly. And what do you do? And your body freezes up, and understanding how that how those behaviors work and how you feel and how the market does it, and where so many times traders will say like something goes wrong against them and they stop out, and then 2 minutes later it reverses, right? And it's like this common, it's a common thing that people talk about as being that being shaken out. That's because everyone behaves the same. And so unless you go in there and do it, you don't learn that behavior. And once you learn that behavior by doing it, then you could start to model, okay, now I can see like it's where my emotions are coming into play, and where behaviors need to be overridden by certain rules. And so you can better build the mousetrap by knowing what it is that that's going on. So that's where my advice, I guess, culminates.
Yeah, great. Are there any testing or modeling methods which you use that are unique in some way, from common practices in the industry or common practices used by, quants, just generally speaking?
Yeah, I mean, I'd say that we generally don't like to use just what's out there, the off the shelf models. There's a lot of stuff that you can. I mean, I know people read, and I do too. The white papers. There's new ideas every day and being published, and I guess I have the general feeling that if it's a white paper and it's being published, especially if it's published by AQR, who are putting out so many, like that, it's like the market knows that. Like you're not going to learn anything there that people are. I'm sure it can continue working. I'm not. That's maybe it will. Maybe that's just enough of the way the market works. But if it's a white paper, you're not the only one who has seen it, right? And so if there's some mathematical approach that in volatility investing, people use GARCH as a very typical model for the way volatility behaves. So what we say is we're not going to use any of that. We're not going to do something off of a white paper. We're not going to do something. We're not going to use GARCH. We're going to develop our own stuff based on how we understand it. And so for me, the beauty of that in using, I'll call it proprietary mathematics, is that yes, you can be wrong, but by definition, you'll be different. And if you can figure out something that has alpha where you can be, quote, right, and you're using different mathematics, then people won't come upon it. Right, and don't go issue a white paper on it, because then it will be known, and then you'll be competing with yourself and all the others that saw it from you. Right, so I think my broad answer will be that yes, we do all our own stuff. We use interesting mathematical approaches. I like integrating I guess more disconnected ideas in mathematics. So, for example, the PhD that we have in house is a algebraic geometer, right? So, what does that mean? His PhD is in the combination of algebra and geometry, and those two are beautifully intertwined. It's a little bit of math back history here. Is the first formula or algorithm that combined algebra and geometry was the Pythagorean theorem, right? That you could take this a squared plus b squared equals c squared, that there's this the algebraic formula that perfectly fit this geometric shape, that the hypotenuse would be the square of the two sides, right? That's a cool way that geometry and algebra came together, and that was the first one where they did come together. So building on that approach, now shoot forward thousands of years in markets, people can use algebra, but you could also use geometry. And so for me, when somebody's looking at, for example, standard deviations, I want to look at that topologically. I want to look at that in geometric space. Like, what are the distances between two things? That's more interesting than how much they, specifically deviate as a percentage. And if you can come up with distance relationships and what that means, and do things take on certain shapes or symmetries? These are ways of using mathematics and doing things differently than most other people are, and I think they help if you can figure stuff out using such approaches.
Just out of curiosity, what is your level of mathematical education? Like, how much of this is self-taught versus formal education?
Yeah, so it's a nice mix. Most definitely more self-taught, because I'm so much older than I have been out of school now for 25 years. So by definition, I have more time out of school than in school for 4 years, right? So therefore, I definitely have more self-teaching. So the background for me is I certainly had a strong mathematical understanding, or as I talked about earlier, as a kid, I saw things numerically very easily, and so I had that intuition. In fact, so much so that I got more advanced in math as a youngster, and in high school I was so advanced over my peers. I started university level math and getting through. I remember I was like started, I guess, college calculus in 10th grade of high school, and so I was really leaping ahead. But then the funny thing happened to me is because I was taking all these college classes when I was in high school, by the time I actually got to college, I was kind of sick of math, right? Or I was just like, I had been that youngster in the college classes, the high school kid in there. And so when I got to college, when I actually went to formal university, I thought to myself, or I at that point, I didn't want to do it anymore. I didn't want to be that. I had kind of negative experiences with being the younger kid in those college classes while in high school. So I said, you know what, I'm not doing any much math, and I was able to transfer all my credits because I did so much university work. And so I actually took on an English degree and did English and creative writing out of Berkeley. So in that way, I didn't formally go further with my math education, but I was this advanced math kid. So when I came out of college and then got into the real world, of course, my love for math was quickly pulled back in. But what it gave me the opportunity to do is to understand things really quickly in the mathematical realm, and to be able to pick up where I left off and then self-educate for the next 25 years. So my love, my passion, my intuition for math has grown a lot of education in me, but formally it wasn't actually even that much, other than this advanced stuff I did early on. But I love the way it came together for me, because it allowed me to see things in different ways than people learned who did I'll call it the formal route.
For someone who doesn't have a strong mathematical education but is very interested in quantitative trading, do you have any advice for someone in that situation?
Yeah, I mean, I would liken that to myself, right? And is that if somebody has the interest, and not just the interest and passion, but the intuition in math, if you're intuitively good with numbers and with understanding that sort of thing, then self-education is amazing. I mean, it's incredible what you can get online now, and I mean, it's right. They didn't even have as much of it was when I was. I mean, and they did, of course, 25 years ago. It wasn't. There was still Wikipedia was still around, right, or was already around, I should say, but. Today, there's even more. I mean, the classes that you can get through Coursera or any number. I mean, through Khan Academy, it just goes on and on and on. And you can, I mean, there's online classes out of every major Ivy League put through different online entities. So one can fully educate. I mean, you can give yourself a PhD if you want to by just taking online stuff. The answer is, if you have the passion and the basic understanding and intuition, then just get out there and do it. All right, grab everything you can and learn. And I mean, that's what I did for myself over decades. And you just keep on going. I mean, it's like that thing what we were saying earlier, is if people say you work too hard, but no, not if you love what you do, then it's not really work. So same for me. It's like on the weekend, I read math stuff because I'm so just interested in it. In fact, I remember there's a funny story. I was out when I'm a big cyclist. I go biking. It's my kind of sport of choice. And for many years, I was listening to math lectures in my iPod while I'm biking. And I was out somewhere biking, and I ran into somebody I knew, and he saw I had my iPhone, I had my little earphones in, and he knew me. He walked up to me and he said, "Oh, what do you listen to?" And he grabbed my ear thing and he stuck the left, he pulled the left and he stuck it in his ear. And there's some partial differential equations or whatever. He's like, "What the hell is this?" Right? And that's what I wanted to do when I was biking, and it helped me to take it in as because I was concentrating on listening. I could climb the hill better, right? So that's my answer: is if you love something, then do it, and you could learn all you want. And if you have the intuition, then it'll come to you.
That's a great little anecdote there.
Yeah.
Just jumping back into modeling. Before jumping on this call with you, Wayne, I spent more time than I expected to scrolling through your Twitter feed. It was just fantastic.
Thank you.
One of the things I pulled from it was you had a tweet about trade frequency and the importance of it, and I think you may have called it mastering the art of trade frequency. So I just thought that would be an interesting question to ask you. to get your thoughts on the importance of trade frequency, I guess.
Trade frequency is, I'll say, I love that idea in the sense that there is no right frequency, right? There's not an absolute version that works. And so the important point is that one has to use multiple frequencies, and the market actually shifts. A lot of the time, the general behaviors don't shift, but the frequency shifts, right? So markets run up and down, but at different frequencies. And so it's very, very hard to time, just like it's hard to time a regime shift, let's say from a value to a growth regime, or on the broader level of factors. It's equally difficult, if not more, to really hone in on the right frequency and or shift in that frequency. So my general approach, and that's something that we do in Logica, is to have multiple frequencies running, at the same time. And it's like I guess I liken it to hedging, right? So let's say I have one frequency in which which day trades, right? It makes a trade per day, and another frequency, let's say, which twice a month trades, and another which is monthly, right? So you have slower and slower at different rates. So what could happen there is, on a day trading level, the market's overdone. And so you take some off the table, you sell some S&P, let's say, but the next day, of course, unemployment comes out, the number on Friday, much better than we expected, right? Still drastic, but of course, much better than the world thought or the US thought. And so, boom, the market gaps up 2%. So as much as the day before was extended and your day trade sold some, took some off the table, on your 2-week frequency trade, you still were net long, right? So you're hedging not being wrong. And so it's not that it's not that one was wrong, or not that the day trade decision to take some off the table was incorrect. It's that both were correct, that each is correct under its own time frame. And I can't stress that enough. And the market, people use these words of that you're profit or loss being right or wrong. It's not really right or wrong. It's that there's a lot of different things going on, and a day trader is right to have taken an overbought position off the table. But if you're a month-long trader, you want to hold on to that mean expansion longer. And so by having both, you're hedging your own ability to time, and you're taking both approaches that over time can be successful, and of course merging them to have a more, I guess, noise canceling the downs, and of course hopefully keeping the alpha associated with whatever edge you have in each frequency.
Wayne, let me ask you one last question. As someone who mostly ignores macro, more focused on the math and in their trading, what have been the greatest observations for you from this recent market crash and recovery? Like, as you said before, it's probably been the greatest rise in markets which we've seen for a long time. And I think very few people expected to see this, and people have been making predictions everywhere, and almost everyone's been wrong about what's actually happened. What has this taught you, or what is this, if not taught you, what is it kind of enforced?
It's enforced to keep on ignoring macro.
As simple as that.
Two things. I want to say that, and then I want to actually contradict myself in a second. But so the first thing is that what's long been my premise is that nobody has any idea, right? It's just the funny thing is I actually did a interview a while ago, which was after the December 18 sell-off and in January 19 recovery. And what I talked about on that cast was how wrong people got it, right? In December of 18, as the market's selling off, people are saying our economy's done and this is it, the bubble has burst. And then not 3 weeks later, in January of 19, it's everything's back to normal. The market's right back up, new highs, and like nothing happened. And I was talking about how wrong everybody got it on that, the V, and how doomsday the world became on the initial weeks in December, and then suddenly how optimistic everybody was in late January. And lo and behold, the exact same thing happens again, right? In February, March, the world was ending. This was worse than 08. This was going to be the gloom we've all been waiting for. And here we are again, having made new highs on the NASDAQ once, and close to it on the S&P. So the highlighted point is, once again, nobody knows. Once again, people get the emotional behavioral side really always just falls into the what's happening now. And if you look at even the Twitter environment or the FinTwit or the media in general, most of it and the panic is associated with what happened in the market today and yesterday, and that tells us so little. And we're all the people that follow that media end up getting immersed in what's being said now, which is just a function of what just happened, which inevitably tells us nothing about the next 2 weeks. So I double, triple, quadruple down on that thesis. Okay, so that's where everything stays the same. On the other side of that, I've had a really amazing new experience in the last year where I actually Logica took on a new partner, somebody I, funnily enough, met on Twitter, Michael Green. He was at the time he was working at Teal Macro, and he had traded in the vol space for a while, and so we came together and just having a common respect and understanding of what each other was doing. I guess having found each other on Twitter and met and started talking about some stuff that was I didn't know about, but he was sharing with me that there was this big reasoning from a macro perspective of why the trades I was putting on were working really well. And he basically said to me is like, yeah, you're producing alpha, but it's not all yours, right? And in a very polite way, like, yeah, maybe you have something for sure, but there's more alpha associated with what's happening in the market as a function of the growth of passive, and how that's distorting the market, where you have this, I'll call it agnostic buyer, so a long-only buyer whose basic model is if cash then buy, right? And every 2 weeks, everybody's paycheck dumps more money into this premise: if cash then buy. And here's every 2 weeks more cash in everybody's retirement, and of course corporate matched plans and all the rest, trillions of dollars that's going into this stuff on a regular basis, just buying, and by definition exacerbating momentum, because the more the stock is represented in the S&P, the more it gets bought. So passive indexing becomes the self-fulfilling prophecy. And so all of his work around, from a macro perspective, how that has been influencing market structure over the last 10, 20 years, and really opened my eyes to this whole new framework of macro, which is not to say we're going to use macro to predict the future or to make a forecast about the economy in 6 months. It's that we're going to use macro to understand the structure of the market and therefore how we can better profit off of that. And so integrating Mike's work with what I was doing, we now had a better mousetrap, because we could say, okay, that does make sense. That's why a straddle, a lot of short vol exposure out there is helping push down the pricing of the vol we're trying to get long. And so this call overriding is bringing down the price of calls that we're trying to get long. That's why there's a little bit more alpha there. So yes, I had a good idea, but I was being helped by this larger structural dynamic of the market. And so I now have come to a newfound appreciation for macro in its ability to help explain what's going on, and to help, I guess, structurally build a model, or to design a model to what could be more of the thesis behind why something's working. And so again, we're not using it for making predictions, other than saying, hey, if this is going to continue, which it looks like it will, as just in line with the U.S. population and growth, then the market should continue to do this. Therefore, we can make certain bets. Therefore, we could bet more on extreme outcomes. Therefore, what happened in February, March, and now April, May, this insane V in the market, was to be more expected given the influence of passive. This explains it better. Therefore, going back to what we were talking about before, trade frequency, if that's the case, then we have to slow down or perhaps speed up or make changes to our trading cadence, because the market will take on more extremes based on the influence of passive. So it just adds this whole new dimension to what we're doing. And so for me, it's a way to infuse a macro view without actually being a forecaster, which is what I'm always going to stay away from.
That's brilliant. Wayne, thank you very much for coming on the podcast. Very grateful for your time. This has been an incredible conversation. So, once again, thanks a lot for coming on the podcast. If somebody wants to follow you or connect with you online, where is the best place to do so? And I know you also have a non-profit as well, so would you like to give that a mention?
Sure. Yeah, the nonprofit. Wow, I started that back in 2003. I just that's called Informed by Nature. It's I just love this, I guess, scientific thinking and rigorous experimentation and this mathematical view of the world. And so as a believer in that, I wanted to fund some projects that did that type of thing. And at one point, we had this little solar cars and that had kids were building in a classroom and things like that. It's done different things. Right now, we work with some journalists who are promoting some kind of innovative scientific ideas, and another group that does a science camp for budding scientists, younger scientists, or scientific thinkers. And so it's just a way to give back to the world for me, what has helped me so much along my path and the way I think. So that's what that does. And then how to get a hold of me, that's pretty easy. I guess I'm on Twitter, right? And to your point, I've got a lot that I like to say stuff often, and I've got a lot of thoughts that I like to share. So my handle is just my first and last name at Wayne Hemmelstein. And from there, my firm, Logica, of course, we're at logicafunds.com. So that's easy. And I guess, if one were to just Google me, there'd be and a lot of stuff, I'm sure. That's what a lot of people tell me. These days, I think anyone's easy to find, right? It's there. We're a Google away. But yeah, I definitely think that if someone's interested in hearing more, then my Twitter is a great place to start because I love sharing my thoughts as they come.
Yeah, folks listening to this podcast, I would certainly encourage you to follow Wayne on Twitter. There's very little fluff, very little feel-good stuff. It's just a lot of really wise thoughts. So well worth your time. Wayne, thanks once again, and hopefully we'll chat again soon.
Thank you. Thank you very much.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome back, traders. I am Aaron Fifield, and thank you for joining me. This is episode 203. Today, my guest is the great and legendary Bob Bright. Though, unless you follow high stakes poker or you were maybe a prop trader during the 90s or early 2000s, it's likely you're unfamiliar with this man. In short, it was 1974 when Bob threw in a corporate job, moved his family out to Las Vegas, and went all in on blackjack. 4 years later, having consistently beat the casinos, Bob went on to the Pacific Exchange in California and traded options on the floor. Then, in 1992, Bob and a partner formed Bright Trading, a prop firm which, at its peak, was home to 490 traders across 42 offices in the United States. Bright Trading still exists today, but on a much smaller scale. Now, at 80 years of age, Bob remains an active market trader, and he is also a serious high-stakes poker player. In fact, if you Google Bob, the only photos you'll find are of him sitting in front of stacks of chips at various casino tables. I might also add, if you've heard my interviews with Blair Hull and Edward Thorpe, you'll notice that Bob's story has similar parallels. Over the next 60 minutes, you'll hear Bob speak on pivotal moments from more than 40 years trading and gambling, his dependence on betting with a mathematical edge, which leads into what he's trading nowadays, leveraged ETFs against non-leveraged ETFs. If you do happen to get confused by some of the things Bob is describing on this subject around leveraged ETFs, I've included a link in the show notes which may help with some additional context. And then we finish it off with some talk of discipline and managing tilt. After this interview, personally I feel like Bob perhaps had a little bit more to give. I thought I might have been able to tap in, extract some more wisdom, but it's like occasionally my questions weren't quite connecting. Regardless, it was an absolute honor to chat with Bob, and I hope you'll dig the episode. Ladies and gents, here is Bob Bright. I believe it was the year 1974. It's when you left a corporate job after having worked there for 12 years, packed everything up, moved your family to Las Vegas, and decided that you were going to become a full-time blackjack gambler. How confident were you that this was a good idea?
Pretty confident. I had, for about 8 months, tested out poker in California and blackjack in Las Vegas on weekends. And I did not run into any real poker players that had much money. A lot of top poker players in California I ran into, but I could tell they didn't really have much in the way of money. If they had a bad week, they were struggling. The blackjack, after reading books and getting a little bit of tutoring, I was able to win that without a big problem. So the playing blackjack as a business is the book I read that worked for me, and I came to Las Vegas and had a weekend workshop with a guy that was teaching people that. And at that time, that was in 1973, I believe, and he charged $100 for a weekend, which is pretty low cost. But he had 12 people, and back in those days, he'd put on the screen that would play on the wall. 2 cards would come up, and your cards would come up, and then you had to tell him what was the proper things to do, because he told everybody they had to study. Well, out of the 12 people, 10 of them, he told them, come back. I'm keeping your 100, and yet next time, study before you come here. Because people from New York and everywhere had come into the workshop he had, and 2 of us stayed then for the weekend, and we learned a lot, and I used that methodology for 4 years and made enough money to get into the stock market, and the casinos were happy that I left Las Vegas. So that was an experience. So that was 12, over 4 years on my own with blackjack. The 12 years that I worked when I got out of college was with a large corporation and I worked myself up to a finance controller for a multi-plant location. And then the next way up was a division controller job, and I checked everybody's profile, and they all graduated from Yale or Harvard and some of the prestigious schools, and I did not, and decided time for me to move on and do it on my own. Why would I work for somebody all my life? So that's what I did. Moved to Las Vegas. I had 3 young kids and a wife that was willing to go anywhere with me. So we enjoyed it for 4 years, and I ran into a few other card counters, and we met every once in a while to sharpen our skills, but we never recognized each other in a casino. If you saw one of the other card counters, you'd always never say a word to them in a casino, because that's how they find out if you're, part of the people that beat them. And they don't like people that beat the casinos. So, but since then, it's been a nice ride since 1974, when I finally left my one-time job. Luckily, I haven't had to work for anybody else since then. So I guess that's been, 46 years.
Quite some time, yeah. So you had this methodology for when you came into playing blackjack that you'd sort of been going over a little bit. When it actually came time to put it into practice, in 1974, once you really committed to this, were you actually a good card counter from the outset, or did you struggle a little bit to make a reasonable living in the beginning?
No, I actually, 1973, came to Vegas quite often on weekends and counted cards. I read the book originally, probably early 73 or early 19, or sometime in 72. So I was always interested in it. My brother had worked in Las Vegas as a dealer, not a blackjack dealer, but a dice dealer. So for a number of years, so I was familiar with Vegas, and once I understood the book, it was fairly simple to do card counting, and I came down with $3,000 in my pocket, and had to rent a house, and that was my biggest expense. And then I went out and tried to play very small stakes blackjack, and did that for about 7 months before I could jump into a little bigger stakes, because I was playing $5 chips for 7 or 8 months, and finally got to the point where I could play the $25 chips, and then I finally started making enough money to where it kind of grew from there. And then I had about 3.5 years to accumulate enough money to go get involved with the stock market.
I've heard you tell the story about how you went out one weekend with the intentions of making enough money from your winnings that you could then buy a house in cash, and you pretty much did, minus a couple grand. You were short, but was that during your first year?
No, that was in the, I think I was 2 or 2.5 years into it. It was in 1976, I believe. And I was getting tailed quite often from the casino. Security people would follow me to my car, write down my license number, things like that. If you win in Las Vegas, they tend to want to know more about you. And of course, I lived in Las Vegas with a Las Vegas license plate and everything. It got to be where, okay, I figured I had to move back into California and drive up on weekends, or move to Utah, which was 100 miles up the road. And I decided to buy a house. We found one about 105 miles from Las Vegas in southern Utah. And for 2 years, it worked out for me and for the security of the casino, because now I had an out-of-state driver's license, out-of-state license plate, and I could pretend to be a high roller and sit there and drink alcohol and play chips and vary my bet to go along with the card counting and act a little bit tipsy and play all night, and they wouldn't bother me because they knew I was out. They did not understand that I had basically lived in Las Vegas for 2 years. I didn't realize that, and I just happened to come in from out of state and check into a hotel for a weekend. And instead of having to play 2 or 3 shifts a day, I used to put in about 3 hours on every shift, almost 7 days a week when I first started. But in 1976 and 78 and 78 through late 78, I only had to work on weekends, and it made more money and less so-called heat by the casino. So that worked out pretty well. Then I had enough money to go into the stock market. I went and got interviewed at one of the stock exchanges, and they said, "Well, what makes you think you don't know how to trade stocks?" And I said, "Well, I don't, but I will learn." And it was ended up on the options exchange, and they asked me, "Well, how are you going to trade options?" I said, "I'd figure it out. I'd probably play it the same way I did the mathematics with blackjack." And they said, "Well, why don't you talk to this so and so guy who he's also was a major blackjack player, and now he has a good operation here." So I did, and he turned out to be a pretty good player. And I understand from Rob that you have interviewed him by the name of Blair Hull.
I was just going to say, yeah.
Yeah. So he and I worked together on the Pacific Stock Exchange for about 3 or 4 years. And then he went on to Chicago, and then he retired for a while. And then I went on to Chicago, and he found out what I was doing. So he contacted me and came back to Chicago and grew an infrastructure of what he really wanted to do. And he's done very well with his life, and I have too, and we both enjoy that period of time. And he's you know him well. Bob told me you had quite a long interview with him, but he helped me a little bit when I first got involved with the options, and he already had something with a kind of a 360 baud modem or something that you can get some computer work done on option models. And back in those days, in the late 70s, not many people had those kind of things. So that's how I made money in doing options for quite a few years. And then in 1984, I moved to Chicago and got into futures and the bigger options exchange there. And eventually, in 1992, I started my own trading firm when I was doing equities. I started doing equities then because a friend of mine told me that he was the second person on the West Coast to be shown how to do equities from what they called upstairs. You did not have to be on the trading floor. Up until the early 90s, you could not trade equities or options unless you were on the trading floor. And he wanted me to come over to his office, and I did for a while, and I was impressed with what he was doing. And the problem was he learned how to make money trading equities with a computer in an office without being on the trading floor, but he didn't have the capital. And I had a lot of capital, so we joined forces and started Bright Trading, and went to Chicago. And from that point on, we grew to a pretty large firm, and we're still around. We didn't get involved with high frequency trading, and now there's a few firms out there with high frequency, but we love having a proprietary trading firm, and that went very well, 1992 to now, and we're still thriving with a number of some of the best are still with us, and we have a firm that we enjoy dealing with the traders and doing trades. I enjoy doing the trades. I bought my partner out there in 2003. He got bored when things started going the other direction, because he was his half of the partnership was he would find the managers to manage the building and do all the construction and electrical work to get offices going. And we had 42 different trading rooms going at one time, and now we only have a couple. So people now trade from home. You can trade from anywhere. You can use your phone from anywhere in the world and trade. And a lot's changed. I've seen a lot of technology change in the last number of years.
I bet. So you've covered a lot of ground there. I think you sort of summarized close to maybe 30 years just then. I'd like to dissect a few of those things a little more. First of all, I was just curious, when you were still in Las Vegas, did you ever cross paths with Blair Hull at that time before you later worked together or had some sort of thing going on at the Pacific Exchange?
No, he was at the exchange before me, and I didn't cross paths with him. I crossed paths with a guy by the name of Ken Houston, who wrote a book, The Big Player, and he also was like an IT manager at the Pacific Stock Exchange, and he would come to Vegas on weekends, and he had a team that played, and it was probably let's see, what year would that have been? That would have been about 1977, 76, 77. And he was the best known blackjack card counter then. He had high profile. He'd always turn around and tell reporters in town how he did, and probably embellished a little bit on that. But he had a smart team that he brought in from California every weekend. And I joined forces with him for a month. And we went around the world and played blackjack a little bit. He taught me everything about team play. And I taught him how to play lone wolf. And that was our agreement. When we got back to Las Vegas, we played about one more week. And then I told him, okay, we both met our goal of learning a lot from each other, and I'm going to go back on my own and be a lone wolf. And he said, well, nobody's ever quit my team before. I said, well, I can make more money as a lone wolf. So he went on and became one of the most famous blackjack players prior to when some of those college kids got in from the East Coast. MIT team got in about 10 years after he did. He had a team going here for quite some time. I never decided to get into team play. I'd like to be the lone wolf and play my own money and not worry about other people. And that's how I did it with the blackjack, and that's how I did it with options for many years until 1992 when I decided to start a firm, and kind of grew because it was the right time. People were now leaving the trading floor. Where a friend of mine who had stayed in San Francisco and I had gone to Chicago, he said, well, come back and visit me and I'll show you what we're doing, and maybe we can get together and start a business. And we did, and it worked out very well.
When you first arrived at the Pacific Exchange, I understand that you were predominantly trading options. Your big thing is having an edge, and I presume this is sort of ingrained in you from playing blackjack originally. Where did you find an edge in trading options to begin with?
Well, back in those days, it was very simple. You would buy to the left, sell to the right. We had printed reports that we got from Blair Hull, who had a little operation going where he was selling to about a half dozen people the mathematical model of what the fair value of option models are. And we were trading stocks with it. We were doing stocks and calls and puts. And most people that did options back then, in fact, the first year I did it in 1978, there was not hardly any puts being done. It was mostly calls. But the idea was, it was pretty simple. If somebody comes in and wants to buy calls or puts, you just look on your printout and you're able to do it. It didn't take long before you learn to do it in your head anyway. But options versus stock, with a call and a put combination, you can actually do synthetic stocks. I don't know if you're familiar with that, but a lot of traders might be. where if you buy a call, sell a put, it's the same thing as buying a stock. And sometimes you can buy a call, sell a put, and you end up with a price of the stock lower than the price that the stock's trading for. And then you turn around and sell the stock, and you lock in some free money. Or you can do the reverse of that. There's what you call conversions or reverse conversions. And back in those days, in the late 70s and most of 1980s and early 90s, that was how a lot of professional traders made their money. But since then, everybody's gotten involved with computers, and seldom do you see things out of line enough to be able to do the three-sided to where you lock in these profits without any risk.
So what year did you transition to computerized trading? And I presume this probably forced you to adapt a little bit. I mean, I'm not sure if you were able to continue doing those same sort of trades once things became computerized.
Rather than get involved with high-frequency automated computers with artificial intelligence and have that do the trades for you, I decided not to invest in that. And I'm still a point-and-click type trader, but I'm not a good analyst. But I find where there's mathematical edges just by looking at these things, and that's why I still point and click. And very few people now. A lot of our best traders have AI, and they will maybe send in a few hundred stocks for the opening and get things done based on some AI programming that they've done, and then they don't trade too much during the day, and then they do a market on close and get out of everything. There's various niches in the market anymore, and you can do it with a lot of letting the computer do all the work for you, and you got to do a lot of homework to get the computer the information that's needed, or you just do it yourself with a niche that you may have in the market, and that changes periodically based on things like interest rates and things like that. So you got to follow it. You got to understand. Once you understand how the clearing firms make their money and the brokerage firms make their money, you find a way to where you can also make your money as a professional trader. So that's, but you still got to pay the piper a little bit, because my clearing firm is Goldman Sachs, and I've been with them ever since 1978 when we started with them or a company that they had bought. They bought numerous companies that I had been with. I never changed firms. I started with one firm, and then another firm bought them, and then another firm bought them, and then Goldman bought them. So I've been with Goldman ever since 78, more or less, and I've learned how clearing firms and how exchanges make their money, and how a proprietary broker can make money, and how retail brokers make money. I never cared for the retail brokerage. There's always such a what you call handcuffs for traders that want to work retail. That you got to almost be into a proprietary situation to where you're not limited to the so-called pattern day trading rule with all the rules of the SEC and FINRA. As a proprietary trader, you have to take a lot of tests, and so they know what you're doing. And then once you get all the tests passed, you're pretty much eligible to do what you or your firm wants to do, as long as it also the clearing firm that you're clearing with is allowing you to do what you want to do. So that's pretty much. It took a while over the years, over the decades, to learn to do that, and I'm still doing it.
Yeah, well, I'd love to spend a little bit of time talking about, I don't know if strategy is the right word, but really understanding a bit more about how you trade. Now,
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
And perhaps today you aren't quite as active. You're still very active, but not to the extent that you were, the past kind of 30, 40 years. Maybe if we talk about when you were kind of at your peak, really active and heavily involved, day trading. If we were to come into your office during that time and we were to watch over your shoulder for the trading session, I mean, what sort of trades would we see you putting on? Like, what would that be like?
Well, things have changed a lot from those days. In those days, the rules were a lot different than they are today. If you have a stock like, say it's $40, and there was a while there for the first few years, they traded by eighths of a dollar. Then they went to a teeny of a dollar, 1/16, and then they eventually went to pennies. But the point is, you could put in, say a stock was $41 bid and $41.05 offer, or $42 offer even. But you could also put in offers above the offer, and then if some institution came in and wanted to buy 100,000 shares when only a few hundred million are traded that day, they might be willing to pay $43 for it. And say you had a 42.10 offer, 42.20, 42.30, 42.40 offer, and if they came in and bought a big block of stock at 43, you would get paid $43. They changed the rules over the years to where now you don't get that money. They get every price that you've had in as an offer now. And that changed many years ago. So those are one of the bigger edges we had back years ago. So you can't talk the same in now versus the 1980s, even though the computer's taken over a lot of information that you can have alerts, and you don't have to be watching everything. You can I have a buzzer that I put a lot of alerts in, and when something buzzes, I look to see what it is, and then I know what to do. And it's the heyday was when there were certain types of things done. Even in the 80s and 90s, a lot of people did not understand options at all. They didn't understand how a three-way, you can do a synthetic stock versus a regular stock and lock in a profit. And now major operations, major firms have automatic computers for that with AI and everything else. So things have changed, but there's still a niche for people that find the niche that they like. Well, I still do probably anywhere from 20,000 to 200,000 or 300,000 shares a day but they're selective trades, and it's mostly mathematics with so-called leverage products. I use the leverage ETFs, and you have to know how that works. And I like the mathematic way of making money, not the smart way of being a good analyst and knowing exactly what a company does and count the number of trucks that go in and out of their factories and the boxes of product in and out and all that. I just like to play the math. And when you play leverage ETFs, that leverage factor allows you to make money just because of the mathematics of leverage.
Can you go into that with a little more detail? What is it about leveraged ETFs that appeals to you?
Well, let me give you an example. Let's say that you pick one of those products, and that particular product, it could be a financial ETF, it could be a leverage, a double or a triple. And what that means is it will move 2 or 3 times. A double will move double, a triple will move 3 times the value that the underlying product moves. So, therefore, if you have a product of $100, a particular ETF, you can sell it. Say it goes up 1% a day, and you sell it. You sell the one side, and you also sell the other side. You can sell the short. You can sell the long. So you're actually selling. Let's just, for a good example, is say over a period of say 3 or 4 months, it goes up 10% and down 10%. Well, if you did the regular ETF, you start at $100 and you end up with $100. But if you do it with leverage, you take a $100 product and you short the long, and it goes up to 130 because it's triple, right? It goes up 10%, so 10, 10, and 10. So it goes up to 130, and you shorted it, and well, you're losing on that side, but you're shorting the other side too, where it goes down 10%, down to 90, 80, 70. So now let's just say over the next period of time, it drops 10%. So now 10% of 130, as an example, is not 10 points. 10% of 130 is 13 points. So it drops 13, 13, 13. So that $100 product goes back to $91. And you started at $100, shorting it. So now it's back to 91 on the sell long side. On the sell short side, it went the other way down to 70, but now it goes back up 10%. And it doesn't go up from 70 to 80 to 90 to 100. It goes up 10% of 70, which is 7, 3 times. So now that 70 goes up to 91. So now you got the product that has given you 9% mathematical edge strictly because it moved around during any period of time. There's other factors you have to consider, but it went up 10%, down 10%. And here in March, there were some of the products that had done that in a matter of a day or two. And think about it, when you have a 10% movement on a triple, you're actually, if it goes up 10% one day, down 10% the next day, and now you've got 91 price on it instead of 100, you just made yourself 9%. So that's what I mean by mathematic game. It's similar to any of the mathematical blackjack games or mathematical poker games. You have to find where the edge is. Now, there's other things to it. You got to put in a beta of the product that you're trying to trade over a long period of time. What's the beta of it and the long-term movement that you can anticipate. And you kind of factor the math into that. But in simplicity, to keep it simple, it's strictly the professionals short these products, and the retail buy those products. And in the prospectus, it actually advises you never buy them for more than a day or two because you lose money over time because they will decay in value. But very few people take the risk to short these products, and that's where the professionalism comes in and understanding the math.
So essentially what you're doing is exploiting the tracking error of these leveraged ETFs.
Well, it's a mathematical, it's not an error. It's a real mathematical game. Kind of like blackjack is a real mathematical game. So if say IBM goes up 10% and then back down 10%, and if you're guaranteed to make money on it, why not?
So how long have you been trading these leveraged ETFs for? Like, when did you come across this niche?
Well, when I first did it was probably 10 or 12 years ago.
Okay.
And I did it for a while, and then I found out the clearing firm knew it better than I did. And as I was making money as the market, it zigs around. It moves up a half, down a quarter, up a half, down a third, or a point, and it moves all over. And they charge you what they call imputed value of interest and locate money to provide this product with you so that you can short it, because you're shorting both sides of the ETF. So you're paying a fee for that, and they can move that imputed interest of value around. If a lot of people started doing it, then they have to go out and borrow more from institutions that might own it. And these leveraged products, hardly anybody owns it long term. So there's a constant battle. One day they might charge you annualized 2.5%, another day an annualized 8%. And you really got to watch the math that is being charged to you. So the first year I did that, I put a bunch of money into it, and I thought I was making out pretty good. I checked it out. I was up $2.5 million, and I looked at the math of what the clearing firm made from me, and they made $3 million from me. So I just said, well, I tried to negotiate with them that I would continue doing it, but they had to cut back a little bit on what they were charging me. And after some discussions, they decided not to cut back, so I just closed everything. And I had like $100 million going on at that time, and within 2 days, I closed it down. Then they called me and they said, well, how come you closed everything? I said, because you wouldn't negotiate with me. So we could both make money. So I'm not going to play any game that you are the only one that makes money.
What is the duration of these trades? Before you gave, in your example, you spoke about kind of 10% moves. 10% moves don't happen too frequently during one day. Are you trading this over multiple days, like these positions or these trades? Do they have a duration of multiple days, or are you trading these through, smaller movements on an intraday basis?
No, you can put a position on that would be a perpetual position. And periodically, if the clearing firm is charging too much to secure the long ETF for you, then you would reduce it periodically. So the way the market works, one day you might be up 1%, and then the next day you're up 0.5%, and then the next day it's down 0.75%. And when I say it's up 10%, down 10%, the reality is over a long period of time, most of these products or most ETFs, the market itself is up about 6 or 7% on an annual basis. So you got to factor the mathematics into that. You got to look at the beta of the type of product you've got. And you also got to watch what you're getting charged for when they're charging you a locate fee and an interest rate fee. So basically, that's what I do anymore, rather than spend time doing a lot of work like we used to do, where their rules favored proprietary traders. I just try to trade the leveraged products that the rules haven't changed. Those that short it and can maintain it and carry a position for a number of weeks, days, years, whatever, you shouldn't make money unless you don't have enough volatility. Now, since February, late February, we've had some pretty good volatility in the global markets. Prior to that, last year, in 2019, I actually closed, I had it up to maybe 30, 40 million and dropped it down to less than 5 million because there was little volatility. If you don't have the volatility, you better start to get out of the position. If you have high volatility, you just have to manage it a lot. And you can't really do that if you don't have enough knowledge of how the math works. There's a lot of information on those kind of products, and you're warned about it in the prospectus. The products are made for retail to buy. What they don't tell you in the prospectus is that professionals tend to sell them.
So what do you do in those periods where volatility does drop off? Do you have other niches which you've found to exploit?
Well, I really don't like getting too involved with other issues other than I have done it with REITs and different things where they pay pretty good dividends and high value real estate. I'm not a good analyst, so I don't like to dig into all that. And I never really made a lot of money doing it because you'd always find out that the people that were putting together these products for REITs, sometimes they don't align their business model with the investors. And I didn't know that. They're not supposed to do that, but any business you get in, you better hope that whoever you're doing business with is aligned with your part of that industry also, so that you both make money. And when people put together a REIT, real estate investment trust, if they're not aligned with the buyers of those trusts, they will try to make management money that kind of defeats the ability for you as an investor to make money. And there's always been some people writing on those kind of things, but I don't like to get too involved with anything other than the mathematics, so I don't have to deal with people that have other interest in what they're doing, rather than just the model that they say they're doing. And that's sort of what I've done over the years with blackjack or poker or stock market. You got to understand what the other people in the industry, what are they doing? They're not there to just make it nice for you. They're there to make profit. I believe in capitalism. And rather than dig into like IBM or a car company or whatever to see what they're doing and all that, I'd like to dig into what the clearing firm does or what the brokerage firm does. How do they make money? They compete against other brokerage firms. They make money by selling order flow. They make money by charging their own customers. They make money by doing sub-penny trades that you can't do if you're not a broker. You can do sub-penny trades with your own customer, but you can't do it otherwise. So there's all kinds of different rules and regulations that favor the big banks of the world and the clearing firms and the broker dealers, and then the proprietary traders that have taken all the tests and understand a lot of that, so that you can't go back on the SEC or something and say, well, I didn't know about that. You believe me, they have some tough tests for people to get involved with proprietary trading. And anybody trying to do short-term trades really should become a proprietary trader, not a retail trader, because there's a world of difference.
Before, when you gave the example of the edge you've discovered trading around these leveraged ETFs, that was a great example of an edge you've discovered. I'd really like to speak with you more broadly about edge, just the subject of having edge. For you, what does it mean to have an edge in trading markets?
Well, in trading markets, you have to have an edge that in the long run will make you money, and that you're not just feeding a brokerage firm or feeding an exchange. The exchange makes their money by selling the information of the quotes. The clearing firm will make money by charging interest. They will take a margin account and take the stock that somebody has in a margin account and lend it out to other people. And then they charge a fee for that. They don't give you that fee if you're the margin account person. They keep that fee. So there's all kinds of little ways that clearing firms make money. There's all kinds of ways exchanges make money. There's all kinds of ways that some firms will buy and sell order flow. So you got to understand all that. Once you understand it, then you pick out the niche that you want to do. And for the most part, most people that have a mathematical or any kind of a real edge will want to get around the pattern day trading rule, which allows only about 6-to-1 leverage. And you can get around that because you get tested, you become a professional, you get whatever your broker dealer will allow you to do because you're actually using the firm's funds. You put up some seed capital. We have people that put up 50,000 or 100,000. We give them $1 million or $2 million to play with, but we monitor very closely what they're doing. But it gives leverage. So even on a small edge, you might have a 0.5% edge. But if you're leveraging it 20 times, that's a 10% return. So you got to prove yourself to be able to do that. But that's what an edge is all about. You don't have to have a big edge. In blackjack, for the most part, you hardly ever had more than a 1% edge. And I did pretty well sometimes when it was strictly a 0.5% edge or a 1/4% edge, because you can leverage yourself more by increasing your bet size when it's a 1% edge versus when it's a negative 1% edge. And you move. That's how casinos used to catch you. They'd watch your bet size, and now they have artificial intelligence that does that with a video taking a picture of what you're doing. And it's also card counting. And if your bet size is always higher when you have a so-called positive count, and always a low bet when you have a negative count, pretty soon you're going to get tapped on the shoulder and asked to, why don't you play another game? Because this game's not for you, at least in our casino. So we'd love to have you here, but we can't let you play blackjack because you play too well. And that's part of the business. And these days, I understand that's happening in the brokerage business too. You may have run into it where I don't know about Australia, but in the U.S., a whole lot of the internet firms have gone to zero commissions, and that's because they sell the order flow. But if you're too good with your orders, if they will find out, and the people that buy that order flow from them will find out who is really a good trader, and they're going to say, "Oh, we don't want that guy's trades." They start to bar him, just like they use the casino model. If you're too good playing against them, then they don't want you. Go down the road, play with somebody else.
I might just rephrase that question a little bit and sort of put a slightly different spin on it. For newer traders, let's say, what are some considerations for how they could seek out an edge in trading markets?
Well, they have to have a niche that they enjoy doing. An edge could be that they have worked in an industry for 20 years and they know everything about it. They have contacts within the industry. They can make phone calls and find out some of the things that is public knowledge. I'm not talking inside information or anything. That's one way of knowing about, as some of the top people will tell you, that trade what you know, trade the industry you know. You got to know that the more trucks that go in and out of a factory will tell you something. There's a lot of data that you need to find. That's why they have quants these days that are providing all that data for you, and you can pay to get that kind of data. But still, so many people have now gathered data based on such things as cardboard boxes and trucks going in and out of factories, and trying to guesstimate how the business is. That it's not near the edge it used to be, but that's an edge if you know your industry. If you have a background in the construction industry, if lumber goes up or down in price, how that's going to affect retail construction. So there's those kind of ways, and then there's the mathematical kind of ways of, like banks, they, for the most part, will want to lend long and borrow short, and they borrow money at lower interest rates and lend it out at higher interest rates. And everything seems to be kind of turned upside down in the last couple of years. In fact, since about 6 years ago, when Europe started going this negative interest rates, or Japan did actually 20 years ago, we now have negative interest rates. So the yield curve is, kind of sloped a little different than it used to be. But it used to be pretty simple for banks. They would lend long-term, they'd borrow short-term, pay 2%, 3% to borrow money and lend it out long-term at 6% on a long-term mortgage. That kind of edge has disappeared, and rightfully so. These days, there's a lot of information out there, and everybody has apps and cell phones to get any kind of information they want. You just go to Google and get whatever information you want. So the competition on a global basis for mathematical games, you have to be a little more smarter than they were even 15 years ago. You go back 30 years ago, banks really didn't they didn't know their own business, but they knew how to make money. It's easy to make money when you borrow at 3% and lend it out at 6% and leverage yourself. It's not kind of hard to lose money doing that.
How about the traders who came through the door of Bright Trading? Like, how were they encouraged to find an edge in trading?
We try to work with people if they don't have a niche that they want to, that they think they have an edge. We'd work with them. We work with a firm that called Stock Odds that has a database for use. Our traders are able to use it for free. They charge quite a fee for most people that are not with our firm. But if they're with our firm, you can get that without any additional cost. And it's a large database. And say you want to hedge yourself all the time, and which we recommend that you hedge yourself all the time. I would not short a triple ETF on one side without shorting the other side. If you short the long side, short the short side also. And it's just like I would not short GM without looking for another car manufacturer in a similar basis to go long. You might buy GM, sell Ford, or whatever. You're going to find those kind of things to hedge yourself, to give yourself leverage with the small edge that you have. And if you have a good knowledge of the regular automobile industry, you can make some good money with some good hedging with what we call pairs. And you have to have a methodology or database to be able to get that. And there's you don't need a big edge. You just need to leverage yourself on the edge you have.
So pairs trading was quite popular amongst Bright traders when it was at its peak?
Well, trading was very popular in we started the firm in 92 when they started leaving the trading floors. Luckily, I had experience in options and futures and equities up until that time. And then when people started hearing about us, they didn't necessarily want to be on a trading floor. Can we come to your office and trade from your office? Really? And sure, come on in. We'll show you what to do. And here's what it costs. And we'll try to help you. And for the most part, people that don't have preconceived ideas about what way the market's going to go will usually do pretty well with a niche that they can find for themselves, something they enjoy doing. If they know for the most part, on Monday mornings or on the last day of the month, certain things happen that don't happen the other days, they're going to play those kind of transactions. So everybody has their niche. We taught, for the most part, we taught everybody how to do pair trading back 20 years ago, 30 years ago. If you didn't know how to do pair trading, how are you going to get leverage on yourself? You have to do pair trading, trade a pair so you can take a small edge of say a half of 1% and turn it into a 5% edge, because you can leverage yourself with enough size to be able to get that half a percent to a multiple. So that's sort of what we've done. We grew to 500 traders, 490 traders, I think, at one time, and 42 trading rooms around the U.S. and a few people around the globe. And since then, artificial intelligence, high-frequency trading firms have gotten in. You're probably aware of Citadel and some of those. That it's really hard to beat them when they have microseconds to. They might do 20,000 orders in a second, and when you're trying to do trading, if you don't have our AI and high-speed computer and have a server right next to the venue you're trading with, you better have another edge. And that's what I do, is always try to have an edge, whether it's blackjack, poker, or options, or stocks, or a combination of everything.
Just a couple more questions for you, Bob. This one on the subject of mindset, and probably more specifically discipline. When I was preparing a few notes for this interview we're doing at the moment, I came across this quote. I think you were quoted in an article of some sort, and you said something along the lines of there were a lot of people trying to count cards at the time. The problem was 95% of the people that tried to count would lose eventually anyway. They couldn't handle the discipline. And I thought that was quite interesting because discipline's obviously a big factor in trading success as well. Can you speak to the importance of discipline and how you've managed to maintain a good level of discipline with your own trading and your own gambling?
Well, I learned the discipline back when I first started playing blackjack. You better have discipline in any kind of a gambling game. You might know you have a 1% edge in blackjack, but time after time, hour after hour, they keep beating you. And you get these runs once in a while. Same way in poker, same way in the stock market. We just ran up here in the U.S., I think 8 days in a row. And today, finally, it went to a downside. Well, how often does you go from a 300 plus point upside to a downside market in the same day? Not that often. But and if you don't have the discipline to say something is changing during the trading day or the trading week or the trading month, then you're going to lose money. And that's what happens. There's all kinds of different things, but you really need that discipline with those three areas of blackjack, poker, and trading. When I say trading, that's whether you're trading futures, equities, options, whatever it is, you have to understand what you're doing and not get upset. Things happen. You stay disciplined. So if you can't stay disciplined, then you get stubborn and you think you know more than the overall market does. The capital markets will defeat you every time. If you think you know more about that you should get a blackjack because the book says so, every 21 hands you should get a blackjack, and you've played 8 hours and haven't had one, now you're getting angry, and if you get upset, that blackjack's going to beat you. So you have to know what to look for and not get angry when things happen. When it comes back in the day, in the 1970s and 60s, actually in the 70s, there were some shady things that went on in some of the gambling casinos around the world. Most of that's all been cleared up, but I play high-stakes poker. I would not play high-stakes poker if I didn't have monitors, cameras on every game that I would be playing with. I learned that the first day I moved to Vegas. I got into a poker game and caught some people with some shady dealings, and of course, they knew I caught them, and they didn't invite me back, and I never would ever again play a private game in Las Vegas. I trust the casinos that they lose their license if they get caught with anything shady, so I always like to have their license there on the line when I'm playing within their casino, because I know that if they do anything shady, they're apt to lose their license, and I'm only going to lose a little bit of money.
I guess this ties in as well to tilt, and tilt's obviously a popular term amongst poker. You play a lot of poker, and that term is also kind of used by many traders as well. How do you avoid or at least manage tilt in trading and or poker?
Well, because I've played blackjack, I've played a lot of poker, and yes, tilt is something in poker that is more prevalent in poker because more people talk about it. There is also tilt in trading. You can't let tilt get to you. In poker, you better not, because other players on the table, if you got an 8 or 9-handed table, there's going to be at least 1 or 2 players that will make comments purposely to trying to get you on tilt. And you got to be able to know that and not allow that to happen. There's, in the capital markets, it just happens. Things happen. Long-term capital took billions of dollars and lost it, but they thought they wanted to hang on and not recognizing that things do change. You have to recognize when something changes, and it was not a shady situation. It was just something back when I think it was 1998 where something changed with the global interest rates. But those kind of things happen, just like the COVID virus in March. The whole world kind of went way down, and it happens. So you better be prepared and not over. When I say use the leverage you can afford to do, don't over leverage. Don't get upset because something happens like a new disease out there. Everybody that should know that roughly every 100 years or more often, these kind of viruses come along. So you can't get upset. Recessions come along. You can't get upset when you ride a bull market up and then all of a sudden you get into a bear market. You better recognize it within a few days anyway, or a few weeks. Don't just hang on for the next 3 years while you go into a giant bear market. And that's really, I guess I gained that in the 70s when I played blackjack. You could not get upset just because you weren't getting good cards and the dealer was getting all the aces and you were not getting any. Same way in the capital markets. If you know it's an honest game, just make sure you know where your edge is and study your edge. Make notes at the end of the day of what you did right, what you did wrong. And before you know it, you'd find out, oh, gee, I went on tilt. I didn't realize that. I went on tilt midday because I did this. And it was the wrong thing to do. And I didn't recognize it at first, but then I had done it. And I kept doing it because I wanted to get even. Well, you learn those things after a few decades or a few years of any kind of an industry that is risk-taking. Trading is a big risk-taking. So you have to... So we back in the day, and I'm talking 10, 15 years ago, we had a lot of training classes with new traders that came in and would teach them how to not go on tilt, how to have a game plan, how to have a journal, study all they could about things, not just what the regulations say, but also the trading. You have to understand, our website goes along with that pretty well, where we clear up a lot of stuff by just looking at our website that traders need, but most of them don't know they need it. When you go to some private broker dealer for retail, they don't care if you know anything. Just send us your money and you can trade. But if you want to be a proprietary trader, you have to have a game plan. And I would say check us out at stocktrading.com and take a look at our website and some of the things that we tell you that you should be checking into before you change careers or before you get heavily involved with any kind of a trading situation. So I've done that for many years with stock trading, and we captured that stocktrading.com website years ago, and it's been nice for us. And we've gotten an alliance with Stock Odds, another firm that provides databases for our traders, and we have one of the premier clearing firms that clears all our trades, and that's Goldman Sachs. And you got to bring to the table a little bit of seed capital. We'd give you a lot more capital to play with, but you have to understand the rules and pass the test, or the regulators won't let you do it. They want to know that you know all the SEC type regulations before you're allowed to have that kind of leverage that a proprietary firm can allow you to have.
Bob, just one last question to take us out here. And I'm quite interested to hear your answer on this. Do you have any self-imposed trading rules that you live by, which have served you well over the years?
I'm not sure I know what you're saying. We don't have any preconceived ideas. Everybody has an edge, one way or another, based on their life's experience. But they have to have the discipline, as you mentioned. In order to trade proprietary trading, that allows you leverage that retail doesn't, you have to have an understanding of the industry. There's a test for that. You have to have an understanding of the products you're trading, and you have to have the discipline and methodology of how you're going to do it, whether you're going to do it with an automated computer system, or you're going to point and click with a single PC, or you're going to flip a coin. Every Monday you're going to do this, and every Friday you're going to do that. I don't know. I've given up on trying to talk people into forgetting that edge, because that doesn't make any sense. Because sometimes they tell you, well, it's worked for me for 40 years, so I'm going to continue doing it. And sometimes I see that hey, it still works for this guy. Whatever works for you, you got to understand it. Don't copy somebody else if you don't know exactly what they're doing. I've seen people, well, Joe, he makes money all the time, and he let me watch him, so I just did what he did, but I lost money and he made money. How did that happen? Well, because he didn't teach you everything that he was looking at. You have to know what's behind why he buys and sells at the instant he does it, and you have to understand what you are doing. So that's I've taught. We used to have, like, every 2 weeks it'd be a 40 people class that I would try to get involved with, and my brother ran it back years and years ago. Like 15, 20 years ago. I'd go in for an hour or two in a week, but he was there constantly for a full week to drum into people's heads that it comes from them. A trader has to know what he's getting into. It's not a flip of the coin. Nothing in life really is. Is that anything else?
Yeah, no, that kind of answers it. I mean, I was more thinking along the lines of, what's a good example? There's some people who will say, if I have 3 or 4 losing days in a row, then I might cut my position size. I might reduce my risk to prevent further drawdown, etc.
Well, that's not a bad policy.
That's just an example. I was more just wondering if you had some sort of, some rules like that, or I'll never risk, more than X%, or etc.
For the most part, I don't use that rule. I learned in blackjack you don't use that rule. When things are going bad and you're pretty darn sure you got a fair game, you get higher leverage if you're losing. So when I walk into a blackjack table, I hope I lose the first 15 minutes, because now they let you bet with bigger bet ratios. If you're betting anywhere from $10 to $50 and you're losing, now you're betting from 25 to 500 and you're still losing. Now you get to bet from 100 to 1,000, or up to $2,000 or more, and they don't bat an eye because they've seen you lose. And so I don't buy into always reducing. Not in blackjack. In poker, yes, you might. If you're going quite a long time in poker and you're losing in a particular table and you don't know all the players, you probably better cut down, because maybe some of the players are better than you, and you're not aware of it. It's okay to play with players better than you if you're aware of it and you know that you have some knowledge of that player and some of his idiosyncrasies and some of the reasons he goes on tilt, and you will know when he does go on tilt. Then you stay around and you work it, but the game. But if you can't figure out where the edge is eventually going to come to you in a poker game, it's best to cut back until you say, well, this game's just not for me. I'm going to move to another table or give it up for the day. In the capital markets, when you lose 3 or 4 days in a row, that's why you should keep a journal. At the end of the day, write down the things you did good, the things you did bad. And after 3 or 4 days, you have 3 or 4 days in a row and you're losing money. You don't necessarily want to cut your risk and cut your leverage, but you might. If you haven't figured out that the market has just changed due to some capital market situations, either gold went up or oil went way down or up, or some commodity happened or something happened in the world that changed the capital markets. If you can put your finger on that, there's no reason to change your leverage. You might move it around a little bit, but if you can't figure out what changed, then I go along with the idea of reducing your leverage.
Okay. All right, Bob, well, let's leave it there. I must say I really appreciate you taking the time to speak with me this afternoon. It's been quite an honor, so thanks very much.
Okay, you're welcome, Aaron, and thank you for the podcast, and I hope you get some of your traders to understand how to make more. Don't get upset, don't go on tilt, get that edge, and make some money.
I'm sure. No, it's been really great. What's on this evening? Do you have a poker game lined up?
No, these days there's so much happening in Las Vegas with all the COVID-19 that, we get a lot of tourists, so there's still a problem in Vegas that a lot of the poker tables are not in action. And there's so much with the volatility. The volatility is greater than it's been in years, so I'm taking advantage of it, and I'm trading anywhere from 6 to 12 hours a day with the high volatility. And it's I get plenty of action, and it keeps the days going by pretty fast without having to leave the house too often. I don't know how it is in Australia, but here in the United States, there's a lot of hot spots, and Nevada happens to be one of those hot spots these days because our industry, casino industry, thrives on tourists all the time, and you never know how many are already sick by the time they get here, and they're here to have a good time. They're not here to be nice and wear a mask and not, get into a party mood. So we have to be extra careful in casinos these days. And I haven't really gone in many casinos at all in the last since March. I flew back from one of our really large poker games in Russia in March, and that was the last cash poker game I played. Early March, we decided to get a private plane back to England and get back British Air from there to U.S. before they closed the borders on other countries' people from coming. Since we were U.S. citizens, we could have got we got in. Me and some friends got in the last day that we could get back without having to go through a whole quarantine thing and everything. And since then, no poker, but it's been a lot of nice trading.
Oh, right. Yeah, well, I guess that's the nice thing. You've got plenty of action to take advantage of in the markets. So good stuff. Hopefully you can get back to playing poker soon enough as well. Bob, I'll let you enjoy the rest of your evening. Thank you once again. It's been a real honor.
Okay.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's good, folks? Welcome to the show. This is Chat with Traders 204, featuring Brian Lee. 3 years ago, Brian, a former esports gamer, took a leap into day trading equities. Having since developed a talent for shorting the backside of inflated moves, paired with a great emphasis on risk management, Brian has experienced tremendous growth both financially and in terms of market knowledge. In this chat with Brian, we go over his first year challenges and overcoming such challenges, the time he lost it all and how he bounced back, Brian's most frequently traded setup, and a detailed discussion about the use of R as a risk model, plus more. As you'll hear towards the end, besides sharing his thoughts and comments on Twitter, Brian has also published several blog posts which are worthwhile reading, and he occasionally uploads videos on his YouTube channel. Links to all of the above can be found at chatwithtraders.com/204. And now, coming to you from California, here is Brian Lee. Before trading, you were a pro gamer for around about 10 years, I believe. That must be like the dream job for so many teenagers out there. What was that like?
Well, it was really, really interesting because I dropped out of university to pursue it, and it gave me a lot of opportunities to travel around the world. So at a young age, I was able to visit like Korea, China, and Sweden. There's all these different places I thought I'd never be able to go to. So the experience in of itself was really nice. And it's really fun to play in a team environment because there's a lot of camaraderie. Like a lot of the guys, I loved meeting with them at the hotels and everything. And it was just like a lot of fun. And in a lot of ways, it was similar to kind of what I would imagine being like a rock star is like, because wherever you go, like people want to get signatures and take pictures with you. And it was kind of a rush. And actually, like when I quit playing pro gaming, I was wondering like how could I find something to replace it? Like there's all the highs are really high and everything like that. And trading was like one of the only things that really, really matched it in terms of how passionate I could be about it and how I felt about it. And I really loved how it was mirroring that like competitive aspect in a lot of ways, but just as if you're just a single player in the team.
So when you were going to these other countries, were you playing, like competing in front of a live audience?
Yeah, a lot of times they would book out venues, sometimes actual like basketball arenas, and then they would just fill it out and have you play on stage. And it was pretty much like a live event where they had hosts and casters and everything like that. And then it was broadcast online as well.
That's crazy, man. And what about the prize money? I know there's some big money being thrown around in esports nowadays. Were you able to pick any of that up?
Unfortunately, I didn't get it pick up that much because when I started in esports, it was kind of a budding industry. And like just to put into perspective, one of the last major tournaments I played in, we got top 8 and made like 50,000, and then the next year was 500,000 for the same exact place.
Oh no!
So, I mean, now people are making millions and multi-millions on if you place really highly, and like a lot of people would wonder why would you stop playing if the money just went up significantly, and it's just by that point I was getting older and a lot more burnt out, and I just couldn't keep the same motivation because I had. Like when I was playing for passion. I didn't know it was going to turn into what it turned into now. By that point, I kind of reached a lot of my goals because I wanted to compete at the biggest tournament, it's called the International, and they hold it every single year, except for this year because of the pandemic. But they hold it every year, and the allure is that every year the prize pool gets bigger and bigger. And the first year they had it was first place was $1 million, and now I think first place is like over 20 million.
Wow.
For the team that wins. So it grows every single year.
That's epic.
But like my goal at the beginning was just, I want to go to that tournament. I didn't care if I got 16th place or first place. I just wanted to be there. And so once I put everything I had into accomplishing that goal with my team, I just, it's like you fulfill your dream. And then now I wanted something else.
Yeah, I understand that. Man, those are high stakes though. That's incredible. Is it common for pro gamers to transition into trading later on? I mean, it kind of seems like a good fit. I don't know if you've heard of many people doing that.
Well, I don't know that many people who trade to begin with.
Okay.
It seems like a very obscure kind of thing. And I've talked to a couple of my friends, but I don't think they're really going to get into it. It's like I understand where a lot of poker players come over here because I think they're all about the money, but I think with professional gamers, it's just it's full on passion for them. And a lot of times they get into it when they're pretty young. So they don't really think that far ahead. They just kind of go for the ride.
Yeah, fair enough. Yeah. So when you did start getting into trading, I'd be quite interested to hear a little bit about your experience from year one. So how did you go during that first year?
Yeah, my first year, I was pretty much full-time straight away. At least that was my plan, because I wanted to, I believe that, if you say you've been trading for 3 years, but you just kind of on and off, you might not be as experienced as somebody who gives it their all every single day for that year, because it's about how many hours they're actually putting into it. So I was thinking that if I wanted to give this a really good shot, I would be going 14 to 18 hours a day, just pushing myself every single day. And hopefully I can catch up and just be one of those superstar traders. So I looked up to a lot of the traders now that are very successful, and I wanted to be like them. I learned very quickly that in the first year, I had no idea what I was doing, because the year prior, I had been paper trading. And, when there's no emotions involved, it's really easy to say oh, okay, well, I can make $1,000 here. And if I do that every single day, then I'll be really, really well off. And the reality is, once you start trading on the broker, there were so many different things. You have to understand the platform. There's liquidity. You can't just get instantly filled and get out immediately. And I realized that a lot of the things I was learning was flawed. So I had to really start over from the basics and figure out, what am I doing here? And a lot of times when you first get into trading, you're pretty much a perma long, because that's the most obvious thing. And I was attracted to a lot of the short-term type of scalping trading because it made a lot more sense to me. And I thought that, other traders, they were up for a lot of risk because of their time horizon. And whereas if you're scalping, you can just book those gains right away and just walk away. And I learned that was very hard as well for me. It was super difficult. And I just bought a lot of different education, trying to figure it out. And later realized a lot of it was kind of scammy. But I learned one or two things from each of them. I was part of these pump and dump chat rooms where you start to realize that they're kind of moving into different stocks because of momentum, but in a way you're creating the momentum yourself. And once I started to learn why most newbies were looking at certain stocks, it helped me either avoid them or be kind of contrarian to them. And I think that I short penny stocks now. So a lot of times people who short penny stocks like have that realization at some point that if they just play the opposite side, there's an edge there. And that's kind of what got me to consistency once I started short selling. And then what really, really changed everything for me from being a losing trader, just hemorrhaging month after month, was learning risk reward and risk management through R multiples, and then also applying like a very special compounding technique, which I developed over and over the years. And like kind of now I feel confident to say, since I've been through it, like how somebody who's new to the game could minimize the risk and also size up and increase their risk in a very systematic way that I feel is very, very good for a new trader.
Now, how much did you start out with when you got into trading? Like, I know that PDT is kind of a bit of an issue for many traders in the US, retail independent traders. Was that something you had to, try and get around?
Yeah, well, I had just enough from gaming to be over PDT, and so I just put everything I had into it. I think I started around like 30,000 or so.
Okay. And what about the losses that you were taking that first year? Were they quite controlled, or were you, having sort of blowout losses from time to time?
They were kind of all over the place because at some point I realized, well, they were all over the place because initially when I was paper trading, I thought I would just get in with a large amount of shares and get out really quickly and just bank it that way. And then I learned really quickly that I was going to blow my account up doing that. So I sized really, really down. So that even when I had a big loss, it was still not that big of a deal. And I did have to refund it a couple times just to stay over PDT. And I just made sure that as long as I could lose like 100, 200 times, that I wouldn't hit that $25,000 mark.
I've heard you speak in the past, or maybe this was from your blog. Either way, you had mentioned that one of the things you struggled with early on was poor entries and also chasing. And I presume those two probably tie into each other quite well. Can you speak about why that was a struggle for you, maybe how you went about improving these aspects? And also when you talk about a poor entry, how did you judge what was a poor entry?
Well, yeah, poor entries for me was a lot of chasing, and I attribute a lot of that to just overcomplicating how much of the level 2 that I need to incorporate into my own trading. And because everyone talks about reading the tape, and so naturally I wanted to learn, and so I was just watching it very intently. And what I realized is that the tape moves really, very quickly, and a lot of times you don't want to miss the trade. So when things start accelerating, it kind of excites you, and emotionally I just feel like, oh, I'm going to miss it. So I just would slam the bid and just get in immediately, compared to letting my order work and wait for the better opportunity. Even though I knew that I was going to get a worse price, I just want to be in the trade at all times because I have kind of a FOMO issue, and I still do today. But the main thing that changed for me and how I developed from that was I tried all different types of things. Like I use Thinkorswim platform, and you can kind of change the colors of the bars and add different types of indicators. So I literally tried to black out the bars that I didn't want to be entering on. So I made every candle like red, and then the ones I want to enter on, I made them green. So I was hoping that would change things, but it didn't affect me at all. And then eventually what I did was I decided that I want to go full systematic in terms of my entry and exit. So I developed a system where once I saw an entry signal for myself, then that was the time to put out an order. And just from back testing it, I knew that from the point where my entry signal triggered, there would be a sort of a bounce for me to get in as long as I wait for it. And I just started placing those orders day after day, and eventually I would just keep getting filled because, I picked like a modest kind of, I could try to top ticket on the bounce, but instead I just put a modest level where I'm for sure going to get filled. And that helped a lot so that I had more consistency and I could believe in it. And eventually I just built into this full systematic entry criteria, and that worked really well for me to fix everything.
I'm making a note here to ask you about the systematic part of your trading. So we'll come back to that in just a moment. I would like to ask you though, like how long was it, if we're talking time frame here, how long before you actually did start to gain some consistency and also, some confidence in your ability to be able to trade well?
Right. It took me a year to finally become consistent, but it was with a little bit of money. So at that point, I was really discovering myself the first year and just learning the rules of the game, getting that screen time. And then in year 2, I started to see consistent results. And then that was really, really working for me. And it built a lot of confidence, but it didn't really prepare me for some events that had me draw back, like pull back a little bit and draw down. And I actually lost like 50% of my overall gains during a really hot sector with cannabis, because in Canada they were legalizing it and it was a month out. So pretty much every day there was some kind of cannabis sector running, and normally they would be good setups for me, but I didn't understand how much of a sector momentum can influence the trades. Even though the stocks were technically garbage, they would still continue to go up and up and up every day, which made me feel like the risk reward was really good and that I didn't want to miss it. So I just kept fighting those and taking losses. And at that point, I realized that it wasn't really about making the money. It was just about protecting it and figuring out how to filter these trades out. And like I really started to hit it off in early 2020, because at the end of year 2, I actually blew up my account. So I lost all my profits up to that time, and I was very consistent throughout the whole time. So in year 3, I set a lot of different systems and rules to protect myself. Like most notably the max loss on the day. I never heard anybody talk about it really, just how to protect yourself from these blowups. Because on a lot of the tickers that I had trouble with, the main issue that I had was that I was revenge trading them, and I was getting emotional because I felt like, oh, I'm right, but me being right doesn't mean that I can just ignore price action. And in some situations, I was growing way too large, so I would not accept the losers. And then I started averaging down, and then sometimes I would win, which further made me want to keep doing it, even though I knew it was wrong. And I just read like all these books about how to manage that. And I read a lot of blogs about how traders dealt with blowups, and honestly, none of them helped. And eventually, after just thinking about it for months and months and months, I just said the max loss was the only thing that was going to protect me. Because on a lot of these setups, they're good setups. I have the right criteria to get in and everything like that. But it only takes 1 or 2 mistakes to lose everything. So once I did that, once I implemented the max loss this year, I've never really had a big loss. And I feel very confident now about my ability to just walk away and understand that I don't want to go through that blow up again. And so now, like my equity curve is just parabolic, just straight up, and it doesn't. I've been waiting for the pullback, and it's just not coming.
We'll touch wood.
Yeah.
Did I hear you correctly when you said that it was towards the end of your second year trading where you lost pretty much all your gains?
I lost almost everything. Yeah.
So how much money are we talking there? Do you mind sharing?
Sure. At that point, I grew my account from PDT, and I think I lost around 100,000 or so.
Wow. How did you move forward from that? That must have been quite a setback.
Yeah, it was really tough, because the part of the reason why it happened too was because I was visiting my my fiance's family for Christmas and Thanksgiving, and I told myself I wasn't going to trade because it's not my environment, and I ended up just trading anyway because of the FOMO and opportunity cost and all that. And then I remember when I was sitting in the room and my broker was sending me emails about getting margin called and having to refund the account and everything. I everyone was asleep in the house because it's really early. I didn't want to get on the phone and be like talking to my broker and kind of panicking in front of everyone. And so instead of that, I just froze and let it balloon. And then eventually they just started marketing me out at the top of this trade, just completely blew up my account. And I just turned the computer off and went to sleep. And like when I woke up, I had to literally act like nothing was wrong for the next 2 weeks while I was there. It was really a terrible thing to go through, but like part of me as a professional gamer, I've gone through really bad things as well, where I've lost so much that I know how to take a loss and just refocus. And I took a little bit of time off to figure out if I wanted to continue or if this was just a dream gone wrong. I decided that ultimately over time that I was doing really well. I can do this. And I think very long term. So I was thinking if I was going to make this into a career, that might not be the biggest setback. I might be able to come back from this and make a lot more, because I know that trading can be very lucrative and I've seen what other people could do. So I got lucky in a sense because I didn't have any other options at that time. Like eventually I told my fiance and she was like, no, I'm not going to fund you. You know, if you want to keep trading, go work. And at that point I didn't have a college degree or anything. So it was just like I could Uber or work at a Starbucks or something like that. And I knew that's just going to take way too long. And the potential of trading is high. Fortunately for me, it's not fortunate and unfortunate, is like my father passed away towards the end of that year as well. And so he left some life insurance money behind. And with the blessing of my mom, she allowed me to refund my account just to the bare minimum. And from there, I took it extremely seriously. Like I couldn't lose at this point. I couldn't afford to lose. I couldn't afford to make mistakes. I set out my business plan. I figured out that instead of letting this account just grow like a high score in a video game where it's like, I want this huge account, why don't I just pay myself consistently? So every time I would go over like 30,000, 40,000, I would just start wiring out all the surplus and banking it and treating it as a job. And since that point, I've only wired back 3 times out of 61 times this whole year. And it was like $4,000 or $5,000. One of them was a mistake because I had an accounting error. So I've just been treating it like a business, wiring out, not sizing up too badly, keeping those max losses, taking it, treating it as a professional, and just doing it for my family, doing it for myself, and not for superstardom or to be the best trader in the whole world.
Well, that's really impressive, man. That's quite the comeback. That must have been just such a blow at the time. Yeah, you've certainly bounced back really well, so good job. I would like to ask you about, and I think this is probably something which a lot of newer traders perhaps struggle with, is how did you come to discover your best types of trading opportunities? Like, how did you identify an area to hone in on?
Yeah, so the way that I backtest is not the same as how people think when they review lots of data and a lot of data entry and analysis of that in Excel. I mostly just take it day by day, where I will focus on a niche. So in this case, I was focusing on small caps, and then I would just take note on a notepad every day of like what fits my criteria, even though I didn't trade it, or if I did, then I would go back at the end of the day and screenshot the 1 minute, 5 minute daily, and then I would just make sure that I noted the day that I ran and everything like that. And then over time, I just kind of discovered the patterns that I kept seeing every single day. And then once I recognized the pattern, it was more about maximizing that pattern and trying to fit it in terms of risk reward. So I'm always looking for a 3-to-1 risk reward at least. And then once I built that system, I was able to make different calculators on Excel where I could figure out, like, if I enter here, if I risk here, and I take my profit here, then this is a good trade. And then I just would constantly go back every single day and apply that system to all the trades since the very beginning, or like a month back. And then eventually I started to figure out what's working for me, and then how can I maximize these trades. And a lot of it was in part due to Twitter. I was able to connect with a lot of different traders who were trading a similar niche, and we kind of built like a brotherhood where we had a small group of people in Discord and we were just talking about our setups and trying to drill into them together. Some people were good at data, some people were good at reading the tape, some people were good at volume and stuff like that, and we were collaborating. And eventually we just kind of figured out what works for each of us. And then unfortunately we kind of all grew apart at this point. But during that time there was a lot of growth because we could take in a lot of information, share a lot of books and resources, a lot of, chat with traders podcasts, which one's good, and then just discuss it as a team pretty much after hours and pre-market. And then that helped a lot for me to develop personally.
I really like that. I get a bunch of emails from people asking me, like who's a good mentor and, what's a good course to buy and all that sort of thing. And I think what you just described there is probably better than all of that. Just being able to collaborate with a couple other traders on a similar journey to you, share ideas, bounce, different ideas off each other and grow together. I think that can be massively helpful, as it obviously was for you.
Yeah, I think I definitely recommend finding people who are in a similar situation to you. And, sometimes they all say like you can pick someone slightly better than you, someone slightly worse than you, and then you can teach so you learn yourself, and then you can learn from the better trader. And a lot of the people that I was friends with back then, now they're really great traders today. And it's cool seeing how everyone goes in different directions. But the friendship that we have is really strong. And, even though they're in different places, like sometimes we can talk about what they've learned and what I've learned and just kind of share that moving forward. So we're kind of like growing together at the same time.
Absolutely. Yeah. Yeah.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Brian, would you be able to actually talk through one setup in particular, like your most frequently traded setup, kind of your bread and butter go-to play?
Okay. I love trading stocks that are trash pretty much with dilution. So most penny stocks in North America, I'm not sure about around the world, are relatively greedy companies that need money. So you can check on their burn rate monthly for cash, and a lot of times you'll know that they need capital very badly. So they'll start diluting, and in order to give themselves a premium on that, they'll release some kind of bogus PR and get people excited. Sometimes they'll take advantage of sector momentum. For example, I saw once when cannabis was running, there was like this cigar company that just all of a sudden said they're doing like weed stuff. Or I think it was this. No, it was actually more ridiculous. It was a cigar company saying that they had blockchain technology, and their stock ran up like multiple days. And so whenever there's trash that they're manipulating, and that they have dilution, and they have a very, they need capital badly, then you can anticipate there's going to be a supply-demand imbalance. And so I look to take a contrarian approach to those by like counter trend trading. So I'll try to scale into the front side of these moves, and then add into it as it starts confirming that's going to start fading and that they're going to start unloading supply. And usually I'll fade that in a mean reversion sort of style. So I just kind of, in my style, I have a systematic entry, and then my exit would be based on what I consider the mean. So you can really pick anything as what you want for mean. Some people use VWAP, some people use moving averages, some people use daily levels, etc. And then once you've determined that, you just run that scenario over and over again. And it's really mostly about fundamentals and pattern recognition. It doesn't come around that often where it's just my A++ setup where they have fresh dilution that they're going to use. A lot of times they run them up and they know shorts are interested, so they'll start blowing through high day constantly and just making people get squeezed. And occasionally there'll be a haymaker type of situation where they're just going to run it up thousands of percentages and people are going to get margin called. And I know that situation because I've been in it. And to me, really, trading is not really about, like, you have your pattern, and you want to maximize your pattern to have the maximal profit, adding to winners, etc. But at the end of the day, a lot of people who trade this particular strategy, they have no max losses, they have revenge trading, they have emotional trading, and then they end up losing tons of profits in just that one or two plays, and then they just get reset to zero or they just can't trade anymore.
Yeah, it's easy to get your face ripped off if your risk management's sloppy. Can you talk to why dilution is so important with this type of play you've described?
Yeah, because in trading, if you just break it down to supply and demand, at some point, if there's overhead supply, it's going to cause the stock to just fade because there's no one else left to buy it. And a lot of times these stocks are very broken. So if you look at the daily charts, they're just downtrending for years and years and years. And you know that not only is there going to be supply from dilution, but there's also going to be people who have been bag holding these stocks who want to get out for break even or just minimize their loss, or they just give up over time. And just knowing that these companies are very toxic by their nature, it helps to identify that there's an edge there. And one way you can kind of tell is that in the stocks I trade, a lot of the people doing the deals in the background, the underwriters for that dilution, you'll see the same names come up over and over again. And you can start to identify like, hey, I've seen this guy dilute, and usually when they're doing it, they have a certain style. And so you can kind of figure out which ones are going to be really toxic to the shareholders and which ones are actually going to be a little bit harder to trade.
With these types of plays, are there any variables that contribute to a higher probability trade?
Definitely when you want to see those broken charts where pretty much every time that it spikes up, it gives back most of its gains, or that I like to say like the cat's out of the bag, where maybe the first time it ran, it went super parabolic, but now that it's faded back and mean reverted, the next time it bounces, some people call it bounce short because it's bouncing up into the prior levels. And once it bounces up, when people look at that, they understand that beforehand the setup failed. so it's more likely to fail. It's not going to be that next unicorn stock. So it helps to discourage people from bidding it up to extreme levels. And so there's an edge for short sellers where you kind of know that the sentiment is in your favor.
So when you're trading these types of plays, how do you do so in a systematic way? Like, what are some of the rules that you have in place that removes some of the, excessive need for decision making to get you into these trades?
On my Excel, I have a calculator where I'll input different price points that I'm interested in. So it might be Hive Day, and then I have my price target, of course, and then I can calculate kind of where I want to enter for an optimal risk reward, where I'm not risking too tight, but I'm also not risking too wide. I base my entries on trigger, so I use a couple of different indicators where I customize it myself to kind of fit the patterns, and then once I get a signal, it's pretty much just put the order out right away. And the reason why I can trust it, why I have confidence, is because I've back tested those signals over years of trades, just because I have all those screenshots that I saved, and then I'll just bring up my chart and I'll input all my different indicators on it, and then I'll just flip through them and I'll see like, oh, it worked here. Oh, it didn't work here. It worked here. And then I slowly just tuned it to the values that works for me. And that has been a big helping point for me in terms of systematizing my entry and exit. And just because I'm backtesting it that way, it's like I'm just gaining experience as I'm doing that, and it builds that confidence for me to just hit the button. But I think the main reason why everything works out in the end is because I'm really good at maximizing the moves. So I'm a very patient trader, and like my win rate is very, very low. It's like at this point 26% or so, just on a per trade basis because I'm cutting a lot of starters. But whenever I win, my average winner is around 6. So that means sometimes I'll have 10, 15 or whatever. And when you have when I emphasize risk reward and I take the edge away from just having a high win percentage, it helps me feel more comfortable to just take the trades without any emotion, because I know that I can be profitable with a very low win rate as long as my average winner is just exponentially greater than my average loser. And that's what's giving me the most edge, is because I don't look at a stock and say, oh, this is going to be the one that makes my year. I just look at it as a drop in the bucket, as a series of trades. And every single trade, if I lose, and I lose, and if I win, then it's going to be a big one. And then over time, I just know that from the math, from all the statistics about it, it's just Lone Stock Trader has a really good blog on Twitter where he talks about how to make it impossible not to consistently make money. And a lot of it has to do with risk reward. So I'm not concerned as much with win rate. And as long as I have a good risk reward, then I feel confident that I'll just keep growing and growing.
We're definitely going to spend some time on this risk model of yours in just a moment. I'm not sure if I didn't catch it, but how do you actually generate these systematic signals for where let's just focus on the entry for the moment. How do you actually generate these systematic signals for where to enter into these types of plays?
Right. Yeah. So it's pretty much just from from the indicators. So I have custom indicators, which I'm not going to share, but basically, if you throw on any indicator, or you can throw on several indicators really on a chart, and just go over every single stock that fits your criteria. So every day, as I'm writing these notes of all the tickers that I potentially wanted to trade, that's building a database of stocks that fit that criteria that I'm looking for. So I know that in the future, as long as I have a large enough sample size of those trades, if I input the same indicator on those new trades, it's likely to work as well. And it doesn't have to work a lot of the time. It only has to work more than 50% of the time. So that takes a lot of the burden away from me for finding like a super, super amazing entry. The way I did it really was just you think about what the average person learns when they're trading, right? So when I learned trading, a lot of people were using different indicators like RSI, MACD, simple moving averages, exponential, right? And so what I did was I tuned indicators that I know people use, and I either tuned it to be slightly faster, more aggressive, or slower, depending on the situation. And that way, I'm kind of countering the average mentality. So the average trader is going to look at something, and if I'm that much faster than them, just by a little bit, I'm going to have an edge on that trade because I know what they're looking for.
Would you say you're a lot more dependent on these indicators and custom indicators that you've developed as opposed to level 2 and reading the tape, etc.?
Yeah, I don't actually have to read the level 2 or anything when I'm trading, because once I enter the trade, I set my stop, and then that's it till my price target. So, over time, of course, I've picked up things just from watching my screen, and it does help in a lot of ways. Sometimes there's like this discretionary approach that you can kind of input into the systematized approach, where you can identify whether there might be a buyer or seller, and you can prematurely exit the trade because you identify something. That does come into play sometimes, but overall, if I wanted to, I don't have to look at it at all.
Okay, that's interesting. Well, on that note, let's get into your risk model. Let's really dissect this. So you use the concept of R. Can you just briefly explain what is R for anyone who's unfamiliar with the subject?
Yeah. R is just how much money you want to risk per trade if you lose. So if you set your stop and you want to lose $100, you have to position size your share count so that once it breaches that level when you cut, you lose that exact amount of money that you chose, give or take slippage and whatnot. But this helps to normalize your trade outcome so that every single time you lose, you know how much your average loser will be, so that you can focus on how much your average winner is going to be. And a lot of times people choose a safe number such as 1% of your overall account. In my case, I couldn't choose 1% because if you're trading for PDT and you have a $25,000 account, you risk 1%, it'll be easy to fall below. So you have to choose a slightly lower number. Sometimes you have to kind of, the trick that I tell people is that what you do is, if you're in that situation, is you make a number out of thin air, like 10,000, and you take 1% of that, and then you grow that number. So in terms of R, you want to lose a certain amount of money per trade and keep it normal. That's about it for R.
So how do you measure a unit of R yourself nowadays? Like, is that based on a percentage of your account, or how does that work?
Well, initially I was compounding my account. So every single day I would take so if I had $10,000 as my imaginary account value and took 1% of that, then if I made a profit or loss on the next day, I would just take 1% of that number. So it would go up or down. And then eventually I got to the point where I learned that initially from blowing up, like my compound grew too large for my account size, and it was just getting really ridiculous in terms of slippage and everything. And because when you have a high risk reward, like if you have 3 to 6 average winner, it's very easy to start skipping R's like in a natural way. So like if you're risking $1,000, sometimes the next jump might go to like 1,200, 1,500, and then on top of that, I was winning some trades where I averaged down, and so I was making a lot more. And then I continued to take my R percent of the account from those gains that were outsized, so they would increase the R way too dramatically. So I learned that what you have to do is you compound your account until a number that you feel is uncomfortable, but you want to be at. So for a lot of people, you just pick a whole number, $100, $500, $1,000, and then you just work towards that with your compound. And then eventually, what I call it a freeze. So you freeze at that point, and then you give yourself a good amount of time, like a month, 2 months, 3 months. And once you get used to that level, I just bump it up to the next logical level. Like if you go from 1,000 to 1,100, 1,200, or you can go up whatever increments you want, whatever feels good to you. I think compounding works really well in the beginning, just so that as you're growing, as you're learning, you have like a real-time reflection of your performance, and you're also scaling your risk down when you're losing, but you're also scaling your risk up when you're winning. And so it makes it easier to get to your goal. And then once you get to your goal, a lot of times you don't really need to push it that much, because you have to get used to seeing the numbers. You have to get used to seeing how much you make, how much you lose, and really like make that part of your identity. And one of my good friends is he works for a fund and he's a manager there. He's been trading for 20 years. He told me that you have to you have to see your bank account, you have to see the gains, and you have to feel like you deserve it. Because a lot of times when I was growing, I was like, oh man, this is a lot of money for me, or that's a lot of money to lose, and I was uncomfortable with it, but I kept growing despite that. And that's what caused me to have those emotional issues where I was revenge trading and whatnot. So like I learned to just find the level that you're comfortable trading for a while, and then once you feel like you've accepted that as that's your new paycheck, that's your new life, everything like that, that's when you can move on to the next level. So that's what I've been doing.
So do you trade the same dollar value of risk on each trade? I know some traders, when they feel like they see something which is a good opportunity, they might hit that a little harder. How do you treat that type of scenario?
Yeah, if there's a setup that I'm really confident in, my A+ setup, then I will double down on it. I'm not sure how much I want to push it, but for the moment, I've been going 2x's on that. But for most of the trades, I do keep it the same, because I find that when you see a lesser setup and you say, hey, I'm going to risk less money on it, when you win, you're not going to feel that great about it when you win. And when you lose, sometimes you want to just add on those shares, or when you're winning, sometimes you just want to add those shares on to get your normal size, but then you add it at a later stage and it screws up your whole trade.
Right.
Or like when you lose, it's just I don't know what you learn from it really. Like I would rather lose everything that I'm risking, so that when I review it, I can say, okay, this is just a trade I should just avoid in the future, not trade it because I feel like it. And I feel like that will have a better impact on your bottom line. Because for me, I think the problem with a lot of traders when they're starting out is that they vary their size so much, and they have very inconsistent results with that. Because like if let's say you took a big loss and then you say, okay, the next day I'm going to size down, then it will take you so much longer to make back that loss. And even if you trade well, you're going to have that emotional component of like, I'm down this much. Whereas like when I trade, even if I take a black swan event, like if I lose 10R on a trade, say it got halted or it just spiked past my risk or I got emotional, then with a 3-to-1 risk reward, I know I can make that back in 3 trades. At this point, I have 6-1 risk reward, so I can make it back in 2 trades, even if in the worst case of scenarios. So for me, I'm not really concerned about losing. I'm more concerned about winning big. And so adding to winners is good, because you're not it's a lot more hesitant to go double size. So you're going to really want that setup to be a great setup. And so like I don't find myself feeling tempted to always size into things. If I think it's a really good setup for me, then I'll double down on it and I'll just take that risk. Because worst case scenario, you'll take -2R, right? -2R, you make that back in 1 trade. It's fine. Even if I get maxed out on the trade, like if I lose -6, -8R, I'll make that back in 2 trades. So, but if I win, sometimes I'll make 12, and in some cases I made like 20R in the trade. So I know that that's going to really set me ahead, because if you make 20R, then that basically means that the next 20 trades you take, if you lose 1R every time, you could lose 20 times just to wipe out that gain. So for me, it's just about pulling ahead and keeping myself ahead and just normalizing every single trade as much as I can. It's just a drop in a bucket in a series for me.
Right. So you're not really someone who's going to put on like a smaller starter position with the intention of adding to your full R size, if it starts to play out.
That is what I do. Actually, I started in really small. So in my system, what I have is basically I have a starter position. So it's like a aggressive signal that is very iffy. I mean, in terms of it's not always going to work, but I want it to work very quickly. And if it does confirm in my price action, then I'll also have a secondary signal that says, okay, now you go full size. And then I also have another signal that tells me like, okay, add to this winner. Because I'm more or less like trading the trend on kind of like a mean reversion type of fader setup. So as long as it starts to work for me, I can keep adding into it and lowering my risk. And that's what really helps you get that really great risk reward. Because what I learned is that if you put a starter on and you cut it for like 0.5 R or something like that, you're not going to really care about that position because you know that when you win, you're going to make so much more. And so once I put my feeler into the trade, I'm a lot more zoned in, more focused, and I can read it a lot better. But it's not enough. I'm not sized in enough where I get emotional about the setup if it goes against me. It's whatever. I just cut it.
When you're using this type of risk model, I just want to ask you about stops and taking small losses here. If you see something in the tape that you don't like, I know tape reading is not a big part of what you do, but if there's something you notice, are you willing to stop out on that trade before you reach your initial stop level?
In the beginning, yes. So when I first put on the trade, I know that since I'm trading counter trend, it's very dangerous. So I do look for situations like that, and I'm very rigid in how I approach the market. So like at one point in time, I was like stop or target only, and so I would consistently take the loss I intended to, and I would not take any partials on the way to my profit target. And then eventually I learned that, once you get more advanced, you start to recognize areas that you can optimize. So you can sometimes see when a trade's going to go against you sooner. And I'm pretty much developing that skill at the moment, where I want to be able to exit the trade for a smaller loss. And that a lot of times that's not systematic at all. It's a lot of times it's what I'm seeing, and I've just gained enough experience where I know where something just doesn't look right, and I can always just add it back on, so it's okay. But I think that's kind of where I'm headed in my journey right now, just figuring out where I can make these discretionary takes in my systematic entry and exit criteria to just boost my stats up a little bit more and protect my capital.
A little earlier, you said that you have quite a low win rate. It can be mid 20%. How many times are you going to try hitting one stock before admitting defeat?
Well, ideally, it's when you notice that the pattern is broken. So for me, I know that there's a certain time of day where if it's, if I'm trading counter trend and it's continuing to push higher in the middle of the day, then there's obviously somebody willing to buy it, and I'm more than likely wrong at that point. So I just know that from my own experience, but I treat it more about my risk reward. So when I was trading earlier with 3-to-1 risk reward, I would give myself two attempts, because I felt that if I couldn't nail it within 2 attempts, then I'm probably wrong anyway. But also, if you have a 3R win, but you lost 2R, then you're profitable. And the reason why I don't do 3R is because if I lost 3R and then I won 3R, then I have fees and locates and everything like that. So it's not truly break even, and that I felt could have an emotional pull. So pretty much as far as it scales with my risk reward. So if I think that I'm going to make 6-to-1 on a trade, then I'll give myself 5 attempts or so in terms of minus 5R. And it's a lot. I have a lot more attempts because I put on starter positions where I can lose minus 0.5 or less. So as long as I keep it beneath that, it's fine. Because there is a relationship between win rate and risk reward where I was really, really focused on growing my reward, but your risk reward is going to go lower. And as a result, because you're going to have to take tighter stops and you're going to take more risks adding to the winner and everything like that. And I know that if I had a lower risk reward, I would have a higher win rate. But actually, I actually prefer to lose more and win bigger because it helps me maximize each trade. And I feel that it's a lot easier to come back from losses. And the way to, really hone in on that is to backtest your signals and just get them as good as possible so that you know that there's a pretty high probability when you get a trigger that's going to work. And the reason why, in my case, you might say like, oh, if you're losing so much, then maybe your signals aren't so good. Well, it's because there's a lot of manipulation in this in penny stocks. So a lot of times I can see that, like with my signals, I can see that they're breaking in an unnatural way, and I kind of just call that divergence, where it's more than likely going to pull back, but I have to just respect my risk, and I'm more focused on cutting the trade and adding it back later than trying to be convicted of my signal. So I'm willing to let trades fly by and just cut my risk whenever I see something wrong. So it ends up being where, because I'm very aggressive on my trades, I have a lot of FOMO. I'd rather be in the trade than miss it. And as a result, I get in a lot of situations where I'll just have to cut it because I might have jumped the signal, or my signal is just, I'm using that slightly aggressive signal, which is not confirmation. My confirmation would be more like my second signal. So if at some point in the future, I might decide that pushing risk reward is not worth it. I think there's a diminishing return for sure. And I might level out, go back to an average risk reward with a 4 or 5 and increase my win rate just so that I have more gains. I think there is a way to test that statistically. And right now I'm just pushing my limits and figuring out like how far I can go with this.
Going into a trade, what's going to make you think that, okay, on this particular situation right here, I have the potential for a 3-to-1, or I have the potential for a 6-to-1? What factors are going to make you think you have different risk to reward opportunities at hand?
So if it's, my strategy is mean reversion. So a lot of times the higher something goes from the meat, the more meat on the bone there is, which is always one good indicator. There's no ATR in small caps, so you kind of have to make your own. And I kind of build my own way to see the average true range of a stock based on the price and what percentage it's at. So I can break that down into different like levels, kind of like a Fibonacci, I guess you could say. And based on that, I'll be able to risk the right amount to where if it reaches my target in terms of mean reversion, it'll be at least a 3-to-1. I know one of the traders interviewed, I think I shared on my Twitter the other day. I think it was
Anthony Riley.
Yeah, I think he does a very similar thing to me, where you kind of revert it based on how much range there is, and you can kind of break it down to different percentages so that I know that like I can risk a certain amount, and if it reaches my price target, it'll be a good winner. And it's apt for the price ranges. It's not too tight, it's not too wide. It's just like a systematic number I can use.
Okay. Now, I think you kind of spoke about this a little bit earlier, but I'm just going to ask you to perhaps share a little more detail on it. Are you taking the trade off only when it hits your predetermined price target, or how do you begin to scale out of it?
Yeah, I do. I wait until my price target, and sometimes I'll miss it. Sometimes I'll get a little greedy, and I've just developed ways to figure out, it's very common sense. I mean, if something is about to hit your price target and it just barely misses, and then I have a rule in my head where I say it's good enough, like it's close enough to my price target. I don't have to be on the dot with it, and I'll just take it off there. Or you notice certain trend reversal type situations where if I'm shorting it and I see higher lows and higher highs, or if it'll cross above like a moving average or something like this, then I know the trend might be broken. And in those situations, I'll take it off. But more or less, I do wait for my price target every time because, I'm in it to revert to the mean. I'm not in it to take it partials on the way down. And I know that eventually that style might not be the best for liquidity reasons, and in a lot of ways, to maximize these trades, you'll have to be recycling and constantly taking it off and adding it back. And I'm working towards that. But as a trader, I kind of know my own limitations where I've had issues with entries and I've had issues with chasing. So I don't fully believe that I'm able to execute that strategy right now. So what I'm doing is I'm just waiting to my price target, and that helps me just stay disciplined compared to constantly lowering my risk or constantly executing and having decision fatigue and putting myself in a position where I might not be fully like aware of what's happening in the trade. Because the more entries, the more exits you put in the trade, the more factors play into your risk. And I'd rather just have my stop at a set location so I know exactly where I need to get out, where I lose exactly what I'm willing to risk, and have my price target, which I know from backtesting hits the majority of the time. So for me, it's not a big deal because I'm backtesting and I understand how my patterns play out and what are the odds really.
Okay, so let's say you're short a stock. It's had a massive run up. You've caught the backside. It's drifting down. If it doesn't reach your price target or the mean value that you've determined by the end of the day, are you going to consider holding that position overnight to try and catch maybe that price on the second day?
Currently, I don't. I know I might eventually get into it, but a lot of the reasons why is because the fees are really crazy. At some brokers, you pay 7 times the short or the locate cost overnight plus interest fees, and a lot of times it's very ambiguous what those interest fees are.
Okay.
And so there's a lot of unknown things, and as well as when you hold overnight, there's different events that can happen or different gaps up and down, and a lot of times it's just too much risk. I'd rather come to each day reset at the moment and just ready to execute. Sometimes like it doesn't hit your price target and then it will the next day just for no reason, and that's frustrating to see. But at the same time, I can sleep fine at night because I don't have to worry about anything. It's all fresh.
Yeah, that's a big part of it. Just a couple last questions, Brian. Moving away from risk here. Or maybe it is tied in still. Your monthly P&L has scaled as of late. If we look at your stats, etc. What factors do you contribute to this?
Just setting goals. So from after the year that I blew up, I pretty much dedicated the next year to treating this as a business and being very modest with my risk. So that entire time I was scaled down way back from where I was, and because I had no other choice. And as a result, I just set little milestones for myself. Like if I can work towards this risk level, then that'll be great for me. And it just happened that my dream risk level coincided with January 2020, where I finally hit it from compounding my account up and up and up. I finally hit the risk level that I wanted this entire time. And that's when I started to see like really good results. And after I did that, I started fulfilling other goals that I set. So I said that I wanted to increase my average risk reward from 3 to 4 to 5 to 6. And so I was constantly backtesting systems and ways to do that. And eventually, basically every month I've increased my R by 1 this year. And I'm starting to get to the point where I feel like it's getting redundant. But during that process, I was just constantly improving while the market was hot and giving a lot of opportunities. But I feel even if the market wasn't as hot as it was kind of more about myself, because I'm really focused on how I can improve as a trader compared to anything else. So when I set those long-term goals for myself, those milestones, it always gave me something to work towards. And I always knew that eventually if I hit those points that I would just start achieving the results that I want.
I just thought of something when you were talking there. You know how you said that you wanted to go from a 3-to-1 to a 4-to-1 risk reward for an average trade? When you're doing that, and I think this is something that maybe someone who's new to this concept or this way of thinking might do, is if they're looking at something and they're saying, I can get in here, I can put a stop here, that's 1R, but it looks like I can realistically maybe only get 2R reward out of this trade, they may just tighten that the risk on that trade a little bit, so that the proportions become 3-1. Does that make sense? So they pull in that stop. Yeah. Can you just talk to that? Is that something you'll ever do? Is that something that you'd caution newer traders from doing? How do you think about that part of it?
Yes, I would caution some traders, because a lot of people look at the results that I post and they feel that it's very achievable, but it's a lot of hard work to hold a stock. I mean, I'm holding a stock for many hours, and for some people, their time horizons is just a couple minutes. And let's say if you're scalping for a couple seconds or minutes, if you put on such a tight risk, you can make a lot of money really quickly, and if you hold, you'll make a lot of money too. But if you put on too tight a risk, you're gonna constantly be stopped out. So in those cases, I wouldn't recommend it at all. I recommend it more for if you're kind of trend trading, where you're willing to sit through a lot of price action, and so there's a lot of range. Like you're not forcing the range, you're just taking advantage of the range. Like a lot of times when I end up covering, I'm covering towards the bottom, like 10% of the low of the day. So it's very easy for me to capture most of the move and to capture that risk reward and constantly add to the winner as it's working. But if you're on a short time horizon, it's going to be very, very difficult. The main way to achieve a good risk reward is to scale into a trade as it's working. And you can't do that if you're only able to get in like very precise moments. And I also think that you have to consider the range of the stock. So if a stock is trading at $5, then 10 cents of volatility is not that much. But if you're trading Tesla or something in the 500s, then you can't put on 10 cents of risk. Like you'll get blown out in a second. And the main issue with that is once it breaches your risk, if you get in that fight or flight or freeze mode and you end up being fearful because you don't want to lose as much money as you are in that moment, it's going to lead to you kind of blowing up your account, or at least taking a big fat loss. And that could lead to a lot of emotional issues where you want to make it back, and then it just starts snowballing for there. So you really have to make sure that your strategy kind of fits the model where you can add into winners. Because I don't have tight risk. Like I start on with a very wide risk, but I have a wide price target, and then I tighten the risk as it's working in my favor. I'm not putting on a tight risk and waiting. So I think it's super dangerous for people if you have the wrong strategy for that movement, unless you have a really sick entry signal that has a very nice win rate. Then I've seen people doing tight risk like that, but personally, I couldn't do that because I think it'd be very emotional.
Right. Brian, let me ask you one last question and then we'll call it a wrap. 3 things you would go back and tell yourself on day one, knowing what you know now.
Number 1 would be max loss. Just set it with your broker, because you have to have that fail safe as if you're a retail trader and you're just responsible for yourself. You need that moment where you get rejected on the level 2 and you have to take a breather and recognize this isn't healthy. Whereas like if you don't have that, you might just fight the stock all day. And I think that's what causes most people to actually get killed. The other thing is I would focus on systematizing my entry and exit, because I feel that if you can create a very simple entry and exit trigger, then you can apply that to backtesting. You can apply that to just optimizing that and making it as good as it can be. And that way you don't have to deal with those emotional components of being afraid or having random results. And that way you can really measure where you're going and how you're going to improve. And then the third thing would be, I would focus on risk reward and make sure that I normalize my risk. Keep a small R at the beginning. And it's all about the process and it's less about the result, because if you trade well, the results will follow, and you need to give yourself enough time to make all the mistakes you made. And I would say, if I think about it in terms of if I think about the journey, at least how it was for me, the first year you're gonna flounder around and not know what you're doing, and there's gonna be situations that you didn't account for, like sometimes the brokers have error, sometimes there's all this type of random things like your power goes out, whatever. How are you going to react to that? You can't be sized in so big that you can't deal with an emergency situation. And then in year 2, you might find something that you like, something that you can stick to that and grow that consistently. And then I think once you hit that 3rd year, it's just whatever it is, all my peers, all the people I grew up with in trading, once they hit that 3rd year where they were consistent and they start scaling up, that's when a lot of them really hit their stride. And, for all the pain that you go through, once you can get to that point, it's all worth it. It's really all worth it. And the money that you lose now in the meantime is just not going to be significant compared to what you will make in the future, as long as you just give yourself enough time to experience the market and experience all the mistakes that you need to make so that you can learn and be your best trader.
Excellent, Brian. Well, it's been awesome to speak with you, and it's really impressive to see what you've been able to achieve. And I think it's maybe coming up 4 years that you've been trading full time now.
I think it's like 3.
3? Okay,
almost.
Well, even better. Yeah. Yeah, it's awesome, man, and well done on your comeback. I think that was great that you could share that earlier on. I know you have a blog which you have some really detailed posts on, and you also have a couple videos on YouTube, and you're quite active on Twitter. I know there's going to be some people listening who would love to check all of that out. Do you want to share where to go?
Yeah, just follow me on Twitter at Brian Lee Trades, and it's the same on YouTube. And pretty much if you go to my Twitter, I'll have everything linked in the pin post, so you should be able to find everything that you need to find, including the blogs, which I highly recommend. I'm a lot better of a writer than I am a speaker, so I think you'll really, really enjoy those posts. A lot of people really love those. And I'm speaking from the heart there. I talk about a lot of things that led to my success today. And I hope that that's something that you can use as a resource to grow on your own journey.
Absolutely. And I'll put those links in the show notes as per usual as well. Easy for anyone to find. Brian, absolutely awesome speaking with you, and I'd love to do it again sometime.
Thanks, Aaron. I'd love that.
All right. Thanks a lot, man. We'll call it a wrap.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.